Push it when the light is turning gray, it means it's working. Hello, hello.
Okay.
All right. Hello everyone. Good morning. We are about to start. We'll start in 2 minutes, and so I'm going to ask you to please take a seat so that we can start the conference. Thank you. All right. So welcome to this event today, which is a joint event between the HKU ESG Institute and the Consulate General of Belgium, where we are going to, well, bridge two words. First of all, the word of academia and the world of practice. So we will try to talk about what we do in academia and see how that can help the work of practice, but we'll also try to understand what are the challenges that people in the industry face regarding sustainability. We will also join, well, Hong Kong and Belgium, as we are receiving professors and practitioners from both places who will share their insight on sustainability. So to start today's, I'm going to invite Consul General of Belgium, David Lomastro, to give you the welcome speech. Thank you.
Good morning, everyone, and thank you for joining us. I will be brief because there are far more knowledgeable people here today. So it's just a quick introduction that I wanted to share with you. I would like to start by thanking our partners at the HKU Jockey Club ESG Research Institute for allowing us to co-organize this conference. Thank you to HKU ESG Center Director Bernice Yu, and congratulations for your new position, for being with us this morning, and to Professor Maxime Couvert, who played a key role in creating synergies and driving the project forward. This joint organization and the partnership that is taking shape through our presence here today happen to be at two strategic crossroads for the future of the planet. Cooperation between industry and academia, and the convergence of European and Asian perspectives on these existential issues. In both cases, cooperation is key to address the broader sustainability challenges we face, from climate change and biodiversity loss to resource scarcity and social equity. However, the stakes require us to be lucid. Discussions on the subject are taking place against the backdrop of marked tensions on a global scale. One of the striking aspects of several speeches at the 30th Conference of the Parties on Climate Change in Belém was the reference not only to the urgency of the situation, but also to the need for dialogue and cooperation, proof that this is a subject of concern. For this reason, and many others, I would like to thank all the participants today, academics and industry representatives, for joining us to discuss these issues. I hope you have a fruitful exchange. Thank you.
Thank you very much, David. Now, I would like to invite Bernice Yu, who, as David just mentioned, just joined us at the HKU ESG Center to become our new center director. So I would like to invite Bernice for her welcome speech.
Hi, good morning, everyone. And good morning to our distinguished guests. Oh, can you hear me okay? Okay, great. Again, good morning, our distinguished guests, esteemed partners, and the Consulate General, Mr. David Lomastro, and respected speakers, colleagues, ladies and gentlemen. Thank you for attending the forum today. And on behalf of the HKU Jockey Club Enterprise Sustainability Global Research Institute, yes, it is a very long name, it is my profound honor and pleasure to extend a very warm welcome to all of you. And we are very excited to be a part of this exchange platform. So I would like to take this opportunity to introduce a little bit about our institute to all of you. As many of you already know, our research institute was established to be a catalyst for transformative change. But a vision is only as powerful as its execution. This past year, we have made significant strides in turning that vision into tangible impact. Well, just this last Friday, we have successfully hosted the 2025 Sustainability Forum. which attracted over 400 academics, industry leaders, and policymakers in person, with around 40,000 participants joining online, which is a very powerful testament to the growing community and momentum behind this critical cause. And today, looking out at this room, I'm both heartened and very inspired to see many of you interested in ESG as a particular topic. Now, our research institute is, whoops. Our research institute is fairly young. We just celebrated our 1-year anniversary last Friday. However, I'm also very proud to share that in the past year, our institution has become a global hub for sustainability thought leadership. First of all, we have a vibrant community of over 200 researchers from across the globe, generating profound insights, resulting in more than 50 articles in top-tier publications, with an exceptional 7 of our scholars ranked among the world's top 1% most cited. Our voice has resonated far and wide through our different media partners like CGTN, Bloomberg, and SCMP, achieving over 3 million media impressions. And we have actively driven social change by convening 45 events that engage over 100,000 participants. And we have expanded our impact through collaborations with 100+ distinguished partners and prominent figures. Now, November is our Institute's Impact Month, and it began with a thought-provoking start through our distinguished lecture series in early November, which featured the renowned American economist, Professor Jeffrey Sachs, and now we gather here today to carry that momentum forward. Well, a bit of marketing here, but do scan the QR code if you're interested to follow our activities and any of the news that our institute publish. Well, coming back to today's event, it is all about connection. It connects Hong Kong and Belgium, and it connects theoretical research with practical application. And most importantly, it connects people, the brilliant minds who drive the sustainable future. Now, we think the challenges of sustainability are too vast for any single institution or region to solve alone. So now we gather the leading minds from both of our worlds. We're creating a powerful ecosystem for collaboration. The insights shared today will undoubtedly enrich our work, and we hope we can also inspire a new, actionable pathway for sustainable governance. Now, before we get into the event today, I would like to extend again our gratitude to our co-organizers who contributed to make this conference possible. Now, once again, thank you for being part of this conference and the essential journey, and we hope you can bring really fruitful insights back after this conference. Thank you.
Thank you very much, Bernice. So we are now going to turn to our first academic talk of the day, and I'm very happy to welcome Professor Henri Servaz from the London Business School. So Professor Servaz is an expert in corporate finance and corporate governance, and of course, sustainability. He has served as a research fellow at the Center for European Economic Policy and is a research associate of the European Corporate Governance Institute. His research focuses on social responsibility, mutual funds, corporate finance, governance. His work has appeared in top journals such as the Journal of Finance, the Journal of Financial Economics, the Review of Financial Studies, and he has earned several prestigious awards. Among those, he was featured in the Financial Times series and as one of the gurus of the future. Beyond academia, he has also consulted for leading firms including Barclays, PwC, Deutsche Bank, and his insight has been cited in top newspapers including The Economist, The Wall Street Journal, or the Financial Times. Please welcome Professor Henri Servaz.
Thank you. very much. It's the clicker. Great. Thank you. Fantastic. Thank you for the kind introduction. Thank you for coming to this conference. It's a great pleasure to be here. And so when I thought about what to talk about, I thought it would kind of be useful to look at what has happened to ESG maybe over the last year or two, when the bubble burst maybe a little bit and the hype disappeared a little bit, and how do we proceed from there? Now, to do that, of course, it's important to understand a little bit what drove the hype, but also what ESG was like before the hype. So I'm actually going to spend a fair bit of time on ESG before the hype and what we can learn from that. I'll talk a little bit about what caused the hype, and then how corporations responded to the hype, because I'm at least going to argue that corporations are not responsible for the hype themselves. It came maybe partly from investors, maybe part from the fund management industry, and of course corporations jumped on it. We'll talk about the bubble bursting, and then what to do next. Where do we take this from here? Now, the first thing we need to note, right, is that ESG is of course not new, right? People have been talking about ESG maybe for 20 years, but ESG is hundreds of years old in that sense. It's always been there. People didn't talk. The term ESG is early 2000s. Before that, we were talking about CSR a little bit, and before that, it didn't have any name, but companies did it anyway. And there's two examples here. If you go back to Guinness in the 1860s to 1890s, very British-Irish example, and maybe some of you saw the House of Guinness show on Netflix. You see that in the show, and of course this is based on true data, in the show, at some point you see them starting to build houses, starting to pay for their workers even after retirement, so providing essentially company pensions, etc. So companies have been doing this much longer than we can remember, and Guinness did the same thing, building affordable housing, taking care of employee welfare. They engaged in philanthropy. Some of the Guinness family started doing charitable work. So this was already part of the nature of the enterprise long before anybody talked about CSR or ESG. Now, you can ask why they did this, but fundamentally, there are only two reasons really why they did this. Either they had a moral conviction that this was the right thing to do, it's the best thing to do. But actually, and I'm going to argue that at least, is because this was also good for business, right? And these two things do not need to go against each other. It just made sense. If you treat your workers better, they will treat you better. And if you make sure that the environment where you operate is clean and provides benefits for the community, well, of course, the community will support your expansion or what you want to do there a lot more as well. So in that sense, it was just good for business. Now, of course, we start with Guinness, but we don't need to go outside of Belgium to actually think about sort of moral capitalism, right? If you look at Solvay, and the company is still out there, founded more than 150 years ago by Ernest Solvay, who's here. And if you look at all the things that Solvay did over its lifetime, this is essentially CSR. They started already in the late 1860s by providing free medical care, workplace doctors, pharmacies. Company housing was built a little bit later on. Then they started providing social insurance, accident and retirement schemes. And then, by the early 1900s, they even started paying people bonuses, etc. And I think the argument is the same. Maybe morally this is the right thing to do, but Solvay, was also a capitalist, and this was done because it was the right thing to do for the people that worked for Solvay, and it made Solvay, of course, a great success story. And so essentially, based on this notion, people came to realize that companies can just do well by doing good, right? I mean, that can just be part of our strategy. It makes no sense to have sort of this narrow shareholder view, because if you have the narrow shareholder view, you're not going to make money for your investors. You're not going to create money for your investors, because I don't know of any company that has unhappy customers and unhappy employees and unhappy suppliers and makes its shareholders rich, right? So people thought doing well by doing good can be the case. And then research started to look into this, maybe a little bit in the 60s, 70s, but then 80s, 90s, and particularly early 2000s, there were actually hundreds of articles published in various journals showing that there was a positive correlation, not very strong, but at least a positive correlation between the value of the firm and CSR. People didn't talk about ESG yet, but the concept was certainly not mainstream. Companies did it, but there wasn't much attention paid to it. They just did it because it was the right thing to do, and they made money because of it. But it certainly wasn't the mainstream concept. And the sources of increased value actually go back to what people originally talked about. And I've done some work on that on the consumer side. We've had very detailed data on consumer products, supermarket products, shampoos by different brands. And we've been able to look at if a company does more on ESG, does it actually lead to more sales by the consumers? And there's data that that's the case. And if there are ESG scandals, there's now very good evidence, and I've worked on that as well, that consumers will just stop buying the product. So why do you do it? Because the consumer wants you to do it, right? There's also evidence on the employee side, right? That employees are actually more willing to work for companies that are more sustainable and even willing to accept lower wages in exchange for the notion that this company is not going to do any harm. But of course, you have to keep in mind that just showing that there's a correlation between the two doesn't mean that one causes the other. Maybe firms that have done very well just have extra resources that they can spend on CSR. And so in some work that I did now, 10, 12 years ago, we actually found that this positive relation, once you take into account that there are some unique features to firms, once you take that unique feature to individual firms out, that this correlation actually goes away. And it pretty much is flat unless consumers are clearly aware of what you're doing. So those businesses that are advertising intensive, this is where you can find out more about what's going on. Now, what was interesting about our work is, of course, we also found out that it cuts both ways. So if you're bad on CSR, then, the consumers also stop buying your stuff. So, if they know more about you, it cuts both ways. Another thing we found that was also interesting is that you cannot sort of be a bad firm and then try to clean up the mess by doing more CSR. The market also sees through that. So if they think it's disingenuous, then they actually punish you more. Now, but what you also have to keep in mind with this whole discussion is that if the market already values the CSR proposition of a company, if the market already values what you're doing in terms of CSR, then it's already embedded in your valuation. It's already embedded in your price. And if it's already embedded in your price, then you can't expect it also to show up in returns. People have already valued it, right? So the returns are not going to be excess returns. And now, seems an obvious point, but I think people are, maybe were a little bit misled by what's going on here. Now, does that mean that it can never affect returns? Well, for CSR, and later ESG, but for CSR to affect the returns on a company, you need something that was not expected, that could not be priced in, that people didn't see coming. And so we try to study this by looking at what happened during the global financial crisis. And we see the global financial crisis also as a period when there was a breakdown of trust between the firm and both its investors, but also its stakeholders. Trust was at an all-time low during the global financial crisis. And our argument was that CSR creates something that you can call social capital. And there's a lot of research on physical capital, machines, and sort of human capital in general, but that's more looking at the individuals. But actually, there is such a thing as social capital in an organization, which is really the value of the bonds that you make between all the stakeholders. And our argument was that in these low trust periods, CSR might become important because this creates a social capital that replaces the low trust that you find in general. And that is indeed what we found. So imagine that you split firms into 4 groups based on how much CSR they do. And you look at the excess return during the global financial crisis, the excess return, the additional return that was earned by companies that were in the second group, so still below the median, but not the worst, the second group, the third group, and then the best group. And you compare those groups to the first group, the lowest quartile, the lowest 25% of companies. And so what we found was during the global financial crisis, there was clearly outperformance of the high CSR firms. And it depends, you can measure returns the way you want. And then we looked at the sources of this, and what you found is that when things are not going well, this is when your stakeholders say, well, you took care of me in the past, I will now take care of you. And so we found that companies, this is always relative too, so these are the top CSR performers relative to the bottom quartile. And so what we found is that firms in the top quartile of CSR had higher operating return on assets, higher gross margins, higher sales growth, higher sales per employee. So what it suggests is that when customers have to choose, when things are not going great, they will say, well, you were good to us, we'll be good to you. The same thing with employees. If you took care of your employees when things went well, then when things don't go so well, they will take care of you. And we later also did some research on the bond market where we looked at the bond spread. So how much extra return do bond investors, right, the people who lend you money, how much extra return do they want from you? And of course, during the global financial crisis, bond spreads jumped up like crazy. But the solid line is the bond spreads of low, environmental and social performance groups. And the dashed line is the performance of high ENS groups. And you can see that during the crisis, the bond spreads jumped up a lot less, right? The market was willing to lend still to these companies. The market didn't charge an extra premium. And you see it at the height, it was 2 percentage points higher cost of financing yourself during the global financial crisis if you were a low CSR firm. So there was evidence in both the stock market and the bond market that it paid off. But it only pays off in terms of returns when something unexpected happens, when there is some kind of shock. Prior to that, and indeed after that, when things are back to quote unquote normal, it's already embedded in the price. I'm not saying that you shouldn't do it, but it will already be reflected in your valuation and it won't necessarily show up in returns. Now there is one reason, and this is now really talking about what happened more recently, there is one reason why prices may still jump up, which comes from this argument that people have built around warm glow. Right? So what's warm glow? Warm glow is when I buy shares in a company, or when I invest in a company, I don't just do it for financial returns, but I also feel good about investing in a quote-unquote green company while I feel bad from investing in a brown company. And so if I get this warm glow, I'm willing to accept lower financial returns in exchange for feeling good about things. Now, of course, if this warm glow increases, right, if more investors now say this is important to me, then they will also drive up the prices. Right? So you can get a little bit of a positive return from this investing if more and more investors are willing to hold stocks just because they do things that they feel are the right things to do. And I'll come back to this warm glow effect right there. But of course, we have to keep in mind, this whole discussion, we have to keep in mind basic fundamental economic principles that at some point the marginal benefits must be lower than the marginal cost and you should stop. And so, some CSR is definitely the right thing to do. Some ESG is definitely the right thing to do, but it makes no sense to do too much of it. At some point, you're going, your employees are going to feel really good, but you're just no longer competitive and you can't sell your product anymore. Or your customers are going to be very happy, but your margins are too tight, and your investors are not going to want to invest anymore. And so, what is silly in my mind is that when people started looking into ESG investing, they kind of lost the plot on a very basic graph that you can draw with anything. You could put R&D there, you could put anything there. At some point, too much is too much, and the company should obviously stop doing it. But the misunderstanding of this fundamental graph, really the misunderstanding of this, then led to a whole hype. And in my view, at least, this was not driven by companies. It was, of course, when something bad happens, because now we think that the hype was too much, then we always look for the guilty parties. And of course, what you should never say is that, were all absolved from guilt, and certainly companies contributed to it in ways that I will discuss later. But my sense is that the hype did not originate there, and the hype may have originated partly from regulators. The ESG term was actually coined. People used to call this a CSR, as I said. And the big difference between CSR is that CSR is more about sort of just doing good. ESG became, kind of a financial thing. ESG investing became the thing to do. People were able to popularize the term much more. And so it moved from kind of a moral argument to more of a financial argument. And then the United Nations launched these principles of responsible investing, and lots of investment managers signed up to it. Of course, signing up was free. I mean, it didn't, it just said that you were going to follow some principles, but there was no check and balance as to which principles you actually followed. And so some people argue that, more than 50 trillion is invested by UNPRI funds. And then, of course, the idea also became mainstream because in the press, everybody started worrying more about global warming, and then that is, global warming suddenly changed to climate change. Of course, you didn't use the word global warming anymore, but that certainly happened. And then governments kind of, got into it, and they realized that they had to take some responsibility, probably through regulation, to make sure that firms didn't sort of, soil the environment too much. And we've got, carbon credits, carbon taxes in many countries. But governments also did one thing that I don't think is very fair. Governments thought, you know what, why should we take responsibility for all this stuff? It's the companies that are making things dirty. Let's just make sure that they solve the problem. So, they have to clean up the environment. They have to do everything that's dirty. It's not our responsibility. Now, I'm not saying that the companies shouldn't clean things up, but for governments to say, you guys figure it out and we take a step aside is not the right thing. Government should regulate. That's what governments are for. Government should impose standards. That's what governments are for. But I think to some extent they thought, very laissez-faire in a way. The market will take care of it and companies will do it themselves. But these ultimately are what in economics we call externalities, right? These are things that the company doesn't fully internalize. And when there is an externality, traditional economic thought says we need regulation, we need somebody else to step in. It's very tough for companies to do this themselves. But with the hype, governments thought, well, let's let companies solve all the problems themselves. And so then, ESG investing became very mainstream. And I would say, investors were misled. Now, it's a very tough one to make that call. But the belief that you would get excess returns while it is already embedded in the stock price is just too much of a good thing. You can't get it both ways in some sense. But somehow, investors were partly led to believe, partly they wanted to believe it, right? I mean, people sort of call this confirmation bias, right? You hear things and you're only going to focus on the things that are already what you want to hear anyway. And if you hear anything negative, you're just going to ignore it. And so I think investors, partly were misled, maybe partly they're, a little bit guilty themselves. But it should be sort of obvious from first principles of economics that if people value something and it's already part of the price, that it can also not then give you excess returns at the same time. It's just too much of a good thing. And so the view that, the traditional thing that you would teach in class when you talk about any economic decision, the view that you reach some maximum and that too much of a good thing is a problem, suddenly kind of changed into this. And I have to be very careful what I say, but certainly there are some people, let me be very careful, who think that way, who sort of say more is always better and we should just keep on pushing companies to do more and more and more. And of course, you keep pushing companies to do more, they'll go out of business. They won't be competitive anymore. But this was the general view. And so people looked for companies that were doing very well on CSR, ESG, thinking more is better, and it's always going to increase the value of the firm. But there is simply no evidence, right, to show this. And so, of course, the investment management industry thought that this was a great thing. It's sort of a new asset class, and you can find all kind of data about how much is invested in sustainable, depending on how you define sustainable. But it obviously took off from zero to multiple trillions, and I on purpose stopped it in 2020 because after that the definition of what is sustainable also changed a little bit. But this is certainly a lower bound on sort of how much money is invested in kind of this sustainable stuff. The actual could be even higher as that. But why not jump on it as an investment management industry, right? It's a new asset class. You can attract, more people, so more investments, more people, and of course you can charge fees on the money that you manage. And maybe under the guise that this is good for you, I may actually even be able to charge a little bit of a higher fee. And research is a bit mixed, but I think certainly early on the fees on these sustainable funds were clearly higher than on the non-sustainable funds, right? And people thought, it's great. And the thing is, if things go well, right, if you earn 20% return, you may not care about paying 2% fees. If you earn 1% return, that's a different story. And so, and then this then becomes, how do bubbles start, right? It becomes a little bit self-fulfilling, right? Because if more money flows into the sustainable investments, then there's more demand for those assets, and then the price pressure alone, all these funds buying those stocks, drive up the price, and this price pressure is not really driven by fundamentals, right? It's just driven by people buying, and of course, that cannot last. Eventually, that has to stop. Now, this was also then backed up by a number of books in the popular press, and there were many books, but from Green to Gold or Grow the Pie or the Sustainable Company. And of course, if you look at what these books sort of said, is that this is what you should do, right? This is like a great business plan. And I am not, be very careful. I'm not saying that it might not be good strategy, and that it might not be a good business plan, but it is not a given. It's not by definition that we all should jump there and, do that as companies. And I think mostly companies were actually pretty realistic about it, but investors were perhaps not. And although if you actually look in these books, you will see that the picture that they paint is more nuanced. People sometimes do judge a book by its cover. And, and then if you see that the two things go together and that's what they write on the cover, then the fact that inside the book they are more nuanced sometimes gets ignored. And so, I am not necessarily blaming the authors, although, a book won't sell, of course, if you put a graph that there is something too much and that it will go down, but partly I think what happened is that people maybe misinterpreted what was in these books as well, partly again because of this confirmation bias that I've been talking about, right? You want to hear that it's good, and so if it's in a book, now it really must be good. And this was also backed up by some academic evidence, and I haven't missed anything here. You might say, I don't want to throw anybody under the bus, but there was probably, I have to be very careful what I say, given that this is getting recorded. There were probably some colleagues who, in their zeal to show that this was such a great thing, maybe were not quite as careful as they should have been in proper academic research by making sure that they, dotted the I's and crossed the T's in what they did. And so there's probably also some academic evidence that was then used to back this up. And of course, you have to be careful, right? Because there's a lot of academic evidence. You can always cherry pick. So on top of the fact that you can always cherry pick the one that happened to find something, if these academics then also approach the problem with a bias, which we should never have as academics, right? I mean, that's the main idea. We can be independent, then you may get problems. But investors loved it, right? Investors absolutely jumped on it. And this is a graph from an article that was published in 2019. And what did these researchers look at? They looked at how much money investors put in high sustainability funds and low sustainability funds. But they look at it at the period when Morningstar, whom many of you may know, it's one of the most prominent databases of mutual fund performance. And they've always had these star ratings that depended on financial performance. But jumping on this bandwagon, they decided in 2016 to also launch globe ratings. And so these globe ratings now represent how sustainable the fund is. So before that period, we didn't know that these were more sustainable. And the blue line is the flow into high sustainability funds, and the red line is the flow into low sustainability funds. But people didn't know that at the time. And what do you see before these star ratings, these globe ratings came out? Nothing. They both essentially got about the same amount of money. As soon as the globe ratings came out, what did investors do? Fed by the hype, they thought, this must be a right thing to do. So they put their money in the high globe funds, and they took their money out of the low globe funds. And even in a short period of time, this resulted in relatively substantial inflows and outflows. So investors jumped on it. And then you get, I think, this kind of vicious circle, right? Where people think ESG is win-win. Win-win means it's good for the environment and it's good for investors. It's always good. The fund management industry popularizes it. Investors then, they think this is the greatest thing, and they go into this category. This then leads to price pressure, right? So it drives up the price, perhaps above fundamentals. So that price pressure leads to excess returns. And this then confirms what people said they knew in the first place, that indeed it was a win-win. And then, this just perpetuates, right? This is, I think, partly what happens. Now, partly, this also then, I want to be complete. It makes it maybe a little bit more complicated. But this partly also then got exacerbated by kind of this warm glow thing, right? The warm glow thing is where investors honestly believe that, this is just the right thing to do and are willing to accept perhaps lower future returns in exchange for holding shares in companies that are more sustainable. And so that also drives the price up. But now, now you can't say it drives the price up above fundamentals, because in some sense the people care less about these fundamentals, right? This is much more rational than what happens here. But so you have the two effects, right? One effect is driven by investors thinking they're going to make a lot of money, they invest in the stuff, and by buying so much, they drive the price up. And then there is another set of investors who actually don't care that much about the returns, but they also buy because they think this is the right thing to do. And both of these effects, of course, initially may drive the price up and leads to this effect. But this is typically what you get, right? This is sort of, when you study bubbles, you often get this kind of pattern, right? Where, people sort of forget, what matters. And initially, of course, these things have excess returns because there's a lot of money invested in it. I think people tell maybe a similar story. I'm not saying it's the case, but people now tell, of course, a similar story about AI investments. And only then, I think, did companies actually follow. The industry sort of got popularized, and companies were doing what they thought was the right thing. Often doing the right thing was what Solvay was doing 150 years ago, or what Guinness was doing 150 years ago. The right thing was to do some. Companies, I think companies are often actually quite rational, and they make investment decisions on ESG just as they made decisions on R&D or M&A or anything else. I think companies were mostly rational in their decision making. It's true that I think companies did a little bit more ESG, but only because I think at least it made business sense. Because when this hype is happening and people say this is becoming important for me as a consumer or as an employee, well, of course, then if this is important to my employees, then if I want to keep my employees happy, I need to do more. If I want to keep my consumer happy, I need to do more. So it's normal that companies did a little bit more, but I would say that they were pretty rational and they were not going to go crazy on this, because they said, what's the point of going crazy and over-investing in this if this in the long run doesn't make any sense? So I think companies were mainly rational. But of course then companies thought, well, are there other ways we can take advantage of this situation? And so one thing that came up, now this happened in the US, but I think it made a big sting globally. In the US, you have this business roundtable. And the business roundtable is kind of a club. You know, we have the same thing in Belgium for that matter. It's a club of large enterprises. And they came out with this statement in 2019 saying, you know, we're redefining the purpose of a corporation. It's no longer about our shareholders. We're going to serve all Americans, right? This is what we need to do. And you don't need to look at the fine print, but you can see the words that they use, right? Instead of shareholders, which actually last, they talk about customers and employees and suppliers and communities and the environment. Now, it's not that these things are not important, customers, employees, suppliers, communities, and the environment. If you don't do well by them, you're not going to do well by their shareholders. But the basic premise is the reason you do this is because it makes business sense, it's good for our shareholders, and it's good for our stakeholders. But that's the, you know, that's the goal. Shareholders is the goal. Stakeholders we make happy, and we will make money, and everybody will be in it. But so they kind of changed their mind. And this was signed by 181 CEOs of the prominent US companies. And that's pretty much everybody who's in the business roundtable. And so people thought this is a drastic change in what companies are doing, but it was not. Okay? It's pretty clear that this was not the case. This is what we call greenwashing. Right? Because there was actually no evidence that these companies who signed this thing changed anything at all. And it's even more, if you were to actually make this change, you're not allowed to do this without first asking your shareholders. You know, you basically ask your shareholders, can I start ignoring you from now on? And of course they didn't do that. There was no evidence that that was the case. And then companies thought, you know, why do we, you know, need to spend all this effort in ESG? We just need to make it look like we're spending the effort on ESG, right? And that's then the famous greenwashing. The other thing that companies did, and maybe you're not going to be so happy with what I have to say here, but another thing companies did is they said, we need to actually tie executive remuneration to ESG targets. And you can see there are various data sources, but one, you know, like 3/4 to 4/5 of all companies, both the largest US and European companies, I don't have the data for Asia, have tied at least part of their executive remuneration to ESG targets. And so there's two views on this, right? One view is, well, maybe this is good for value because in the long run, right, you know, sustainability is good for long-term value. But the other is that maybe this is a way for executives to earn more money. And how do you earn more money? By setting targets that are easy to meet. And, you know, essentially targets you would have met anyway, but now you put it in your compensation and, you know, under the guise that this is the right thing to do. And of course, people have studied this. So it's, you know, what we do in academia. And so the preponderance of the evidence is on the right-hand side. Okay, so only 2% of S&P 500 companies missed their ESG targets in 2024. So 98% paid out or paid something out on this. If you're going to set a target, you cannot always meet the target. In Europe, research suggests that these payments are largely discretionary. And maybe, of course, misguided investors thought that this was the right thing to do. And they even demanded it, although it turned out to be a problem. But at some point, the music stops, okay? And I think the music stops as soon as investors who thought it was win-win realized that actually it's not win-win, and it was probably never supposed to be, right? At some point, it simply stops. And then, you know, they realize that there are these higher fees, which is problematic. And then part of the investors that have this warm glow, but what does warm glow actually mean? Warm glow means you're willing to pay a higher price because you value the non-monetary part, but that must mean that the monetary part in the future is lower, so expected returns must be lower, and if that's then what happens, you get a problem. And then people realize that ESG pay actually wasn't making a difference because companies were paying their executives for doing what they would have done anyway, right? And it was a little bit rigged. And then you got this political backlash, and investors, you know, a bunch of investors said, wait a minute, ultimately, I wasn't in it because, you know, I thought this was the right thing to do. I was in it because I thought I wanted to make money. And when people then realize that they're not making money, then they pull money out. It's been much more severe in the US, and, you know, you all know the background. I don't need to go into that. but it also happened to some extent in Europe. And then a bunch of US states also, and this map changes on a daily basis, but in purple are those states that have some anti-ESG statutes in their books. And so an anti-ESG statute essentially says that, you know, state pension funds, for example, cannot invest in any investment funds that have a ESG remit, because by definition, this is now a bad thing. Right? That's kind of the idea. ESG must be bad. And so we've gone from this, which was a very unrealistic picture, to this, which of course is also a very unrealistic picture, right? And this is the problem, right? When something happens, you know, things go one way, and then when the bubble bursts, people overreact, and the pendulum then switches too far the other side. And so now we're at this decreased return thing. You know, by definition, this is bad, and any kind of ESG that you do, you know, must be destroying value for your investors. And of course, that doesn't make any sense either. So it's really silly, but it's not. This is a typical overreaction. We overreacted in one way, and now people are overreacting in the other way. So now what, right? Where do we take this? Because, you know, I'm supposed to be talking about after the hype, and I spend most of my time talking about before the hype and the hype. But I think hopefully that sets the stage for why we are today where we are and how we should respond to this. And of course, you know, one thing that you have to do to avoid the hype is we have to be realistic, right? So we have to stop this discourse that more ESG will always be better. It was the wrong discourse, and it misled people, so we should have never said that in the first place. We also, I think, have to stop relying on companies to solve the world's problems, and I know some people don't like that idea. I'm not saying companies cannot help, and I'm not saying companies cannot be important, but you cannot expect companies to go beyond what they need to do and remain competitive at the same time. You know, it's just about being competitive. And so we need, you know, governments to some extent to regulate and to impose standards, and of course, hopefully global standards, so that, you know, this can be avoided. But the other thing we have to do is we have to stop the negativity as well, right? That fundamentally has to change. And the notion that ESG, or now, you know, people have now moved this to DEI a little bit, that this always reduces value is simply not supported by the data. And some recent research we did is we looked at hiring in US top firms after Me Too, and something that maybe you don't know is that actually firms did increase to a large extent, you know, lack of diversity in the executive suite. There are a lot more, there's still a minority, but there are a lot more women top executives after 2017 than before. It really has been quite a shift. And so we looked at this, and then we looked at the performance of the company, and we just found no difference, right? And so the point is, you know, if you wanted to find women, you could find women, and the performance is just as good, right? And so the notion that DEI will be bad, you know, there's just no evidence to support that either, right? And so, you know, what we need to speak out as academics. You know, we can't sort of be doing our research and not trying to publicize what we found, right? Because, you know, this is what you need, and you want unbiased, right? Academic evidence. That's the best cure. Not anecdotes, or not what people are saying, or not people with a vested interest. You know, you need people who don't have a vested interest to speak up. And so what should companies do? Well, we need to go back to the basics. I think companies mostly did it. Of course, you have to engage in ESG. Customers and employees want it. Investors may want it because of this warm glow. I personally don't think we necessarily need to tie executive remuneration to ESG targets. If you tie executive remuneration to long-term value by itself will embed the fact that if you are more sustainable, you will create more value in the long run. If you reward something twice, you will get too much of it. And so ESG should be considered like any other business decision. Now, of course, that means greenwashing is out. And so how do we find out that companies are engaging in greenwashing? This is about the media. This is about fund managers. Maybe this is about accounting standard setters that would require this. We need to name and shame those companies that pretend one thing and do the other, right? And we need to use all possible channels to do so. The fund industry, I think, needs to be more realistic about what ESG investing is about, right? And it's not about win-win. It's about, you know, providing access to a certain set of investments that, you know, maybe do something a little bit different. You might get ESG in index funds, and those index funds might even include investors willing to accept lower returns. But then you're going to have some active ESG funds. And those can be out there. There are momentum funds, size funds, value funds, growth funds. Why not ESG funds? It's okay. But we have to have honest language in the prospectus. Are we just going to exclude some companies? Are we going to engage with companies? Or are we just going to do what the fund industry does in general by looking for undervaluation? Investors have to be realistic. I think it's unlikely that they will outperform in the long run. And maybe because of this warm glow, it might well be that they will underperform in the long run, and there's nothing wrong with that if you as an investor are willing to accept these lower returns because it makes you feel good. But we have to be realistic about that. I think governments and regulators have to, take responsibility for dealing with these externalities, stop passing the buck to companies. Of course, you need to improve regulation. So that if you want companies to make green investments, they can do this very quickly. And maybe we want some increased disclosure requirements, but we also have to be careful not to regulate companies so much so that they spend millions on disclosure either. That's not the solution. And so finally, for all of us, what can we do? There's really only two ways we can have our voice heard. We can change our consumption pattern to the way that we like. Of course, not everybody has to be in favor of green, but those who do should show it in their consumption decisions. And of course, if we want change, we should vote. We should vote for other governments if we don't like what the current governments are doing. If we're shareholders, we should also vote in elections, of course, at the company level. We should do that. But so the bottom line, I think, is that even without the hype, ESG is here to stay. Thank you very much for your time.
Thank you very much. Thank you very much, Professor Servaas. I'd like to actually open the floor to a couple of questions. We don't have that much time, but I would like to have a couple of questions. Yes, Shipeng.
Yeah, Henry, thanks for your really insightful sharing. I just want to, so I totally with you on the inverted U shape, but I think the larger question is that when is the turning point going to come? And is that turning point really optimal for the whole system? Because we look at a firm value, which is specific to that individual firm. But what might be optimal for the firm might not be optimal for the system. A lot of companies are simply privatizing the benefits and socializing the costs, such as through pollution. That's a classic example. So I think along this thinking, what's your thinking about the more system level consideration?
Yeah,
because it might be perfect for firm to optimize on CSR based on
100%. I 100% agree with you, but I think firms should still do what's right for them. And if the regulator doesn't like it, we should impose costs, right? The way that companies would internalize these externalities is if somebody above them tells them, their carbon taxes, there is this, there is that, and imposes these regulations on the firm so that they internalize them and then realize that they need to do more. A regulator will change the company's graph, in other words. That's kind of my view. You cannot expect the company to do it. I think companies will simply be uncompetitive if we expect them to do this. And so then we're left with nothing, right? I mean, and people have made this case about what's happening in some countries or industries. But I agree with your basic tenet, absolutely.
Thank you for the presentation. I'd like to take this to the Asian context, because everything you said, I think, is really mostly for a more developed market context. Because if I look at the Asian context, when we were traveling to China about 2 years ago, nobody really cared about ESG. They basically said, look, ESG is just a way, to sacrifice performance, and that's really what it was. But the thing that I'd like to bring into the equation, I think that's something you didn't touch upon, is impact investing, because that's a complete different ballgame altogether.
So, I mean, there's lots in your question. So how do I deal with this shortly? I mean, impact investing is a very small subset, of course, of the investment community where people really take lower returns. It's kind of warm glow to some extent squared, right? It's almost philanthropy, and there is room for that, but I think it's a smaller place, a smaller investment set, where people are really willing to give up returns, right? Now, of course, China, and I mean, if you look at global pollution, right, no matter how much we regulate and do in Europe, we're going to have no influence if China doesn't stop polluting, right? And so there's not much we can do except for kind of having a global conversation, right? Now, there too, the consumer can help, But often the consumer prefers, dirty products that are cheap than, clean products that are a bit more expensive. But, the consumer has to play their part. If the consumer doesn't do it, then we're back to regulators, right? And so, I'm certainly not in favor of tariffs in general, but, if you think that it's just bad for your consumers for your citizens to consume products that are made with lots of carbon emissions, you could tax it that way, right? The tariff could be an indirect tax in that way, right? So you could tell the companies or the country, clean up your act, or we will make your products more expensive, right? But this is the job. This is why we elect people in parliament, I think. It's very hard for companies to do this.
All right. Thank you very much, Professor Sabras. I'm sorry. I'm sure that Professor Sabras will answer your questions during the next break. So now we are going to welcome Haoshan Feng, who is actually one of our PhD student and really kindly accepted to present today, as his co-author was not able to join us today. And so he has accepted to present one of his research papers. And so I'm going to ask you to welcome Haoshan.
Hello everyone, my name is Hao Tianfeng. I'm a third-year PhD student in finance at HKU. I'm very honored to be here and present to you my research titled The Influence of Climate Science on Policy Stringency. It's co-authored with Professor Thomas Schmidt. I would like to introduce this research by illustrating a daily example. With the development of climate science, our decision process, especially for our daily activities, has actually been changed. Take a weather forecast, for example. If we know what the weather is going to be like tomorrow, we will adjust our dressing, our transportation method, and our activities accordingly. If it's going to be rain tomorrow, buy an umbrella, and if it's going to be sunny, buy a bottle of sunscreen cream. So it's a so natural thing why people believe in weather forecast. I think one reason is that they think it is high quality information with low uncertainty. So it's a rare case that the CCTV says it's going to be sunny tomorrow, but the Hong Kong Observatory says it's going to be raining. And that's why people think weather forecasts are precise and have low uncertainty. However, imagine if CCTV says it's going to be okay, but Hong Kong Observatory says there is going to be a thunderstorm. How do we make decisions then? It's not a rare case that weather forecasts disagree with each other. After all, the climate science cannot predict the future like a crystal ball. It has limits. Take the weather forecast for typhoon, for example. I don't know whether you recall this thing, Typhoon Ragasa. It hit China pretty badly in last summer. So in September 18th, 1 week before its landing, we find all different models predict the route of a typhoon has a huge divergence. And on 23rd September, 1 day before its landing, we can find that although the model converge, but it still has a high uncertainty. We only know the exact landing point after it's landed. So under this kind of huge uncertainty, how do we make decisions? For an individual, the worst cases are either it's raining and you don't have an umbrella, or it's sunny, you have wasted your umbrella. But if for a factory, the cases are different, the economic loss or consequences will be higher. If you stop production, but the typhoon does not hit you, you will lose 1 day revenue. And if you produce anyway and get hit by the typhoon, you will have severe consequences. Take a step forward. What if it's for a city, the mayor needs to decide whether to issue a red alert? If it does, and the typhoon does not come, the city will lose its GDP. But if it doesn't, and the typhoon hits it, the economic losses will be even larger. And take a next step forward. What is the decision for a country or a decision for the whole world? And it's not for tomorrow, it's for next decade or next century. And it's under an even larger uncertainty. We are talking about climate for the future decades. How should we make decisions? That's our research topic today. Our research question is, how do scientific climate predictions affect climate policy stringency? And we collect data from internationally 49 countries and 50 US states. We find both evidence internationally and within the United States that higher abnormal temperature predictions lead to more stringent climate policy. That is, if it's for a region, the future climate is predicted to be pessimistic, the politicians would likely to issue climate policies with higher stringency. And this positive abnormal temperature stringency relationship decreases with prediction uncertainty and increases with people's belief in climate change. It's like if although the future climate is predicted to be pessimistic, but the prediction, different models argue with each other. Some models predicts is very pessimistic, but some is okay. And in this case, the politicians will hesitate to act, so they will not launch stringent climate policies as it would be. This can be shown via simple mathematical calculations, but it can also be shown the intuition behind this via simple daily life examples. Let's first begin with why prediction level matters. Consider there are two investment opportunities. One is invest $100 now and you will get 120 tomorrow. Another is invest 100 now and you will get 150 tomorrow. People would line up in the second investment opportunity because the return is higher. The same logic applies to the climate policy decision. If the future climate is predicted to be pessimistic, the return of launch a more stringent climate policy now will be higher. So they will choose to launch climate policy with higher stringency. And let's move on to why prediction uncertainty or prediction precision matters. The same example. There are two investment opportunities. One is invest 100 now and you have 50% chance to get 300 tomorrow. And another is invest 100 now and you will definitely get 150 tomorrow. People would choose the second investment opportunity because although the return is the same, but the risk of the second opportunity is much lower. This also applies for the climate policy decision. If the uncertainty for future climate is very huge, it can actually go both ways. One is very pessimistic, the future abnormal temperature is very high, and one is the future abnormal temperature does not increase significantly. So politicians will hesitate to act to launch climate policies with higher stringency. And last one is why people's belief matters. So there are two identical investment opportunities. Both you will receive $150 tomorrow if you invest 100 today. But next to the first one, a person is saying that it's a hoax. And next to the second one, a person is saying the investment is credible. People will choose a second investment opportunity. So does the climate policy decisions. If the politicians believe climate change is a real thing, they will choose to invest now by launch climate policy with higher stringency. And if if the politicians think it's a hoax, it's a fake news, they will hesitate to act. They will do nothing. So, as we have made the logic clear, how do we empirically test it? And this is the climate predictions we use. We use climate predictions from coupled model intercomparison project. It's a large-scale international and multi-stage project. It has over 100 models with 300 different future scenarios from 42 modeling groups across the world. And it has multiple phases. So it's about every 7 years they will issue a new phase of prediction. It's of very high time and geographical resolution. It gives monthly future temperature prediction for the next century for every location in the world. And it's plausibly exogenous because for one thing, it's predicted on an integrated level, so localized factor would not influence the overall picture. And secondly, it's the driving input factor are the hypothetical future scenarios. It's like what the future temperature would be if people choose their effort to a certain degree. So our result indicates a causal relationship. And as you may not be familiar with the CMIP project, you must have heard of the IPCC report. It's a report issued by the United Nations for the governments and leaders around the world to, as a reference to make their climate decisions. The CMIP data is exactly the foundation of the IPCC reports. The analysis and conclusions in the IPCC reports are based on the results of CMIP predictions. So IPCC report is one of the climate science related are linked with the politics. And to have a direct look at the uncertainty in the prediction, this is a monthly abnormal temperature prediction of all models for New York City until 2060. You can see, although there is a positive trend, the model predictions have a huge variation. So in order to measure that, we use the average as a measure for the level of prediction and the standard deviation as a measure for the uncertainty of the prediction. Then we combine this prediction data with the policy stringency data for the 49 countries from OECD CAPMF project and for the 50 United States. And in the rest of time, I'm going to demonstrate our result. We estimate the effect using a two-way fit effect regression model, and we have added a bunch of robustness tests. But in the presentation, I will focus on the visual evidence because it's more direct. So in the first picture, we have the average future abnormal temperature prediction as the x-axis and the standard deviation, standardized policy stringency as a y-axis. So we can observe a significant positive correlation between abnormal temperature prediction and climate policy stringency in different regions. What's nice about this picture is that we actually have very few outliers in this region or that region. This means there are few regions with low future abnormal temperature but have very strict climate policies, or there are very few regions with high future abnormal temperature but with very loose climate policies. And to get rid of the effect of time trend, we just, again, plot the change in optimal temperature predictions between 2005 to 2020 as the x-axis and the change between climate policy stringency as the y-axis. Again, we find the similar result. And what's surprising is that we actually could find Belgium just on this heated line. That means the politicians and decision makers in Belgium are very smart. They made full use of the scientific information and they can.
You are a very good speaker.
And they can even foresee this. So the magnitude of the estimation is that 1 degree Celsius higher in predicted optimum temperature will lead to 0.32 standard deviation increase in the policy stringency. And if we separate the sample to 2 parts, the regions with high prediction uncertainty and the regions with low prediction uncertainty, we can find that the previous effect is more pronounced in the regions with low prediction uncertainty. And again, if we separate the sample for the regions with high belief in climate change and low belief in climate change, we can find the previous effect is more pronounced in the regions with high climate change belief. This result was confirmed by our regression model, and the result is robust if we change our measure of construction method of our independent variables. What's more, if we substitute our dependent variable from policy stringency with CO2 emission, we can actually observe the coincided result, because with higher policy stringency, there should be lower CO2 emission, and that is indeed the case. So if the region is predicted to have a pessimistic future climate, they will have lower CO2 emission now. And in conclusion, this paper shows that climate predictions affect policy stringency. Higher future optimum temperature leads to climate policy with higher stringency, and this effect size depends on the perception of the information as well as the climate belief. So to answer the question in our research title, politicians listen to climate science, especially if the predictions is precise, and that calls for more precise forecasting in the future. So thank you very much for your attention. If you have any questions, please let me know.
Thank you, Haoxin. I think that's a groundbreaking result to show that politicians actually listen. I think that many people were not convinced at first. Is there any question? Yeah.
Thank you for your presentation. It's really informative. Actually, my question is regarding your perspective. How do you think the climate prediction and the policymaker decision in Hong Kong or in mainland China? Because from your presentation, I think you lack of some information regarding focus in Hong Kong.
Yes.
Thank you.
I think for Hong Kong government, one thing that they care most about the climate in short time would be the forecast of extreme weather events. For example, this Typhoon Ragasa, I don't know if whether you recall this event, but on that day, there is a number 10 wind signal was held, and all Hong Kong factories stops working. All good news is that with the development, especially the AI, in these two models, we can actually see several models predict the typhoon event much better. one especially is provided by Google DeepMind. They say their prediction model could predict the route of the typhoon to a very accurate level. And in this case, this kind of new technology, new method for future prediction, if Hong Kong government and Hong Kong Observatory could implement or cooperate with these technology firms to increase the forecast precision of this kind of extreme weather event, their policy, their decision-making process would be much better. So next time, when the Hong Kong Observatory says so, it's more people will believe that.
All right, thank you very much, Hoshin. I think we have time for one more question very quickly. Sorry, I'll go to the closest.
Thank you. So glad to hear that politicians listen finally to climate scientists. I serve the World Economic Forum Global Future Council on Climate and Nature Governance. Climate is really a manifestation, weather is a manifestation of climate. Climate, we average climate weather patterns over 20, 50 years. So how in your research can pinpoint that the forward predictions of climate is more accurate or less accurate, thereby influencing regulations and climate policies? Thank you.
Yes, thank you for your question. As we discussed in the paper that the decision-making process, especially under the uncertain information, in this case, the future information, the future predictions, is a very complicated thing, because if you make the right decision, you will benefit a lot much more in the future. And if you make a wrong decision, like today, you may need to invest directly today. So if your decision is wrong, you will not only lose your investment today, and you will have very little effect in the future. So if we rely on the weather forecast precision, we need to make balance between the overall effect as well as the uncertainty. So you can develop very sophisticated models. You input the future information, and you can output most likely or most optimal climate decision. But hopefully it would be the case in the future for the future politicians. But in our results, we can again see very significant deviations from what the policy should be compared to the predictions of their region.
All right, thank you very much, Hoshin, again. And now we are going to take a 20 minutes break. So you have coffee over there. So thank you very much.
How are you? Yeah, good to see you here. Yeah, good to see you as well. See which cases. We share some EA siblings. Yes, I did my
PhD over there. I see. Okay, well, so where are you now?
I'm based here.
Oh, okay.
I happen to be also Belgian.
Oh, yeah, okay.
We also have the our ESL like here.
Yeah, that's right.
Very important roles here.
Oh, I see.
Yeah,
Okay.
doing a lot of stuff like that. Yeah, it was interesting, right? You were asking the question, right?
Oh yeah. It was, no, I mean, I see the point, but you know, politicians don't necessarily. You leave the job to the government. Question: can they deliver?
Yeah, that's absolutely true. Yeah. But yeah, the corporates also it went too far. That's true. I mean, I'm a portfolio manager, right? So you're struggling with this thing as well. Like you have people in management saying like, "I the more you choose better returns." No. If you exclude more and more of your universe, you have less and less alpha generation opportunities. Yes, it's just normal mathematics. People press you, I don't want to hear this. I don't want to hear this. Just invest more in ESG. And then indeed, it's true. Like that has a self-fulfilling prophecy because everybody buys the same 5 stocks. It keeps going up, and then they crash.
I thought in the earlier days, when they talked about ethical investing, I thought the argument was that it doesn't work. But then I thought the early argument was that it might not be thought that it doesn't work. Now it becomes like all the way excessive return was like really. The narrative actually changed.
And the problem is, we also have a very good performing stock LGD, my previous employer, and then the sales guys and the ESG was part of the process, but it's not the reason why it didn't perform well. Portfolio manager did like a very good bet on both things, right? It had nothing to do with ESG, but then the sales, they were thinking like this is big sell this product, and then like they said, oh, we're doing ESG, great, and then all they talked about was they couldn't, they felt uncomfortable saying like, yeah, the portfolio manager's judgment, it didn't feel like the right pitch. The pitch was sustainability growth is outperformance, and then it damages in the end ESG because now we need the opposite movement. And so that's also the right. So now it's actually doing damage to the sustainability effort, which is supposed to be a good thing.
I think fundamental drivers.
There was too much hype on now, and now it's the opposite.
Yeah, lots of regions pause their ethical which I've been here for. Because this is such a big process. Influence the other. But I think a lot of pension funds do care deeply.
Yeah. There is a bit of a long-term argument with the universal. Yes, that argument. The argument like multiple generations.
Although the problem, not every economy is on the list of that's a mismatch. Right? So because the universal ownership is if you own the entire piece of the economy, then any externality will be bad because all responsibility will be then the question is the listed company not representative of the whole economy?
But
there may be some economy I think so.
Yes. Because also it's for a pension fund and like the endowment fund that has an LGD as well, and also invest so much in the private markets. So soon you will need to cover almost entirely the economy. There's always something that escapes.
Because they also really care about like 20 years. So I don't care about what Trump gets elected. I need to look at like 20 years macro trends. Trump is just a random factor.
Exactly. It's a blip. It's hard to quantify.
The most compelling one so far. I haven't seen any other one. I don't think I've tested
and the other argument is also from like some governments, actually European governments have done a lot for ESG. But yeah, if you're a whole continent alone, you're actually just damaging your industry. The industry is gone. And then it's like, yes, yeah, and now we don't have pollution anymore, but we also have no employment anymore. So
That's the problem. No, you're a good place to talk to. I try to talk in the high end of so this anti-trust law, which processing this, and then some exporting company in China. They do it in a weird way. They force the workers to get at 5 p.m. To comply with the regulations. So, and I look at it because sometimes some workers will say, oh, there's a damage on economy. But this time is different. Everyone's praising them. Well, that's great. Even though they do it in a very weird, such as carbon electricity, so you have to be on some of the drastic measures. But some people are very or some there's actually some so some people work as a whole is actually good for us. Even though we know the office of it could work, it could work. Because it's a big exporting company like fire. They do this. Europe just has to simplify the regulations. Also for fund managers, right? Like you have all these articles, 6, 8, 9. Also that went a bit too far. Just that at the end, for investment, it's just it's impossible to implement sustainability at this level. So being a lot of people online funds were launched there's actually no more investment in it. Okay, so that's just it's also raised in such a vague way that as a fund manager you're hesitating to adopt it because you feel like yes, it's raised me abuse of so their governments something often have money I often tell that to my European friends. Because some of them very conscious because sometimes some regulations are good intentions have unintended consequences. We know there are a few that actually work. Sometimes working like anti-slavery. We're also working back to that by forcing really social responses that some people so there's a bit of trade-off. So they also being very conscious and I told them, people depends on the regulation. Yes,
待会他们自己拿吧，我。
All right. I'm going to ask everyone to please go back to the chairs so that we can move on with our next presentation. Yes.
I mean,
Okay. I'll announce you and then you go first. All right. Thank you very much, everyone. So I'm going to let Professor Thomas Maurer announce the next section, which is going to be about sustainability in asset management.
All right. So thank you so much, Maxim, to include me as a session chair in the program. So it's a great pleasure to have Dun Hong Jin presenting her paper on how green is green, autonomy of ESG funds selection. And we have the timer there in the back. Dun Hong. You have 20 minutes.
Thank you, Thomas. So first, welcome to Hong Kong and welcome to Hong Kong U. I'm Dun Hong from Hong Kong U Business School, and today I'm presenting an empirical project joined with my colleague Ronnie and our PhD student Meng Han, who is on the market this year. And before I start, I would want to say, feel free to interrupt me anytime during my presentation if you have any comments or suggestions. So how green is green? This is the question we strive to answer in this paper with a focus on ESG funds selection. Actually, the starting point is more general. Say, what's the role of shareholders in promoting ESG? Back in 2021, we see a letter by Larry Fink to its shareholders mentioning that BlackRock will put ESG investment in the center of their approach. But after 2 years, exactly these shareholders criticized on BlackRock's ESG investment, saying that they are not actually fulfilling what they promised. So these shareholders even threatened to withdraw their monies from BlackRock. So the society demands to know, are ESG funds really able to move the dial and to fulfill their ESG promises? Of course, we are not the first to ask this question. Existing literature already document the impact washing behavior of ESG funds, meaning that they tend to do selection more by doing treatment. What does it mean? It simply says that these ESG funds tend to invest in the firms that are already green instead of investing in those who are brown and trying to convert them into green. Even the evidence on selection is actually mixed and unclear. For instance, there are some studies using the, say, PRI signatory events at the fund family level and looking at only ESG scores, arguing that there is actually no selection. But other papers using different samples other than US sample or using different ESG measures actually send contradicting findings. So in this paper, the message is very simple. We focus on US equity funds, use various ESG measures, and in a systematic way, trying to understand the exact manner and extent of these funds selection. Okay, so the first question we try to answer is how do these ESG funds attempt to make this selection? First, we all see that existing literature mostly compare ESG funds to average non-ESG funds. But we believe it's a kind of unfair to say how can we compare a growth active ESG funds to a non-ESG index fund. So we believe the first step is actually to define a comparable funds or benchmarks for all of these ESG funds, either using those who are used by the rating agencies or what the funds compare themselves to as these comparable funds, and then to say to what extent these ESG funds really deviate from this otherwise identical portfolio. Okay, so we will look at the holding deviation by defining these benchmarks. And we all know that ESG funds, they care about emission, but emission clearly concentrates in a few specific industries. So the question arises saying that are these funds doing their selection at industry level or at stock level? Meaning that do they simply drop the brownest industry in their portfolio, or they actually pick the best performer within each industry? Equally important, we look at extensive versus intensive margin selection, and we will actually decompose ESG funds to different types to look at their different selection strategies. Okay, so the second part of the paper, we try to quantify the greenness associated with this selection using all of these common E and S measures we can think of. And as the last part, we try to unpack the cost they pay for being greener. Of course, we first look at the financial performance, right? They widely discussed in all the literatures, and we also look at their, say, fundamental risk profiles, including their diversification, portfolio return volatility, cap and beta, and especially the exposure to macroeconomic risk factors. Okay, so let me try to summarize the findings by answering these three questions one by one. Question one, how do they attempt to make their selection? As we mentioned, we first need to define the optimal portfolio, or say a benchmark for each of the ESG funds, and we choose the Morningstar category classification. Probably you already know that the Morningstar category classification basically assign a ESG fund into one of the cell when it's identified by their market cap as well as their investment strategies. So there will be large, mid, small, and there will be, say, value, blend, growth. Okay, so each of the ESG fund will fall in this one 3x3, say, style box. And then we actually use the matched non-ESG funds within the same Morningstar group, Morningstar category group as the reference point of this benchmark. And then actually we see that about 80% of our sample ESG funds are actually large cap funds. Okay, and then to look at the holding deviation, we actually take each of the weight of the stock in these ESG funds compared to a non-ESG fund, take the difference of the weight, take the absolute value, sum it up, and divide it by the number of stocks held by the fund, define it as the stock level holding difference. Okay, so we see that overall, the holding difference between ESG funds and their otherwise identical portfolio is actually only 5 bips per stock. This is because if we look at the large cap funds, I mean 80% our sample, they only deviate about 5 bips per stock, even though the rest of the sample, like small, mid caps, they could deviate a bit more in terms of the discretion of choosing their stocks. So how can we say the economic significance of this level, whether it's large or small? So we conduct a placebo test. So we actually use this matched group of non-ESG funds and match them with the closest matching non-ESG peers within the same category, and then trying to compare the holding deviation of our ESG funds to the holding deviation between these two similar groups of non-ESG funds, and we find they are almost exactly identical. So then we are confident to say, okay, they don't really seem to differ much from this comparable funds, right? They almost hold identical portfolio as compared to the similar non-ESG funds. Okay, so Morningstar category also assigns a benchmark index to each of these cells, each of the group, and then we are able to compare ESG funds to this benchmark index. Okay, so probably the most important measure we can think of when we talk about ESG, or E more specifically, will be emission. We do show that ESG funds have a significant 36% less GHG absolute emission compared to their benchmark index. But surprisingly, more than 90% of this emission reduction is actually coming from only 2% adjustment in their holdings. And that will be the holding of the top 25 emitting companies. Okay, so if we take the top polluting companies, the top 25 emitting companies, they already account for 50% of the total emissions. And in our sample, we see that around 35% of the ESG funds simply don't hold any of them. Okay, it's clearer if we look at this figure. Okay, so the first two pillars indicates the ESG active funds compared to their benchmark index. The second group looks at ESG index funds compared to their benchmark. And the red part in the pillars represent the emission coming out of this holding of top 25 emitters. The blue parts are the rest of the holdings. And then we can see almost all the emission reduction are coming out from the red part, right? If we exclude the red part, there's barely any difference between ESG funds and their, say, benchmarks, right? So then it's actually very obvious that emission is actually very well distributed in certain specific industries, and then they simply can adjust their holding a little bit to achieve this outperformance in the emissions. Okay, so to decompose ESG funds to active and index funds, we also find an interesting result that they seem to perform different selection strategies. And we see that ESG active funds perform more across industry selection, whereas ESG index funds perform more within industry selection. Okay, so this might be a little bit counterintuitive because that basically is saying ESG passive funds are doing a more granular level of their selection. But if you think of their diversification requirement, it kind of makes sense, right? So as a passive fund, you cannot simply drop the entire industry. You have to hold a more balanced portfolio in terms of the industry distribution and because of the diversification constraints. So that leads to different selection strategies by different types of ESG funds. Okay, so the three parts, the almost identical portfolio to their comparable funds, the avoidance of top emitting companies, and the different strategies employed by active and passive funds add up to give us a big picture about how these ESG funds attempt to make their selection. Okay, so then I'm trying to address the second question of the paper. What's the greenness, or to quantify the greenness of these ESG funds? As we already mentioned, these ESG funds are significantly better in terms of their portfolio emissions. They are also significantly better in terms of managing ESG-related risks. However, what is surprising is that ESG funds seem to be very similar in terms of ESG scores, right? So the first measure we can think of when we talk about ESG, and then social aspects. Okay, so I want to highlight the results on the ESG scores. Basically, in the paper, we use all the common used ESG scores provided by 5 different rating providers, including those Sustainalytics, KLD, Refinitiv, MSCI, etc. And then we see the consistent message sent by all the 5 rating providers is that the ESG funds don't seem to differ much from their benchmarks in terms of their ESG scores. Okay, so some of the reason we can actually think of. So first, when we look at these ESG scores, it's not just about tangible outcomes, right? It's not just about emissions. So even if we observe significant emission reduction of ESG funds, it doesn't necessarily translate into ESG scores because the score also factors in like disclosure, governance, compensation, a lot of other issues. Okay, and the second reason is that when we actually plot out the industry across industry distribution of these ESG scores, we see a tiny variation across different industries, right? So how could we expect a big difference in portfolio level ESG scores if the source score doesn't actually exhibit much variation? And lastly, out of the 5 different rating providers, actually 4 out of the 5 say do some industry adjustment, meaning that when they have these subcomponents in their ESG scores, they actually assign different weight to these components in different industries. So that makes any comparison across industry being meaningless, right? You cannot really interpret any result when you compare 2 firms across industry. Okay, so these results are also consistent if we look at E-scores separately. Okay, so that basically points to looking at ESG score only when we assess the greenness of these ESG funds is at least insufficient. Okay, so as the last part of the paper, we try to address the costs associated with their selection. Okay, so first we show that even though ESG funds on average hold only 17% of the stocks as compared to those benchmark index, they only have modestly higher volatility. Okay, so that means they don't really seem to suffer from their portfolio risk with this regard. And we show that they are very similar in net fee alpha measures when we use either risk premium or 3 factors, 4 factors, 6 factor alpha. If anything, we show that ESG index funds consistently outperform, while ESG active funds consistently underperform. Right, this is kind of less surprising because our sample period is from 2010 to 2022. Over that period, we can't believe the passive funds really doing a good job. So it's the same when we actually apply it to ESG active and ESG index funds. Okay, and as an interesting part, actually we show that when they try to avoid these top emitting companies, these companies largely concentrate in energy utility sectors. Then it's actually kind of natural to believe like during periods, for instance, in 2022, when there is a high energy-driven inflation, maybe ESG funds cannot really take advantage of this rising energy prices as non-ESG funds or as their benchmarks. So we indeed show that this is the case, that ESG funds are less effective as a hedge against energy-driven inflation. So when we construct the inflation shock variable during the high energy-driven inflation period, ESG funds do underperform. Okay, so that's basically all the results we have and a lot of messages. To sum up, we do see that ESG funds are able to construct portfolios that have lower emissions, and this is done with minimal cost on their returns and risk profiles. However, this is only to a very limited extent because they largely retain all these components in their, say, benchmarks or otherwise identical portfolios, while only dropping 2% of the top emitting companies. So that means even if they have impact on cost of capital, it's only on these top 25 emitting companies, right? So it's not hard to believe that they have limited impact on most of the firm's cost of capital or, say, ESG improvements. Okay, so I'm going to flip through the literature and then unpack the empirical parts a little bit. As I said, I used the Morningstar data from 2010 to 2022. After cleaning the data, we have, in the end, 3,800-ish US equity funds. Among them, 516 are ESG funds, and most of the ESG funds are active funds. 64 of them are ESG index funds. Okay, so how do we classify ESG funds? Right. So the fund is classified as ESG fund using this Morningstar column, sustainable investment product, or if the fund is compliant with EU SFDR Article 8 or Article 9. So there are funds, say, domiciled in EU but marketed to US investors or the other way around. So we also include these criteria as used in the literature. And as I said, I use a bunch of ESG impact score and ESG risk scores. So first about the general ESG scores. So we have 5 of them, MSCI, Refinitiv, KLD, S&P, Sustainalytics. And for the ESG risk scores, we have the RepRisk dataset and the Sustainalytics risk score. Okay, so just to clarify a little bit, so the Sustainalytics actually provided ESG impact score up to 2018, 2019. And after that, they switched to provide Sustainalytics risk score. So there's a methodology change around that time. And then there is an aggregated version to the fund level, which is a well-known Morningstar 1 to 5 global rating. Okay, so this is essentially the ESG risk measure, not the ESG impact measure. Okay, and we use standard, say, emission data, social measures, and industry classification. Regarding the benchmark, I want to clarify a little bit. So we allow either objective benchmarks, meaning that what the rating agencies compare these funds to, or subjective benchmark, meaning that what the funds stated in their prospectus to compare themselves to. Yes, please. Okay, sorry, I thought you had questions. Yes. Okay, so in the presentation, I'm using the first one because it's precisely based on the holdings, investment style, standard risks, and has the best coverage. But we also show in the paper that our results are robust with respect to other choices of benchmarks. Okay, so then let me unpack the findings of how do they attempt to make the selection. So we have this holding deviation measure. As I said, if we take the weight of each individual stocks of the two funds, take the difference, absolute value, sum it up, we call it the total or the sum of the absolute holding difference. And if we scale this by the number of stocks in the fund, then it's called stock level holding difference. Okay, so let's quickly take a look at the results. First, I just separate all different categories and also separate active and index funds. We can see that most of our sample ESG funds are large blend type, right? More than 50% of that, and more than 80% of the ESG index funds are also large blend category. Okay, so let's take a look at the number of stocks of ESG funds and of their benchmarks assigned by Morningstar category. We can see that it's of course not ideal if we compare ESG funds to the benchmark index because they only hold about 17% of the stocks as compared to the benchmark. But a more comparable group will be the matched non-ESG funds, of course matched using star rating, size, etc. And then these two groups of funds are very comparable in terms of the number of stocks. And then we are able to say to what extent ESG funds really deviate from this comparable non-ESG funds within the same group. Okay, let's take a look at the result. Okay, so I highlight two numbers because this is the most important group in active funds, most important group in index funds, and the deviation is all like only 1 bips per stock. And the average deviation across all the groups will be 5 bips per stock. As I said, how to assess whether it's big or small, we use the applicable group, which is the deviation between two similar non-ESG funds, and then we show that deviation level is almost identical, like 5 bips per stock. Okay, and as said, the top emitters are important, right? So even though they have only 5% of total market cap, they account for most of the emissions. And then when we actually list all the top emitters within our sample across different fund quarter, right? So in total, we have 42 firms on the list, right? So these are, say, consistent polluters like ArcelorMittal, ExxonMobil, Southern, Berkshire Hathaway, right? So they consistently show up on the list, and these are the companies that these funds try to avoid. Okay, so in the end, we show that the blue line is the reduced, say, emissions, and the red line is the reduced holding of the top 25 emitters. Those funds with the least holding of the top 25 emitters have the lowest emission, and those with the most of the top 25 emitters have the highest emission. Right? So that means they mostly do this by avoiding only a tiny part of their holdings, and they are able to achieve a large emission reduction. And this is mostly done at extensive margin. Okay, so I'll quickly unpack the method we use to quantify the greenness. For instance, if we use the emission as a result, then we can see that when we compare ESG funds to their benchmarks, they have a significant lower emission as well as emission intensity, but this also applies to non-ESG funds, but just to a lesser extent, right? So in general, institutional investors are greener than the benchmark. And we also run the regression to test in a, say, more rigorous way. So first we say have the Y variable being the benchmark adjusted ESG performance, and then we have the ESG dummy. Of course, we care about this beta one here, and we can, of course, decompose that to look at the difference between active and passive funds. And we include the controls, fund quarter, fixed effect, fund family, fixed effect, and Morningstar category fixed effects. Okay, so the results indicate the same pattern that ESG funds are significantly less polluting. Okay, and the last part I want to highlight, we always decompose this into across versus within industry selection, and we can see that ESG index funds do more within industry selection and active funds do more across industry selection. Okay, so for the time reason, we basically sum up that we do show ESG funds are greener in terms of their emission, but this is with minimal sacrifice of their return and risk profiles. But they only selectively avoid a very tiny list of the holdings, which is the top emitting companies. So we argue their say results or their impact are limited in scope in terms of cost of capital or ESG improvements. Okay, thank you very much.
All right, thank you so much, Dun Hong. We have time for 2 quick questions.
Just a short question. You mentioned the ESG fund mix is lower volatility, right?
Like modestly higher volatility, not lower. Yeah.
Is there a reason in the observation? Just.
Okay, so but I mean, if they hold identical portfolio to similar, say, non-ESG funds, then it's actually not surprising to believe their volatility are largely similar. And of course, if we decompose ESG funds to index and active funds do perform worse in terms of volatility, while index funds don't seem to suffer anything in terms of volatility.
Yes, sorry, good question. If they have no difference in investment strategies and no impact on WACC, what's the point?
So that's why we actually hold a relatively negative attitude towards ESG funds, right? So for instance, here I put in like policy implications, quote unquote. So if we want to be an ESG fund, I can do it within 1 hour. I just drop the dirtiest part of my portfolio, then I'm done. I can game is on, right? So if I'm a investor, right, seeking the sustainable investment tools, actually I would say at least the ESG index funds is a good option because you lose nothing, right? So they actually are greener, but their returns are also equally good. They don't suffer from volatility. I lose nothing in terms of ESG index funds, right? So it's also a very good say kind of investment option. So we hold a slightly negative attitude towards what they are doing. So basically that's the takeaway of the paper.
All right, I think we have to move on. So again, thank you very much, Dun Hong. And then we have our organizer. And, did a lot of work here. So Maxime Couvet with AI Proxy Advisor. You also have 20 minutes.
Thank you. All right. Okay. Well, thank you very much for being here today. So I'm actually going to talk about voting. As our keynote speaker this morning said, one of the main strategies that you can use to have an impact, whether it is on our society by voting at elections or whether it is actually at firms, is going to be one of the main strategies for citizens, but also for shareholders to have a sustainability impact. So what I want to talk about today is, can we actually use artificial intelligence to make better voting decisions at firms? So like a couple weeks ago, there was a very important vote at Tesla. Many of you might have heard of it. Shareholders had to decide whether or not they wanted to accept a compensation of $1 trillion for Elon Musk, Tesla's CEO. This vote is actually quite complex when you think about it. On the one hand, you might think, well, that's a crazy number. I mean, if you give $1 trillion, you're basically losing $1 trillion in firm value. So that's a cost for shareholders. But on the other hand, how do you incentivize the richest man on earth? It's not an easy decision. How can shareholders actually decide what to do, what to vote? One of the strategies that shareholders will use is to buy the services of what we call proxy advisors. So proxy advisors, especially Glass Lewis and ISS, which are the two main proxy advisors, give recommendations on how to vote and help shareholders to decide how to vote. And these both proxy advisors, ISS and Glass Lewis, who hold about 90% of the market shares in the proxy advising industry, they both recommended voting against the compensation of $1 trillion to Elon Musk. Well, the result was that shareholders actually accepted the compensation with 75% support, so quite large, and the stock market reaction fell by 8%. I am not saying that the stock market reaction actually is a direct implication of the vote, but this is something that we can observe in terms of correlation, is that this vote was followed by an 8% drop in market price. So did shareholders actually make the wrong decisions? And how can we know what would be the optimal decisions to make? This question is difficult because there are so many topics on which shareholders can actually vote. I just talked about CEO compensations, but shareholders can also vote on, for example, approving greenhouse gases emissions reduction plans. Or they can vote on reducing plastic use at firms. Or even vote, oh, lost it. Oh. All right. They may even vote on, well, board diversity or animal welfare. How do you decide whether you would like, for example, to ban animal testing? I mean, of course, it might have a good social impact, but at the same time, for a pharmaceutical company, this might be highly problematic if they're going to do animal testing. So this might have negative value implications for the firm. So how do you actually decide? These decisions are very complex, and shareholders have to vote on so many of them. Just think about an institutional investor. It might have thousands of companies in its portfolio. And for each of these companies, they may have to vote on 30 votes. That's tens of thousands of issues that they might have to vote on every year. So how can you really analyze what would be the optimal vote in these situations, especially when the value implications of these votes are not clear? I mean, I don't know ex ante whether supporting the $1 trillion package for Elon Musk is a good decision or not. That's very complex. And the reliance on proxy advisors might not help. There is actually a lot of criticism about these proxy advisors. Many people argue that they have a one-size-fits-all approach. So they are not really tuning their recommendations to every firm, but they just provide blunt recommendations that might not be actually tailored to the goals of the firms and that are optimal for the firms. They might also face conflicts of interest because these proxy advisory firms, they are actually selling consulting services to the firms for which they are also supposed to provide voting recommendations. So they have like these conflicts of interest. And there are quite some academic evidence that they might even provide value-destroying recommendations. Finally, some people might argue that they might have a biased or political view. This is actually something that, like Donald Trump, who's actually claimed, they would say that these proxy advisors, they are way too ESG friendly. And in practice, what we observe is that, well, shareholders, they actually do vote for value-enhancing proposals. So there are quite some studies that analyze the market reaction following a vote, and we find that when you have a positive market reaction, so when you can have a positive market shareholders reaction when shareholders vote in favor of a proposal, but we also observe that shareholders might not vote in favor of value-enhancing proposals. In addition, there is some evidence that shareholders might support value-destroying proposals, for example, proposals that are submitted by labor unions or religious groups or NGOs, and that pursue the interest of these groups, the special interest of these groups, instead of shareholder value. So the question I'm going to ask is, well, can AI actually help shareholders make an optimal voting decision? To do this, we collected data on thousands of votes. So we have the data on all of the topics of the votes. We have data on who is the sponsor of the proposal, and the sponsor can either be a shareholder or it can also be management. Management may also ask shareholders to vote on some issues. We have data on firm characteristics, so that would be data on firms' financial ratios, such as their profitability, their return, etc. So we have data on firm characteristics, and finally, we have ESG data. So these are like ratings such as MSCI ESG rating. And we use all of this data to train a machine learning model such that it would actually maximize the market reaction following a vote. So the market reaction, we are talking here about like a 3-day market reaction around the vote, and we train this machine learning algorithm on a data set of proposals between 2007 and 2020, which represents about 70% of our data set, and we want to find what are the determinants of having a voting outcome that maximize the firm value, the market reaction to the vote. Once we have trained this algorithm, we use it to predict what would be the market reaction in 2 situations. One situation where shareholders vote in support of the proposal, and one situation where shareholders vote against the proposal. And so we have this predicted market reaction for our sample between 2020 and 2024. And we try to analyze, based on these 2 predicted market reactions that are predicted by our machine learning model, what is the optimal vote? So that means that we are going to look at what would be the predicted market reaction in case of success. And if we see that the predicted market reaction in case of success is larger than the predicted market reaction in case of failure, we say that the optimal vote is actually to vote in favor of that proposal. On the other hand, if we observe that the market reaction is actually smaller in case of success than when we have failure, well, we say that the optimal decision would be to vote against that proposal. We then test in our model whether these predictions actually make sense. And to do this, we look at the real market reactions, not the predicted one. And we look at the real market reactions when shareholders actually voted, so we can observe how they voted between 2020 and 2024. So we look at how shareholders actually voted, and the cases where they voted as our optimal, AI optimal vote suggested, compared to the cases where they voted in opposition to what our AI optimal vote suggests. And then we analyze whether these 2 actually are different. If we can find that when shareholders vote like our AI model says is optimal, and we find that the market reaction is larger than when they voted differently than what our AI model says is optimal, then we can say that indeed the AI model is able to tell us what would be the value maximizing impact. So I'm going to tell you about the result here. We create these cases where shareholders, we look at the market reactions where shareholders voted
like our AI model would say is optimal, and the market reaction where shareholders voted differently than what the AI model would say is optimal. And then we compare the difference between these two cases. And we do that at a narrow margin, several narrow margin actually, around the majority threshold. Why do we do that? Well, because a proposal that would receive a 90% support actually is very unlikely to generate a market reaction because everybody expects the proposal to pass. Similarly, a proposal that receives a 10% support, well, everybody already knows that that proposal is going to fail, and so it's not going to generate any market reaction. So what we are interested in is these proposals that are within a narrow margin around the majority threshold. And we then look at the difference here between the cases where shareholders voted like AI says is optimal and the case where they did not. And what we find is every time for all of our narrow margin, we actually find that when shareholders vote like our AI optimal model would say is the best votes, well, this generates a much higher market reaction of about 1 to 1.5% than when they vote in a different way. And if we actually look at the long term here, we just create two portfolios. One portfolio where shareholders voted like our AI model suggested, and one portfolio where shareholders did not vote like our AI model suggested is optimal. And what we find is that even after over 6 months, these are trading days, so that's over 6 months, we still find that the portfolio where shareholders actually voted optimally, AI optimally, performed much better than the portfolio where shareholders did not vote AI optimally. We then look at these different predicted returns and we create 5 portfolios depending on the predicted returns. So from the case where the AI model says that supporting the proposal would generate the 20% highest return, to the case where the model said it would generate the 20% lowest return. And what we can find is that indeed, when shareholders actually vote like our AI model suggested, proposals that the AI model said would be the most value enhancing indeed generate the highest effect. And so we can really see this different effect for like here, the top 20%, then the second 20%, the third 20%, and finally the last 2 where the impact is the most negative. We then ask, well, what about these proxy advisors? We mentioned them at the beginning. I was telling you, well, these proxy advisors, they might not actually do a very good job. So what we want to know is, are we able to do a better job than these proxy advisors with our artificial intelligence model? And to do this, we first look at whether cases where shareholders voted like ISS, the biggest proxy advisor, actually produces larger market reactions than cases where shareholders did not vote like ISS suggested. And what we find is that there is basically no difference. There might even be a small negative impact. So when shareholders vote like ISS suggests, it doesn't really have any market implication. And then we put our AI suggestion along with the ISS cases, and what we find is that our AI suggestions actually beats the proxy advisor every single time. So we are able, using AI, to actually find optimal voting strategies that are much better than what these proxy advisors do. We do the exact same for Glass Lewis, which is the second largest proxy advisory firm. And again, we look at cases where shareholders voted like Glass Lewis recommendation and cases where shareholders did not vote like Glass Lewis recommended. And we look at the difference, and we don't see any difference. While when we compare to our AI optimal vote, we actually see quite a large difference. Again, almost 2% here, different market reaction. We have other results in the paper that I don't have much time to present, but we can also show that even if we provide the recommendations of the proxy advisors to our AI model, it actually does not help the AI. So it's not only that the AI beats the proxy advisors, it's also that it doesn't even benefit from their recommendations. So we might think, well, these proxy advisors' recommendations, they might help AI. Maybe AI does not actually capture some elements because we are not feeding them all of the information. But we actually don't find that. We find that even when we provide the recommendations of the 2 largest proxy advisors to our AI model, it doesn't have any impact. And then we look at why would shareholders not vote optimally, because we find that they actually don't vote optimally in about 45% of the cases. And one of the hypotheses that we had is that we were thinking maybe they don't vote like optimally from a value maximizing perspective, but they are trying to target other goals such as sustainability, environmental policies, etc. We don't find that. What we find is a strong bias of shareholders voting pro-management and against shareholders' proposals. So shareholders are voted suboptimally because they are too supportive of management and not supportive enough of shareholder proposals. We do a lot of other robustness tests, but I'm not going to tell you about those today because I have very little time. So just to conclude, overall, we are able to train a machine learning model to find the optimal voting decisions, the one that would actually maximize the market reaction to a vote, so that we can actually know what would be the optimal vote. And we find that this AI model beats shareholders, beats proxy advisors, and does not even benefit from these proxy advisors' recommendation. Thank you.
Maxime, you're even more Swiss than me, so you have still some time left for questions.
Thank you for your sharing. I have two questions for you. The first question is, from your perspective, is there any challenges and difficulties for the shareholder will use this AI model to make the decision for voting? There any concern about accuracy, consistency, and even the cost? And second question is, in practical, is there any institutions or the companies will conduct or will use the AI model to help their shareholder make the decision for voting? Thank you.
So I think that there is one constraint, which is access to data. You need to buy the data. It means that, like, for a small shareholder, that would be actually quite difficult because all of these databases, they are quite costly. So it costs a lot of money. But if you're a very large institution, you are BlackRock, Vanguard, State Street, you can absolutely do that. And it's really easy. Honestly, it's not a really complex machine learning model. Here, this is a project where I'm working with people who are like AI engineers, and they know the topic very well, but you can hire an AI engineer and they can do that very easily. It's actually, I was surprised by how easy this is. So I don't think that there is any constraint, to be honest. Like, beside access to data, I think it's very easy. And I'm surprised that not more companies are actually, and also the proxy advisors are not using AI to make optimal voting decisions.
Yeah, actually, our company is conducting the AI analysis for the stock selecting or the sector selecting. Maybe we can talk more later.
Yeah, absolutely.
You should say it's very difficult and sell that service.
Oh boy. Thanks. So fantastic paper. I really like it. One question, you train it based on short-term reaction.
Yes.
And then you show that in the long term it does even better.
Yes.
But then why don't you train it on the long-term reaction? Right?
So,
because there is a little bit of a disconnect between it's based on short-term reaction, but then we wouldn't expect any long.
Absolutely. I think that makes sense. So this is something that we haven't done yet. So it's a very early stage project, but this is something that, like, we've got a couple of comments, as you're saying, where people say, well, if you also want to look at the long-term reaction, that might also be a good objective to actually to analyze whether the model can predict long-term reaction. I think this is something we can do. Absolutely.
So currently you just look at the abnormal return, or you also do trading, maybe say the more significant ones you put more weight on in your trading?
No, well, at the moment we just do like abnormal returns, but as you could see, like, we could even like classify them into portfolios where the most significant ones, like, we can observe that they would have like a better, like they have a higher market reaction. So we could actually do that too, yes. Yeah. I don't know if we have a microphone. I'll hand them over. Thank you.
Thank you for the presentation. We know that shareholders vote not only on the management proposal, but also on the shareholder proposal, and the shareholder proposals are not binding. in the sense that the firm may not actually implement. So do you find any difference in terms of the two types of proposals, like, and also the shareholders vote, I guess, on the same day on different proposals? So how do you really differentiate?
So, there are two questions here. The first one is about whether we have a difference between management and shareholder proposal. And yes, we do have that difference because we do find that actually shareholders in their vote tend to support management proposals way more than what our AI model would suggest, and tend to vote against shareholder proposals way more than what our model would suggest. So our model would say, well, be nicer to shareholder proposals and be a bit tougher on management proposal. So that's one thing that we find. And then the other question, I think it's very good about, well, sometimes you actually have several votes that can happen in the same day. So this is one of the reasons why we are also using this narrow margin, because with this narrow margin, we actually have very, very few cases where we have several proposals that fall within that narrow margin. Usually it's like one case, you have one proposal that is contentious and that is within the narrow margin. We don't have that many cases where we have like 5, 10 proposals that would fall within the narrow margin. So this is also one of the reasons why we are looking at this narrow margin around the voting, the majority thresholds. Yeah, go ahead, please. That's a super good question. Actually, I haven't tried it. So yeah. I absolutely. I think I should definitely try that. It's just like this is so recent that we actually don't have the data to do it right now. But I think that's something like next time when I present it, I should have that result. Absolutely. Yeah. All right. Thank you. Oh, yes. So just one thing. Before we start the panel session, I would just like to do a small group picture with all of the speakers of today's who are present right now. So we are going to do like a small picture, and at the same time, they can set up the stage for the panel. So if I could ask all of the speakers of today to come in front here, and we can have a small group picture while they set up the stage. Thank you.
Oh, no, they're going to introduce themselves.
I'm not surprised, honestly. It's Thank you, everyone. So now we are going to have our panel about greening, basically the fund industry, aligning with the green mandates and aligning capital with these sustainable goals. So for this panel, we are going to have 4 panelists. First, we are going to have Anthony Cheung, who is the head of sustainability at Polymer Capital, which is maybe the largest or one of the largest Hong Kong-based hedge funds. And then we are going to have Philippe Laurency, who is the CEO of Euroclear. Euroclear is basically the largest custodians for securities in the world. And so he is the CEO of the APAC region for Euroclear. Next, we will have Nana Lee, who is the head of sustainability at Impax Capital Management. And Impax is one of the largest mutual fund company in terms of impact investing and sustainability. And finally, we'll have Rizal Wijono, who is managing director at Syncicap Capital Asset Management, and who will tell us about how Syncicap, which is, well, a bit in between Hong Kong and Belgium, deals with these issues, especially because they actually have quite a lot to say about impact investing. So please welcome our panelists. Thank you. Oh, and of course, I should introduce our moderator, Professor Alan Kwan, who will moderate today's panel.
Great. Yeah, I guess let's get seated.
Awesome. I guess in order maybe of the icons. Well, yeah, I guess, yeah. So. Awesome, let's get started. So Max already did a really good job introducing everyone, so maybe we'll just head right into the panel discussion since we're sitting between lunch. Okay, so the first question, I think most of us know that our notion of ESG investing came out of initiatives that began mostly in Europe, adopted and espoused by European investors. And I guess Asia and the rest of the world sort of caught up since then. So why don't we begin by exploring the differences between ESG, CSR, sustainability in Europe versus Hong Kong and Asia more generally. I guess we have panelists with experience in both regions. So the general question is, what are the sort of differences in the approach, the appetite, the regulations? So this, for all panelists. Nana, why don't we start with you?
Thank you. Yeah, of course. So my coverage is mostly APAC, but we are a UK-oriented fund, now globally operated. So I can maybe speak from both sides. So I think, obviously, all of the regulations started in Europe. So many of the regulations still now are imported from Europe. And European is very good at importing regulations, making regulations. But I want to say that the reason why it could work was because the concept of fiduciary duty is very well embedded in the UK capital market, in the US and UK capital market. So you have this concept first, it's very structured. Then you have the regulations, and people are more willingly to work towards the regulations. However, in Asia, I think there is a little bit catching up from the regulators at the beginning. So there was a lot. At first, there was a lot like directly imported rules from the EU and the US. However, those have to be localized to different markets in Asia. So there was a process of local adjustments, I think, for the last maybe 4 or 5 years. And the concept of fiduciary also is, at the same time, is trying to import into some Asian markets. So some markets like Korea only amended its commercial code this year to say that company directors have the responsibility to all shareholders. Previously, it was to all directors, like to all the companies. So the benefit is to the company, not to shareholders. So that's kind of basic things. I think it's only just started to change. So yeah, so I think in Asia it's in parallel, and to have the rules, everything in effective implementation, I think you need to have the concept of fiduciary stewardship in bed first. Thank you.
Thank you very much. Good morning to all. What do we see as a difference? I think indeed Europe has started with a regulatory framework pretty difficult to comply with. So moving probably too fast from 0 to 100, which has scared a number of companies. Now we see clearly Asia is picking up in terms of issuance. I have a paper here because I don't get all the numbers by heart, but there is today about 5 trillion of securities that are quoted as sustainable or green. We have about 1.7 on our books. But if we look into the Asian shares, it has grown by 16% in the recent few years. In this year only, China has issued $70 billion of sustainable bonds, and it's more than 17% of the global issuance this year. Hong Kong is a leading hub. So we see clearly that Asia is picking up, probably with a more pragmatic regulatory framework than what Europe has built. But I think there is a perception maybe that Asia or China is not moving on those kind of initiatives and financing. But I'm very surprised when I used to go to Shanghai or Beijing a few years ago, you had this big fog. This has gone for most of the days. So clearly there has been a number of initiatives that have taken place that are sort of changing the dynamic.
I can only echo that. I think maybe just to clarify a little bit our position, a little bit of background of where I'm coming from. So Syncicap Asset Management is a asset management company on behalf of a French asset manager. We are the fourth largest asset manager in France, and we're backed up by an insurance asset management company. Now, as a firm, we have about 50 years of establishment and more than 25 years now of sustainable investment. Now, I think being based in France, France is widely regarded as the birthplace of ESG, and impact investment is not new to us. On the contrary, I think in many respects we are the front runner there because we have strategies linked to renewable energy. And if I say renewable energy, it's actually not wind and solar, because that's usually what people think about when they think about renewable energy. So we invest in things like biomethane, carbon capture, sustainable fuel, biogases, all these kinds of things, which is actually true impact investment. We also invest in ocean regeneration, right? And we also invest in agricultural rejuvenation. So you can see, we actually go way beyond what we think is or should be ESG investing. So with that as a context, I think what else Europe has to offer, I can only echo what my two panelists have mentioned. And I think Asia is catching up. Not only catching up, I think the learning curve is very steep, and it's become actually even steeper. Because in the 3 years that we've established an office here in Asia, the reverse inquiries that we're getting is just mounting enormously. We're getting, inquiries coming from governments, sovereign wealth funds to see what does Europe really have to offer in terms of these impact strategies, and what is it that they could potentially import going to Asia. Not that these investors are very interested in investing in renewable energy. I think for most of them, the actual interest really goes out to how do they bring these technologies to Asia, right? So I think that's a whole different concept rather than just embracing. So it's actually going, in my opinion, beyond ESG investing. And Asia, the learning curve is very steep, and it's coming not only from Hong Kong, but it's also coming from China, Korea. I've just recently gone to a trip to the Philippines where we had very interesting discussions. So it's really gone to that extent already.
And Ellen, if I may echo with one of the real-life example on stewardship code, which the Hong Kong U researchers has actually presented earlier on. We all know that globally, the very first set of stewardship code came from UK 2011, where the first one in Asia is from Japan 2015. Now, the interesting part is if you look at a few months ago, the Japanese government or the regulator actually came out with the third set of stewardship code. It's like the version 3. And having consultations on it. Now, the interesting part of it is you look at the version 1 to 2 to 3, you could actually tell the very fine differences from almost like a copy and paste to the recent version. They are actually making very fine adjustment based on the feedback of the Japanese fund managers. I mean, the difficulty when they are engaging with the Japanese company and circumstances where they were also, asked to, provide better disclosure. So I'm actually, I have to say that there are fine differences because like Asia is quite different across different jurisdictions, but you could see that from there are countries where are also driving to more local customization.
Awesome. That's great to hear. I guess not just caught up, but actually customizing or even exhibiting some thought leadership is the sense I get. So awesome. Okay, so the next question is about actually doing, not the next few sets of questions, but actually doing the investing. So the next question is about data quality. So one of the challenges, I guess, to ESG or impact investing or greening portfolios is just understanding what are the behaviors of companies. So then I guess the question is, do you feel like now in 2025, you have access to trustworthy data? And if there was one thing that you wish could improve about the ESG metrics, what would it be? So Philippe, why don't we start with you? Does Euroclear as a custodian actually use ESG? How do you guys use ESG data, and what do you see as the improvements to be made?
We've done a couple of things on ESG data, and you're right, and I think Maxime mentioned the big issue is the quality. The structure of the data, they're structured differently everywhere, so trying to use data that you can compare with one another is really a challenge. So we've done two things. We've invested into more fintech type company that is called Impact Cube. And Impact Cube basically is measuring and following all of the data from about 50,000 corporates in the world, and basically measuring those corporates against their 17 ESG criteria, if I'm not mistaken, so that you look at each criteria independently, or you can basically benchmark your own portfolio against a benchmark that they've done. So basically, we try to leverage the competence and the information that we have at a big scale with the information that the people with more technological capabilities could do. The other thing that we've done is that as a firm, we've committed to net zero by 2050. And we thought that, you know what, we have plenty of data, so we're going to be able to build products, data products, that would be very attractive to the investor community. So we started to do that. We started to try to monetize those data. And then to our big surprise, everybody wants the data, provided it excludes their data, and provided it's free. So we are in a sort of interesting scenario where there is, as it was mentioned by Professor Servas, there is the good intent, but then there is the economic reality of what you can or cannot do. But more needs to be done, certainly on the data set, and on the quality of data. And you could dream that with the DLT technology, for instance, which I think is a very strong technology to create golden source of data where everybody could leverage. But I think we're not there yet.
Nana, how is APAC data, actually, since you have an APAC focus?
Yeah, I think we're now in a very interesting time. So since I started doing this over 10 years ago, the first, I would say 5 years, the struggle is always we don't have the data. So there's a long time that it's like a black box. We don't really know what we're looking at, and it's very difficult to get access to companies. So you don't have the actual information, just like the last session before you would have to vote. You don't really know what you're voting on. There was time, like for example in Taiwan, there could be when you're trying to vote on some directors' nominations, the only thing you have is the name. So you have to guess everything from there. But now I think we are at a very different time, and now we have too much data. I think that's the issue. And for us, we are a long-term active investor and long only. So, and we started doing this in early 2000, so almost 25 years ago. When we started doing this, there was no any data provider or service provider on this. So we have to build everything in-house. So we have been building everything in-house and upgrading this, our own taxonomy, own ESG rating system, engagement portal and everything. So we still use that system. And we have a very thorough ESG now we call corporate resilience analysis system. Our PM, portfolio manager, and analysts, they all have to do the analysis themselves. So my team and myself is mostly for review their research, and also when there is ad hoc issues, when there's like some controversies, we can discuss. But mostly, so everything is in-house. We also subscribe to some major supplier like MSCI, Sustainalytics, etc. as reference, just because our system, so this rating we have, we update it once every 12 months. And these providers, they could update more frequently. So if there is some issues that we think is more up to date, then we can take into account when we are making investment decisions. But otherwise, we mostly rely on our own proprietary system. I imagine it could be very different for some passive investors because they have thousands of companies to cover. And I think there's a lot of debate, just like that session, on the what role the policy advisor should play and policy they should issue. So yeah, so I mean, we can go there, but I mean, for us as active investor, we don't have that kind of issue. Most of our policies are customized. Even if we use proxy system, we still customize our policy, and so that wouldn't affect our operations too much.
I see. So too much data and customizing it to your own needs now, and just sifting through it. That's really interesting. Anthony, at Polymer, at a hedge fund, what types of data do you guys use? And do you guys feel like there's any big data gaps?
Sure, thanks, Alan. So a lot of people, start asking that, so Polymer is actually a hedge fund, and why does hedge fund care about sustainability at all? And actually, I think I've got this very same questions like 5 years ago, and then still answering it. I think one of the reasons is the business model for alternative funds or hedge funds, right, has been evolved significantly over the years. And now, I mean, the more institutional one are to actually provide or generate more consistent, low volatility returns. And for us, sustainability is actually less about the likes of exclusion, but it's more about alpha generation. So think about like a big quant fund using, I mean, a lot of them using different quant data from global macro, etc. But instead of that, we also look into different E or S and G data. And one thing that a very interesting finding that we've got is that, like, obviously, you know, if you look at the drivers that would have that explain share price outperformance or underperformance across all this data, right? You have to do it on a country basis, on a sector basis. I mean, factors that would drive the performance of Samsung Electronics versus a shipbuilding company, which should be completely different. And it's also echoed the HKU research earlier of why I thought someone shared about that the ESG score doesn't really like the funds are not looking in impacting into that for a very good reason, because when we look at in each of the country on each sectors, the top 3 factors that is driving share price performance short term and long term has I mean the ESG score didn't happen to be ranked at the top 3. Okay, in every single factors and countries. So we more and more we are actually using system level data, which we find that a better explanation of alpha generations could be better sustainable supply chain management, could be executive link ESG compensation, could be on climate governance and stuff. And because of that, I actually felt that, you know, some of the data provided by Euroclear are actually very pioneering and very eye-opening, because it's beyond just purely grading and score. And that's why that's how we do it. And the other part of it would also to do with how we link engagement with proxy voting with share price performance, which is a very interesting research that we've just learned from Professor Massimi.
Awesome. How about you, Rizal? How do you guys use ESG data? What are sort of what's your approach, and what are the
I do definitely agree that there's an overflow of data. It's very hard to find, you know, what is reliable and what is not reliable. Yesterday, somebody made a joke about, you know, this 50 shades of green washing. You know, you have green batching, green hashing, or what have you, right? So now for us as a, what do you call it, as an insurance asset manager, data is extremely important for us, because insurance asset managers actually have 2 objectives, right? One is to ensure we protect capital of our investors. And secondly, is to find the assets that can match our very long dated maturities, right? So those are 2 extremely important guiding principles that we have. So if you look at those 2 principles, data is extremely important to ensure that we invest in the right companies. Now, I think what we do a little bit more, I think just like Impacts, we have our proprietary models. We have a whole army of, what do you call that, ESG specialists. But what we try to, where we try to be a little bit different is we do use AI as well. We try to sift through all the data with the AI models that we also try to develop internally. So yes, extremely important.
This is a little bit of a selfish question, but as an academic trying to figure out what to work on, what's we heard there's an overflow of data, but if there's one type of improvement to data that you wish academics could sort of help with, or if there's like one type of data you wish was out there but is missing, do you guys have any sorts of thoughts on that? It's a selfish question, so you know, but you know, lots of academics in the room. Are there any big data gaps you guys feel?
I'm going to give it a try. I'm not sure it's a data gap. I think it's more structure of data gap and location of data. So how can we bring the data together so that it becomes easier to analyze and to assess? Which is what we've tried to do with Impact Cube. In fact, is bringing all of the data into a single platform, and then you can run all of your models on that platform. You can ask the model to reallocate your portfolio according to specific criteria that you have, whether it's an E, an S, or a G. And so that's the beauty, I think, of centralization of data.
So one of the pain points that I've been struggling for years is that after our in-house research of identifying the drivers or issues that have that I've mentioned earlier, we actually want to have a more systematic reviews of Asia-Pacific companies in terms of their AGM and shareholders resolutions and proxy seasons, so that we could be very targeted in our engagement and voting. And we spoke to like every single bulge brackets, you name it, MS, GS, UBS, etc. And we asked the research team for help, and also that's the complexity about voting. It varies across each of the jurisdictions. So when we obviously, if you talk to the likes of the big proxy providers, they would give you all the information of the 70,000 proxy voting that you need in terms of recommendations, but they would never. It's very hard for them to customize to some of these specific drivers that we identified, and the same struggle persists today. I mean, the browse records still do not have a wonderful answer for this. I mean, they talk to each of the country specialists, and then they come back saying that, oh, maybe these three companies are doing this voting this year, and you may want to have a look. So still a big gap there.
Got it. Yeah. So I guess the answer I'm kind of hearing from everyone is that there's a lot of data, but then how you actually put it all together and then actually assess and add up the data seems to be the biggest challenge, and every company seems to have their own approach. Interesting. So, okay, so I guess we have one more question, because we had a third question, but you actually already answered. It's how hedge funds view sustainability. I guess the last question is just, what are effective strategies for greening portfolios? Like, what is the approach your firm takes? Is it exclusion, integration? How do you actually ensure that your investments are green? And what is the best way to do that? What are the things that you've learned along the way? So why don't we start on the other hand with Rizal? Why don't we hear from you?
I think from our point of view, there are two categories that we really need to look into, right? You have investments into listed securities and investments into unlisted securities, right? Because those are two very different approaches. If you look at investments into listed securities, I think, we mentioned a lot of topics have already been discussed, but I think it's the area of unlisted securities that presents a lot of opportunity, in our opinion, because this is impact investment. I think if you're looking at the core of how you want to create an ESG portfolio and how you invest sustainably, you need to go beyond that, right? With impact investment, you can. Now, what do you do with impact investments? I think core to impact investment methodologies is to set KPIs. KPIs that are set normally by the fund manager, but if you want to go beyond that, it can also be set by an external committee, right? That's not an easy discussion, because as a fund manager, having to abide to achieve targets set by an external committee, that's not easy. But it is being done. Now, we go a step beyond that. Rather than trying to achieve those targets set by an external committee, we basically say, look, if we don't achieve these targets, we give away 50% of our performance fees. So that's how we, and you asked a little bit about the academic community. And we're actually very proud to say that last year we've been handpicked by Harvard Business School, and we've basically been handpicked by them to basically showcase to their curriculum how nature blends with finance, right? So I think if you can build, metrics around this, I think it's important. I think that's also how you show to the investor how you embody the fiduciary responsibility that you have as an investor to provide shareholder value in true ESG articulated imperative objectives. I hope. Sorry for the long answer.
No, that's great. I mean, basically incentivizing the manager directly with the profit and setting KPIs is very clear. Yeah, that's really interesting.
Yeah, I mean, it's a good question, and our founder, who is also our CEO still, he has a phrase. He's always say, "Green is not black or white. So it's actually very difficult to define green. But in order to make, we don't say like green investments. So for impact asset management, we only do sustainable investments. So the whole firm is doing sustainable investment. We don't have like, we don't carve out like a part of our assets to just do this. The whole firm is doing this. So the first step of our investment strategy is to filter all the listed companies. So we only mostly invest in listed companies. Filter all the listed companies in the world through our taxonomy. So taxonomy is in-house built. We upgraded it about 3 years ago. So now we have maybe 6 categories. So energy, water, food, sustainable food, clean transportation, circular economy, and IT, so digital transformation. So we care about green, but we also care about sustainability. I think that is the broader concept of our investments. So we want to help different economies to transit better, and also want to get financial returns from the process. So that is the core of our philosophy. So in that process, it's difficult, I think, for every firm to build its own taxonomy, but I think you need to have a sort of like investment strategy and philosophy that is aligned with your goal. So which like different firms have different expertise. You can focus on nature, you can focus on energy, etc. But you have to find your expertise, and you have to be consistently implement that through your different strategies.
And then do you guys screen or engage, or like where do you guys fall on that spectrum? Do you guys exit if they don't score well, or do you like put it into your process and give them a boost? Or
Yeah, of course. So the taxonomy is the first step. Simply we have like 3 steps. So the first one is taxonomy. So we build a universe, we call, which is like a candidate pool of all the listed companies in the world that we could invest in. So it's about filter already like maybe 80% off. So the universe has about 2,000 companies globally. Then the second step is the ESG rating, which I mentioned about. So we have the in-house proprietary rating for different companies. When we think a company is up for selection, for the financial side, we will look at the model and everything, market return, interest rate, mostly backward looking. But then for ESG, the non-financial side, it's mostly forward-looking. So we look at the long-term and also look at the rating we have for the company internally. If the rating is not passed, then we just cannot invest. And the rating also transfer into a grade. Then the grade will decide how much we can actually invest in the company. If the company is like fairly graded, then no matter how bright the business prospect is from the financial side, we can only invest in certain cap in the portfolio. That's the second step. Then the third step is engagement. So we have also policy to engage with our companies once every 12 months, and everything is recorded, everything is reported to our clients regularly. So everything, like in Asia especially, the voting rights shareholders have, especially foreign shareholders have, is still very limited. So a lot of things you need to get through engagement, and you need to pass your message basically through the engagement, direct dialogue with the companies. So that part is also very important.
What do you see as the main, sorry, at Euroclear, what do you guys see as the main sort of way that, because you guys see the positions of lots of different investors, what sort of your takeaway from the approach that you've seen investors take, and sort of, do you have any recommendations for other investors?
I think the first thing we will do is not give recommendation, because we're not there to give to give advice, and the asset manager are usually much better equipped to make those investments. What we need to do is to sort of support their different trading strategies that they might have by bringing different tools. How we do impact to some extent is by our behavior. We have KPIs, so we need to reduce carbon emission impact. We manage our own pension plan for employees. There we give very clear guidelines to the external managers as to the expectation that we have from an impact point of view. We look at our suppliers, and we expect suppliers to take actions, and we ask them to have sustainability reporting and certainly action plan. Now, in some cases, you say, do you exit that supplier? In some cases, it's difficult to exit a supplier because you don't have many options. So that's the way we will look at it. But for us, from a customer point of view, from an investment, we have about $3 trillion or euros of funds on the platform. And we need to make sure that we provide all of the tools for the customers to do what they need to do. We do try to include the ESG dimension into our proxy voting service.
Yeah, and then I guess we've heard a little bit already that you guys integrate ESG, but at Polymer, do you guys think of it more as something, would you guys avoid companies that have really bad scores, or will you guys actually buy them and try to shape them, or like what's your sort of thought on exclusions?
Sure.
Yeah.
Thanks, Alan. So before I joined Polymer, I actually had up. I'm doing similar role, but for the long-only fund, and it was in the old days that I lived with all the exclusions criteria, and I have to say that exclusions sometimes might be from an academic standpoint, we have got a more restricted universe and also a restricted alpha generations, right? But I think that's also beyond that. It's also limits your capability for engagement. So there was Climate Action 100 Plus, which is one of the global initiative. I still remember one of the first engagement meeting when we, as a group of investors, collectively engaged with an Indonesian mining machinery company. Right, and we were flattered. They were setting 3 board directors joining us in addition to the CFO. Usually, it's like the head of finance or head of IR, right? And then we were also unexpected by the fact that we were lectured in the first place. Okay, and basically, I think the CFO basically print out the shareholder register and say that, like one of these guys have an exclusion policy in coal and mining machinery, and then literally implying that why are you in this room? Okay, so until the point that I jump in and saying that, oh, by the way, we are hedge funds, so we could go long and we could also go short. And then the dialogues continue. So we felt that sometimes, instead of a more purely policing approach, is the engagement side, especially in the context of Asia, has also to do with the cultural side of it, which they always love to have it like behind the scene. But at the same time, the activist approach sometimes could be seen as a very like treated with hostility. So we believe in collaborative engagement. The way that we try to make that more effective is by 2 little gadgets. The first one we call it like an engagement cycle. So we've got 5 steps doing it. And then you think about one cycle for 5 steps, it's like 1 year. So in a fiscal year standpoint, we want to engage with all these 5 steps. And we also measure what we met before we meet with the company. We do the homework and we measure some of the most material metrics that they have been performing. Could be the supply risk or other factors. But we felt that it's both important to financial materiality and impact materiality. And then we engage them. And then every year we draw up the same Excel like again. And then we try to, from the dialogue, we want to understand how they are making progress on that one. And over the last 3 years, we actually felt that that's a very effective way of doing it. And so.
Yeah, that's really interesting. I guess in the academic literature, we typically sort of have this tension. Do you exit at sort of to discipline or something versus engage, which feels very hostile? But then I guess in Asia, for cultural reasons or others, then I guess more collaborative approach. That's actually really interesting. I've never heard that before, so that's really cool. Yeah, so I guess that was my last question. I guess maybe, do we have any more questions from the audience? Yeah.
Quick question, just from a philosophical standpoint, where do each of you see nuclear generation, nuclear power, in terms of environment? Is that green or not green, or how do you see it?
Yeah, of course, there is almost a 180-degree change of the attitude toward nuclear in Europe in the last few years. For us, the 2 things about nuclear is it takes time to develop. So if you didn't develop like 10 years ago, then maybe we're talking about 10 years later to actually have a scale to generate electricity for your public. The other thing is it is safe and it's carbon free. So I think we always neutral, I think, to nuclear. And in fact, we did a small upgrade to our taxonomy just this year to say that nuclear is okay for us to invest in. So there is not so many targets before. So we didn't really exclude nuclear, but there was just no targets for us. I think now there are more companies looking at this. So we are also looking at more targets on this. Yeah.
I've got to be very careful on this because I'm also I sit as a trustee on Friends of the Earth, okay, a green group. But speaking from an investor standpoint, because when I was an analyst, I actually specialized in industrials and capital goods. So and looking at these companies over the years, there are actually a few things that I felt is kind of the missing puzzle from the general public. Okay, the whole world's hostility towards nuclear is from Fukushima. Okay, and a lot of yeah, and Nobel, okay, and Chernobyl, and the problem for this is that a lot of people fail to understand the development of the nuclear technology. A lot of for the whole like if we look at all the accidents globally these days, they are one thing that are very similar is they are all happens with the first generations of nuclear technology. Now we are at the fourth gen. Okay, the closest nuclear power plant, which is close to Hong Kong Diablé, supplying 1/3 of the electricity in Hong Kong, is the second generations Framatome Alstom technology, I think, since 1990s. So if you look at the lifespan of these first generations nuclear power assets, the expected life expectancy is like 50 years. So when all these happens, I mean, when these things happens, you know, those nuclear power plant in the first generation are supposed to be decommissioned, okay? But there has been a delay in that, and they've already exceeded their lifespan. So I've always argued that the problem is not nuclear itself, but mismanagement of nuclear power. So I think we have to make that clear. And if you look at the second gen, third gen, and because I've also speak to a lot of the capital goods company, you'll be seeing that there are actually well, I won't say over-engineer, but they actually keep it very tight in terms of the technical side to make sure that it's so-called extra safe. The biggest bottleneck, however, is actually human capital. So if you think about, I mean, one of the reasons why that China is actually very big and on nuclear, etc., is because they are literally the only country on the planet that have unstopped track record of nuclear builds in the last 20 years. Whereas if you think about it, right, 20 years is like one generation of nuclear engineers. So that is why we are seeing a lot of, well, in fact, one of the PMs that I was talking the other day, he managed our US portfolios and look at all those cyclicals, right? And we actually jokes about, you know, some of the US utilities company that where the CEO would usually get into trouble when they announce a big nuclear project. Why? Because there'll be budget overruns and then missing of earnings, and then, you know, that's what happens to the US C-suites, right? So we felt that it's actually the talent part that needs to be bridged, and it's not the technology itself that is the major issue.
Can I say something too? We looked at nuclear energy about 10 years ago, but we chose not to invest in nuclear energy, and we opted for biomethane instead. And to explain you why we chose for biomethane, I need to also explain maybe a little bit about how that works, because biomethane, if you look at the core of that, it's a real waste to energy kind of technology, right? I think you probably understand. So if you look at, we've launched about 3 funds, and 75% of these funds are actually invested in biomethane. Because biomethane, at the core of it, is about waste, right? It's collecting organic waste, mostly from farmers, right? Getting it through this methanization process, extracting gases and turning those gases into energy, electricity. So it's a whole circular economy. Whatever we give back to the farmers, it's fertilizer, right? That's the waste of the waste. So you can imagine, you know, this has been quite, this has been stellar in terms of demand in Europe, right? And the development cost, admittedly, of nuclear energy is still lower than biomethane, but biomethane at the same time is dropping in terms of development cost, as well as, you know, the push, the demand push, both from regulatory as well as the private side, is actually increasing. Now comes Asia. You know, guess where all the waste is being produced? Well, not all, but a lot of the waste, right? So there's a lot of circular economy benefits that we would like to bring into Asia, and I think there's always this debate about nuclear energy and biomethane or other more expensive forms of renewable energy, and I think time will tell, right? But there is still obviously the perceived risk of radioactivity, the use of uranium, everything else, right? And the dependency on it. Whereas on the other side, you know, the cost is a little bit higher, but, you know, there are also a lot of added benefits to that alternative.
Don't have much to say on the topic, but one think to add maybe is all of the debate, we need to step back a little bit because what was perceived as bad 20 years ago might not be bad today. And as an industry, we really need to reassess on a constant basis where we want to go and why we want to do it. We see the different conflicts around the world. There are some shares that were banned. Now everybody goes into those. You have those defense ETF and the like because Europe has to rebuild its defense. And we see that many other countries will probably spend money there. So I think it's really important that we are agile and that we do not stop on the ideology view that nuclear is bad. Nuclear maybe was bad because there was a number of accidents. The technology as such is not bad if we manage it properly, as you mentioned. So I think that we are maybe sometimes a bit too slow in adapting our thinking process, given the speed at which the technology evolves, at which the environment evolves, and that's something for me that we have to spend a bit more time on.
I guess we have time for one more question. Although I guess everyone's hungry, right? So, should we just call it a wrap? Okay. Well, awesome. Thank you so much to our panelists for an interesting discussion. I'm gonna steal some of these quotes.
All right, thank you very much for this very interesting panel. So now we are going to have lunch. So lunch is actually in this building. So you need to take the elevator to the third floor. And in the third floor, you will have people guiding you to the restaurant where we will have lunch, which is called The Square. But you can just like follow people guiding you. So third floor, same building, no need to go out. One thing for people who eat vegetarian, there is like, or vegan, there is one table that is specific with like vegetarian and vegan food. Thank you.
I wanted to ask, but I didn't want to interrupt lunch. But so let me ask you, right? There is now quite growing evidence of a carbon risk drinks, right?
Yeah, no, so ChatGPT said
Nice to meet you.
Yeah. No, I think the short recaps are good because like for me, what is the takeaway? Hopefully it's aligned with what they say. But then, yeah, I think
That slowly, just to see what that does. When you say it, you feel like, wow, it's just so bad. Yeah, I've always good at we have the office. Oh, okay. Are you French? I'm French. It's a Belgium. But I'm only language. So you're next. Sorry. Oh, you're president. As a company, but a partner as well. We have to work well together. It's just like undifference. Chase 那个麦克风也要拿回去唱充电一下哦。OK OK。
In an age where AI can write, code, analyze, and even imitate human judgment, the traditional role of the university has already been profoundly disrupted. Universities must now be reimagined, not as factories of knowledge, but as spaces to cultivate what machines can't: values, vision, and the essence of human judgment. At the Bachelor of Global Leadership, Innovation, and Society, we focus on what machines cannot replicate: cultivating critical thinking, creativity, judgment, empathy, and leadership. We challenge you with complex, real-world issues so you can forge your own way of thinking. Our classroom begins not with a textbook, but with a real-world challenge.
Your introductory courses are taught by senior professors, pioneers in their fields, alongside accomplished industry experts who serve as faculty in residence. Your academic journey is truly personalized and experiential.
We admit only 30 to 40 students each year, so every student gets individual attention. You will participate in year-long global immersion modules, and at the end of your second year, you will choose a specialization track in technology, business, or society to discover your own leadership path.
Career support and leadership development are our top priorities. You will practice innovation through internships, build a portfolio of work, and learn to try, fail, learn, and succeed, building the resilience that the uncertain future values most.
We're not just looking for top students. We're looking for builders, challengers, and thinkers. We seek the most ambitious and creative students worldwide, and we value depth and true passion. Our admission is need blind. Your ability to pay will not affect your acceptance. Join us and leave the world better than you found it. In an age where AI can write, code, analyze, and even imitate human judgment, the traditional role of the university has already been profoundly disrupted. Universities must now be reimagined, not as factories of knowledge, but as spaces to cultivate what machines can't: values, vision, and the essence of human judgment. At the Bachelor of Global Leadership, Innovation, and Society, we focus on what machines cannot replicate: cultivating critical thinking, creativity, judgment, empathy, and leadership. We challenge you with complex, real-world issues so you can forge your own way of thinking. Our classroom begins not with a textbook, but with a real-world challenge.
Your introductory courses are taught by senior professors, pioneers in their fields, alongside accomplished industry experts who serve as faculty in residence. Your academic journey is truly personalized and experiential.
We admit only 30 to 40 students each year, so every student gets individual attention. You will participate in year-long global immersion modules, and at the end of your second year, you will choose a specialization track in technology, business, or society to discover your own leadership path.
Career support and leadership development are our top priorities. You will practice innovation through internships, build a portfolio of work, and learn to try, fail, learn, and succeed, building the resilience that the uncertain future values most.
We're
not just looking for top students. We're looking for builders, challengers, and thinkers. We seek the most ambitious and creative students worldwide, and we value depth and true passion. Our admission is need blind. Your ability to pay will not affect your acceptance. Join us and leave the world better than you found it. In an age where AI can write, code, analyze, and even imitate human judgment, the traditional role of the university has already been profoundly disrupted. Universities must now be reimagined, not as factories of knowledge, but as spaces to cultivate what machines can't: values, vision, and the essence of human judgment. At the Bachelor of Global Leadership, Innovation, and Society, we focus on what machines cannot replicate: cultivating critical thinking, creativity, judgment, empathy, and leadership. We challenge you with complex, real-world issues so you can forge your own way of thinking. Our classroom begins not with a textbook, but with a real-world challenge.
Your introductory courses are taught by senior professors, pioneers in their fields, alongside accomplished industry experts who serve as faculty in residence. Your academic journey is truly personalized and experiential.
We admit only 30 to 40 students each year, so every student gets individual attention. You will participate in year-long global immersion modules, and at the end of your second year, you will choose a specialization track in technology, business, or society to discover your own leadership path.
Career support and leadership development are our top priorities. You will practice innovation through internships, build a portfolio of work, and learn to try, fail, learn, and succeed, building the resilience that the uncertain future values most.
We're not just looking for top students. We're looking for builders, challengers, and thinkers. We seek the most ambitious and creative students worldwide, and we value depth and true passion. Our admission is need blind. Your ability to pay will not affect your acceptance. Join us and leave the world better than you found it. In an age where AI can write, code, analyze, and even imitate human judgment, the traditional role of the university has already been profoundly disrupted. Universities must now be reimagined, not as factories of knowledge, but as spaces to cultivate what machines can't: values, vision, and the essence of human judgment. At the Bachelor of Global Leadership, Innovation, and Society, we focus on what machines cannot replicate: cultivating critical thinking, creativity, judgment, empathy, and leadership. We challenge you with complex, real-world issues so you can forge your own way of thinking. Our classroom begins not with a textbook, but with a real-world challenge.
Your introductory courses are taught by senior professors, pioneers in their fields, alongside accomplished industry experts who serve as faculty in residence. Your academic journey is truly personalized and experiential.
We admit only 30 to 40 students each year, so every student gets individual attention. You will participate in year-long global immersion modules, and at the end of your second year, you will choose a specialization track in technology, business, or society to discover your own leadership path.
Career support and leadership development are our top priorities. You will practice innovation through internships, build a portfolio of work, and learn to try, fail, learn, and succeed, building the resilience that the uncertain future values most.
We're not just looking for top students. We're looking for builders, challengers, and thinkers. We seek the most ambitious and creative students worldwide, and we value depth and true passion. Our admission is need-blind. Your ability to pay will not affect your acceptance. Join us and leave the world better than you found it. In an age where AI can write, code, analyze, and even imitate human judgment, the traditional role of the university has already been profoundly disrupted. Universities must now be reimagined, not as factories of knowledge, but as spaces to cultivate what machines can't: values, vision, and the essence of human judgment. At the Bachelor of Global Leadership, Innovation, and Society, we focus on what machines cannot replicate: cultivating critical thinking, creativity, judgment, empathy, and leadership. We challenge you with complex, real-world issues so you can forge your own way of thinking. Our classroom begins not with a textbook, but with a real-world challenge.
Your introductory courses are taught by senior professors, pioneers in their fields, alongside accomplished industry experts who serve as faculty in residence. Your academic journey is truly personalized and experiential.
We admit only 30 to 40 students each year, so every student gets individual attention. You will participate in year-long global immersion modules, and at the end of your second year, you will choose a specialization track in technology, business, or society to discover your own leadership path.
Career support and leadership development are our top priorities. You will practice innovation through internships, build a portfolio of work, and learn to try, fail, learn, and succeed, building the resilience that the uncertain future values most.
We're not just looking for top students. We're looking for builders, challengers, and thinkers. We seek the most ambitious and creative students worldwide, and we value depth and true passion. Our admission is need-blind. Your ability to pay will not affect your acceptance. Join us and leave the world better than you found it. In an age where AI can write, code, analyze, and even imitate human judgment, the traditional role of the university has already been profoundly disrupted. Universities must now be reimagined, not as factories of knowledge, but as spaces to cultivate what machines can't: values, vision, and the essence of human judgment. At the Bachelor of Global Leadership, Innovation, and Society, we focus on what machines cannot replicate: cultivating critical thinking, creativity, judgment, empathy, and leadership. We challenge you with complex, real-world issues so you can forge your own way of thinking. Our classroom begins not with a textbook, but with a real-world challenge.
Your introductory courses are taught by senior professors, pioneers in their fields, alongside accomplished industry experts who serve as faculty in residence. Your academic journey is truly personalized and experiential.
We admit only 30 to 40 students each year, so every student gets individual attention. You will participate in year-long global immersion modules, and at the end of your second year, you will choose a specialization track in technology, business, or society to discover your own leadership path.
Career support and leadership development are our top priorities. You will practice innovation through internships, build a portfolio of work, and learn to try, fail, learn, and succeed, building the resilience that the uncertain future values most.
We're not just looking for top students. We're looking for builders, challengers, and thinkers. We seek the most ambitious and creative students worldwide, and we value depth and true passion. Our admission is need-blind. Your ability to pay will not affect your acceptance. Join us and leave the world better than you found it. In an age where AI can write, code, analyze, and even imitate human judgment, the traditional role of the university has already been profoundly disrupted. Universities must now be reimagined, not as factories of knowledge, but as spaces to cultivate what machines can't: values, vision, and the essence of human judgment. At the Bachelor of Global Leadership, Innovation, and Society, we focus on what machines cannot replicate: cultivating critical thinking, creativity, judgment, empathy, and leadership. We challenge you with complex, real-world issues so you can forge your own way of thinking. Our classroom begins not with a textbook, but with a real-world challenge.
Your introductory courses are taught by senior professors, pioneers in their fields, alongside accomplished industry experts who serve as faculty in residence. Your academic journey is truly personalized and experiential.
We admit only 30 to 40 students each year, so every student gets individual attention. You will participate in year-long global immersion modules, and at the end of your second year, you will choose a specialization track in technology, business, or society to discover your own leadership path.
Career support and leadership development are our top priorities. You will practice innovation through internships, build a portfolio of work, and learn to try, fail, learn, and succeed, building the resilience that the uncertain future values most.
We're not just looking for top students. We're looking for builders, challengers, and thinkers. We seek the most ambitious and creative students worldwide, and we value depth and true passion. Our admission is need-blind. Your ability to pay will not affect your acceptance. Join us and leave the world better than you found it. In an age where AI can write, code, analyze, and even imitate human judgment, the traditional role of the university has already been profoundly disrupted. Universities must now be reimagined, not as factories of knowledge, but as spaces to cultivate what machines can't: values, vision, and the essence of human judgment. At the Bachelor of Global Leadership, Innovation, and Society, we focus on what machines cannot replicate: cultivating critical thinking, creativity, judgment, empathy, and leadership. We challenge you with complex, real-world issues so you can forge your own way of thinking. Our classroom begins not with a textbook, but with a real-world challenge.
Your introductory courses are taught by senior professors, pioneers in their fields, alongside accomplished industry experts who serve as faculty in residence. Your academic journey is truly personalized and experiential.
We admit only 30 to 40 students each year, so every student gets individual attention. You will participate in year-long global immersion modules, and at the end of your second year, you will choose a specialization track in technology, business, or society to discover your own leadership path.
Career support and leadership development are our top priorities. You will practice innovation through internships, build a portfolio of work, and learn to try, fail, learn, and succeed, building the resilience that the uncertain future values most.
We're not just looking for top students. We're looking for builders, challengers, and thinkers. We seek the most ambitious and creative students worldwide, and we value depth and true passion. Our admission is need-blind. Your ability to pay will not affect your acceptance. Join us and leave the world better than you found it. In an age where AI can write, code, analyze, and even imitate human judgment, the traditional role of the university has already been profoundly disrupted. Universities must now be reimagined, not as factories of knowledge, but as spaces to cultivate what machines can't: values, vision, and the essence of human judgment. At the Bachelor of Global Leadership, Innovation, and Society, we focus on what machines cannot replicate: cultivating critical thinking, creativity, judgment, empathy, and leadership. We challenge you with complex, real-world issues so you can forge your own way of thinking. Our classroom begins not with a textbook, but with a real-world challenge.
Your introductory courses are taught by senior professors, pioneers in their fields, alongside accomplished industry experts who serve as faculty in residence. Your academic journey is truly personalized and experiential.
We admit only 30 to 40 students each year, so every student gets individual attention. You will participate in year-long global immersion modules, and at the end of your second year, you will choose a specialization track in technology, business, or society to discover your own leadership path.
Career support and leadership development are our top priorities. You will practice innovation through internships, build a portfolio of work, and learn to try, fail, learn, and succeed, building the resilience that the uncertain future values most.
We're not just looking for top students. We're looking for builders, challengers, and thinkers. We seek the most ambitious and creative students worldwide, and we value depth and true passion. Our admission is need-blind. Your ability to pay will not affect your acceptance. Join us and leave the world better than you found it. In an age age where AI can write, code, analyze, and even imitate human judgment, the traditional role of the university has already been profoundly disrupted. Universities must now be reimagined, not as factories of knowledge, but as spaces to cultivate what machines can't: values, vision, and the essence of human judgment. At the Bachelor of Global Leadership, Innovation, and Society, we focus on what machines cannot replicate: cultivating critical thinking, creativity, judgment, empathy, and leadership. We challenge you with complex, real-world issues so you can forge your own way of thinking. Our classroom begins not with a textbook, but with a real-world challenge.
Your introductory courses are taught by senior professors, pioneers in their fields, alongside accomplished industry experts who serve as faculty in residence. Your academic journey is truly personalized and experiential.
We admit only 30 to 40 students each year, so every student gets individual attention. You will participate in year-long global immersion modules, and at the end of your second year, you will choose a specialization track in technology, business, or society to discover your own leadership path.
Career support and leadership development are our top priorities. You will practice innovation through internships, build a portfolio of work, and learn to try, fail, learn, and succeed, building the resilience that the uncertain future values most.
We're not just looking for top students. We're looking for builders, challengers, and thinkers. We seek the most ambitious and creative students worldwide, and we value depth and true passion. Our admission is need blind. Your ability to pay will not affect your acceptance. Join us and leave the world better than you found it. In an age where AI can write, code, analyze, and even imitate human judgment, the traditional role of the university has already been profoundly disrupted. Universities must now be reimagined, not as factories of knowledge, but as spaces to cultivate what machines can't: values, vision, and the essence of human judgment. At the Bachelor of Global Leadership, Innovation, and Society, we focus on what machines cannot replicate: cultivating critical thinking, creativity, judgment, empathy, and leadership. We challenge you with complex, real-world issues so you can forge your own way of thinking. Our classroom begins not with a textbook, but with a real-world challenge.
Your introductory courses are taught by senior professors, pioneers in their fields, alongside accomplished industry experts who serve as faculty in residence. Your academic journey is truly personalized and experiential.
We admit only 30 to 40 students each year, so every student gets individual attention. You will participate in year-long global immersion modules, and at the end of your second year, you will choose a specialization track in technology, business, or society to discover your own leadership path.
Career support and leadership development are our top priorities. You will practice innovation through internships, build a portfolio of work, and learn to try, fail, learn, and succeed, building the resilience that the uncertain future values most.
We're not just looking for top students. We're looking for builders, challengers, and thinkers. We seek the most ambitious and creative students worldwide, and we value depth and true passion. Our admission is need blind. Your ability to pay will not affect your acceptance. Join us and leave the world better than you found it. In an age where AI can write, code, analyze, and even imitate human judgment, the traditional role of the university has already been profoundly disrupted. Universities must now be reimagined, not as factories of knowledge, but as spaces to cultivate what machines can't: values, vision, and the essence of human judgment. At the Bachelor of Global Leadership, Innovation, and Society, we focus on what machines cannot replicate: cultivating critical thinking, creativity, judgment, empathy, and leadership. We challenge you with complex, real-world issues so you can forge your own way of thinking. Our classroom begins not with a textbook, but with a real-world challenge.
Your introductory courses are taught by senior professors, pioneers in their fields, alongside accomplished industry experts who serve as faculty in residence. Your academic journey is truly personalized and experiential.
We admit only 30 to 40 students each year, so every student gets individual attention. You will participate in year-long global immersion modules, and at the end of your second year, you will choose a specialization track in technology, business, or society to discover your own leadership path.
Career support and leadership development are our top priorities. You will practice innovation through internships, build a portfolio of work, and learn to try, fail, learn, and succeed, building the resilience that the uncertain future values most.
We're not just looking for top students. We're looking for builders, challengers, and thinkers. We seek the most ambitious and creative students worldwide, and we value depth and true passion. Our admission is need blind. Your ability to pay will not affect your acceptance. Join us and leave the world better than you found it. In an age where AI can write, code, analyze, and even imitate human judgment, the traditional role of the university has already been profoundly disrupted. Universities must now be reimagined, not as factories of knowledge, but as spaces to cultivate what machines can't: values, vision, and the essence of human judgment. At the Bachelor of Global Leadership, Innovation, and Society, we focus on what machines cannot replicate: cultivating critical thinking, creativity, judgment, empathy, and leadership. We challenge you with complex, real-world issues so you can forge your own way of thinking. Our classroom begins not with a textbook, but with a real-world challenge.
Your introductory courses are taught by senior professors, pioneers in their fields, alongside accomplished industry experts who serve as faculty in residence. Your academic journey is truly personalized and experiential.
We admit only 30 to 40 students each year, so every student gets individual attention. You will participate in year-long global immersion modules, and at the end of your second year, you will choose a specialization track in technology, business, or society to discover your own leadership path.
Career support and leadership development are our top priorities. You will practice innovation through internships, build a portfolio of work, and learn to try, fail, learn, and succeed, building the resilience that the uncertain future values most.
We're not just looking for top students. We're looking for builders, challengers, and thinkers. We seek the most ambitious and creative students worldwide, and we value depth and true passion. Our admission is need blind. Your ability to pay will not affect your acceptance. Join us and leave the world better than you found it. In an age where AI can write, code, analyze, and even imitate human judgment, the traditional role of the university has already been profoundly disrupted. Universities must now be reimagined, not as factories of knowledge, but as spaces to cultivate what machines can't: values, vision, and the essence of human judgment. At the Bachelor of Global Leadership, Innovation, and Society, we focus on what machines cannot replicate: cultivating critical thinking, creativity, judgment, empathy, and leadership. We challenge you with complex, real-world issues so you can forge your own way of thinking. Our classroom begins not with a textbook, but with a real-world challenge.
Your introductory courses are taught by senior professors, pioneers in their fields, alongside accomplished industry experts who serve as faculty in residence. Your academic journey is truly personalized and experiential.
We admit only 30 to 40 students each year, so every student gets individual attention. You will participate in year-long global immersion modules, and at the end of your second year, you will choose a specialization track in technology, business, or society to discover your own leadership path.
Career support and leadership development are our top priorities. You will practice innovation through internships, build a portfolio of work, and learn to try, fail, learn, and succeed, building the resilience that the uncertain future values most.
We're not just looking for top students. We're looking for builders, challengers, and thinkers. We seek the most ambitious and creative students worldwide, and we value depth and true passion. Our admission is need blind. Your ability to pay will not affect your acceptance. Join us and leave the world better than you found it. In an age where AI can write, code, analyze, and even imitate human judgment, the traditional role of the university has already been profoundly disrupted. Universities must now be reimagined, not as factories of knowledge, but as spaces to cultivate what machines can't: values, vision, and the essence of human judgment. At the Bachelor of Global Leadership, Innovation, and Society, we focus on what machines cannot replicate: cultivating critical thinking, creativity, judgment, empathy, and leadership. We challenge you with complex, real-world issues so you can forge your own way of thinking. Our classroom begins not with a textbook, but with a real-world challenge.
Your introductory courses are taught by senior professors, pioneers in their fields, alongside accomplished industry experts who serve as faculty in residence. Your academic journey is truly personalized and experiential.
We admit only 30 to 40 students each year, so every student gets individual attention. You will participate in year-long global immersion modules, and at the end of your second year, you will choose a specialization track in technology, business, or society to discover your own leadership path.
Career support and leadership development are our top priorities. You will practice innovation through internships, build a portfolio of work, and learn to try, fail, learn, and succeed, building the resilience that the uncertain future values most.
We're not just looking for top students. We're looking for builders, challengers, and thinkers. We seek the most ambitious and creative students worldwide, and we value depth and true passion. Our admission is need blind. Your ability to pay will not affect your acceptance. Join us and leave the world better than you found it. In an age where AI can write, code, analyze, and even imitate human judgment, the traditional role of the university has already been profoundly disrupted. Universities must now be reimagined, not as factories of knowledge, but as spaces to cultivate what machines can't: values, vision, and the essence of human judgment. At the Bachelor of Global Leadership, Innovation, and Society, we focus on what machines cannot replicate: cultivating critical thinking, creativity, judgment, empathy, and leadership. We challenge you with complex, real-world issues so you can forge your own way of thinking. Our classroom begins not with a textbook, but with a real-world challenge.
Your introductory courses are taught by senior professors, pioneers in their fields, alongside accomplished industry experts who serve as faculty in residence. Your academic journey is truly personalized and experiential.
We admit only 30 to 40 students each year, so every student gets individual attention. You will participate in year-long global immersion modules, and at the end of your second year, you will choose a specialization track in technology, business, or society to discover your own leadership path.
Career support and leadership development are our top priorities. You will practice innovation through internships, build a portfolio of work, and learn to try, fail, learn, and succeed, building the resilience that the uncertain future values most.
We're not just looking for top students. We're looking for builders, challengers, and thinkers. We seek the most ambitious and creative students worldwide, and we value depth and true passion. Our admission is need blind. Your ability to pay will not affect your acceptance. Join us and leave the world better than you found it. In an age where AI can write, code, analyze, and even imitate human judgment, the traditional role of the university has already been profoundly disrupted. Universities must now be reimagined, not as factories of knowledge, but as spaces to cultivate what machines can't: values, vision, and the essence of human judgment. At the Bachelor of Global Leadership, Innovation, and Society, we focus on what machines cannot replicate: cultivating critical thinking, creativity, judgment, empathy, and leadership. We challenge you with complex, real-world issues so you can forge your own way of thinking. Our classroom begins not with a textbook, but with a real-world challenge.
Your introductory courses are taught by senior professors, pioneers in their fields, alongside accomplished industry experts who serve as faculty in residence. Your academic journey is truly personalized and experiential.
We admit only 30 to 40 students each year, so every student gets individual attention. You will participate in year-long global immersion modules, and at the end of your second year, you will choose a specialization track in technology, business, or society to discover your own leadership path.
Career support and leadership development are our top priorities. You will practice innovation through internships, build a portfolio of work, and learn to try, fail, learn, and succeed, building the resilience that the uncertain future values most.
We're not just looking for top students. We're looking for builders, challengers, and thinkers. We seek the most ambitious and creative students worldwide, and we value depth and true passion. Our admission is need-blind. Your ability to pay will not affect your acceptance. Join us and leave the world better than you found it. In an age where AI can write, code, analyze, and even imitate human judgment, the traditional role of the university has already been profoundly disrupted. Universities must now be reimagined, not as factories of knowledge, but as spaces to cultivate what machines can't: values, vision, and the essence of human judgment. At the Bachelor of Global Leadership, Innovation, and Society, we focus on what machines cannot replicate: cultivating critical thinking, creativity, judgment, empathy, and leadership. We challenge you with complex, real-world issues so you can forge your own way of thinking. Our classroom begins not with a textbook, but with a real-world challenge.
Your introductory courses are taught by senior professors, pioneers in their fields, alongside accomplished industry experts who serve as faculty in residence. Your academic journey is truly personalized and experiential.
We admit only 30 to 40 students each year, so every student gets individual attention. You will participate in year-long global immersion modules, and at the end of your second year, you will choose a specialization track in technology, business, or society to discover your own leadership path.
Career support and leadership development are our top priorities. You will practice innovation through internships, build a portfolio of work, and learn to try, fail, learn, and succeed, building the resilience that the uncertain future values most.
We're not just looking for top students. We're looking for builders, challengers, and thinkers. We seek the most ambitious and creative students worldwide, and we value depth and true passion. Our admission is need-blind. Your ability to pay will not affect your acceptance. Join us and leave the world better than you found it.
All right, we are about to start, so I'm going to ask you to please be seated. We'll start in about 2 minutes. Thank you. Oh, thanks. All right. So I'm very happy to have our keynote speech today with Niraj Nanda. Niraj is the Chief Commercial Officer of Anglo-Eastern, and where he leads the company's commercial strategy, sales marketing, and also external communication and ESG reporting as part of the executive team. With nearly 3 decades at Anglo-Eastern, Niraj has a deep understanding of the organization and the industry. Niraj oversees clients reporting for 750 vessels and various roles, including Director of Management, significantly expanded the crew management business to over 250 vessels. He also served as General Manager for the Anglo-Eastern Recruitment India, overseeing crewing operations and achieving over 2,000 global seafarers recruitments annually. Niraj played a key role in establishing the Cadet Academy and leading the trainings division, engaging thousands of active trainees each year. His impact in the sector has been recognized internationally, including as a top finalist of the Crew Connect Global Industry Awards, Young Person of the Year in 2018. Please welcome Niraj. Thank you.
Thank you, Maxime. Can you hear me? Hello. Does it work?
I think it works, yeah.
I'll try this. If it doesn't, then let me know. Does it work now? It's a bit too generous on the introduction. I have to tell my team to cut it down a little bit. Too much history there. Yeah. Oh, I can take that if that works better. No problem. It's fine. It's good. It's fine. You want me to use that? Okay. Well, good afternoon, esteemed guests, colleagues, and friends. I'm Niraj Nanda, Chief Commercial Officer at Anglo-Eastern. It's an honor to be a part of this conference where sustainability meets strategy and where shipping intersects with industries like finance, academics, and governance. Ship management may seem distant from finance. We are an industry that works diligently behind the scenes, but is deeply connected. We had a very good lunch, and I'm sure a number of you are probably struggling to stay awake. I'll do my best. Which way does it need to point to? Which way I have to click? It works. Sorry, I gave you the first answer. Okay, I have a small quiz for you just to make sure that we're getting off to the right start in engagement. Thank you, and you get the first prize. So yes, giving it a little bit, shipping moves 80% of the global trade with nearly, how many seafarers, sir? There are no wrong answers. This is not a percentage, this is a number, so please go for it. 25,000. A little bit more than that. If you have to move 80% of global trade, I'm sure it's a little bit more than 25,000 people need to do it. Yeah. Big ships also, that's true. 25 million. I wish it was that much, but it's not, right? One last answer? I think that's very, very close. It's 2 million seafarers working around the globe and bringing the food to the supermarkets and all the stuff that we buy. Everything here in this room has been brought on a ship at some point of time in its journey. As they say, no shipping, no shopping. While contributing to how much of the global greenhouse gas emissions? That is, yeah. I think that's a very, very accurate answer. So probably shipping is an invisible industry because the more and more I talk about people in Hong Kong and wherever I travel to about shipping, they see a lot of ships being a port, but nobody recognizes the contribution of the industry. But yes, how do we contribute to the greenhouse gas emissions? I think this is the answer everybody knows fairly accurately, and it's only 3%. And this is the problem that we'll try to solve today in the next 20 minutes. How do we get the world to become a better place by addressing the 3% that we contribute to emissions? On that note, I'm sorry, this is a bit sticky. Yeah. For those who are probably new to our industry, I'll give you a very high-level overview of how shipping connects to others in our role. At the top of everything is a ship owner. Somebody needs to buy a ship, right? And that's how you will move the goods. Somewhere down there is somebody like us who's a ship manager, who's going to manage that ship, right? And who's going to operate it day to day to take those goods from point A to point B. And also we provide the crew for these ships, so that's an associated role with the ship manager. The finance, because without the money, you don't have the ship. That's where a lot of you people come in, because it's a big investment. Shipping is very investment heavy, and you need a shipyard to build that ship. So somebody has to take care of the finance. And there are regulators and there are associations who govern this industry. So there's a flag state, the flag that the ship flies, there are classification societies for standards. There's somebody who needs to charter that ship to take the cargo from one place to the other, which will involve typically a broker, and there has to be a port for the ship to go to, and you have to remove the vessel into the port. So these are the sort of stakeholders and cargo interests and regulatory bodies sitting in the background who would be connecting you on this side to the end consumers, and that side to all the way to IMO, which is the arm of the United Nations on shipping. That's possibly the cycle of the industry. How do we fit into this, and what do we do here? Anglo-Eastern is a global leader in ship management. We manage about 740 vessels under technical management, which humbly makes us the biggest ship manager. We have another 500 vessels in crew management only, where we provide the crew to owners who manage assets themselves. Till date, and we've been in the business for now 50 years. Last year, we celebrated our 50th anniversary in Antwerp, and this is the 51st year of operation. We have delivered about 1,000 ships through new buildings in various shipyards across the world. We today support 39,000 seafarers out of the 2 million, which work on board our ships, and about 2,300 staff ashore in 30 locations worldwide. We decided early that these seafarers are not going to produce themselves, so we need to help a little bit with that. And with that long-term vision in mind, we started a Pre-Sea Academy, where we have about 500 cadets joining for training every year, which go on board our ships, our managed vessels. And for these 500 cadets, we attract about 20,000 applications. This is what we look like on a world map. Apart from the Pre-Sea Academy, we also have training academies, which are post-sea, which is for continuous professional development of these seafarers and their constant training. What kind of ships do we manage? Almost everything. We have bulk carriers, and for those who don't understand the ships, I'll be a little bit more elaborate. Bulk carriers is where you carry solid cargo in bulk, like iron ore, like coal, and all the raw material that's needed for production, right? Then you have the tankers, which carry liquefied bulk cargoes. So you're carrying diesel, kerosene, petrol, all the other energy stuff. Then you have containers, which is more widely known. These are the box ships, and these are packaged goods which can be carried across the world. Then you have specialized gas carriers like LNG and LPG, which are, of course, much in the news in Europe these days for the energy transition. Ro-ro ships typically carry cars and trucks, and of course, some passengers sometimes, if there are ro-ro passenger vessels, which are very common in the ferries in Europe. Then you have dedicated passenger vessels, which are, of course, excursion ships for a holiday, and some of them also doing expedition cruising, taking you to see the dolphins and the penguins up north or south. Then you have something called the heavy lift ships. These are typical submersible vessels which have an open deck. And if any of you have seen a oil rig or an offshore production plant, which is outside a country and which is used for drilling oil, these assets don't move by themselves. They need somebody to come down, lift them up, and take it from one place to the other. So that's what these ships do. And of course, you have the smaller offshore vessels like tugs and exploration vessels, which help around the sort of coastline of a country for various reasons, including naval assets. Why am I here? Anglo-Eastern is Hong Kong born and majorly Belgian owned. So our roots are definitely in Antwerp for a very long time. And thank you, Maxime, for inviting us to make ourselves present today. We are the top ship manager for Belgian owners. We have 91% market share in Belgium. Our clients being CMB, Conti Lines, CLDN, some of the biggest names. Let's talk about the topic now, shipping and sustainability. The merchant fleet today comprises about 65,000 active vessels, which is not what I put for the quiz. Many of which were not designed with decarbonization in mind. Sustainability in the maritime industry is evolving, regulatory frameworks are emerging, but ESG remains largely voluntary. The sector's decarbonization is capital intensive, system-wide challenge, and the financial community plays a pivotal role in enabling this transition by providing critical capital, financing mechanisms, and innovative instruments to support the massive investments required for decarbonization. The sector faces unique challenges due to its capital-intensive nature and the high cost of adopting new technologies and cleaner fuels. Making tailored financial solutions is essential. What do you think is the estimated cost for decarbonizing this 3% transport across the seas? Wild guess. Thank you. I see that you've been the one paying attention, at least to the slides. Yes, exactly. That was a trick question. It is 1.4 to 1.9 trillion. Do you think any shipping company alone can afford this kind of investment? I think the answer is no. Even for the industry as a whole, with 65,000 ships, this is a major financial challenge and something we'll talk about and come back to it a bit, right? Let's talk about regulation and collaboration. Emerging regulations require cross-industry collaboration and innovative financing models. Are we the only ones struggling with the decarbonization challenge? Are we the only industry using liquid fuels? I don't think so. In the transportation sector itself, one comparison is aviation, and probably some of you in the room are from that industry. There's also steel production, there's chemicals, there's cement, there's the entire power sector, right, which is going to be the major contributor for decarbonization. The other problem is we have an aging fleet. Emerging regulations require cross-industry collaboration and innovative financing models. We also have an aging fleet. BIMCO highlights that over the next decade, more than 15,000 ships will need to be recycled. This is double than the last decade, underscoring the massive scale of deployment for sustainable ship recycling aligned with global environmental goals. This requires not only legal and operational frameworks, but substantial shipping infrastructure investments worldwide to meet demand. Digitalization. Digitalization is not a parallel trend. It is the engine that powers decarbonization. By harnessing real-time data, AI-driven analytics, and IoT sensors, we can optimize routes, reduce fuel consumption, and monitor emissions with unprecedented accuracy. This synergy between technology and sustainability is transforming shipping from a traditional reactive industry into a proactive force for climate action. The sector is responding. There are new fuels, there are new technologies, and there are new partnerships emerging. But the pace is uneven, and the financial sector has a critical role to play including capital mobilization, risk management, aligning investments to climate goals, and innovative financial models bridging information gaps. Besides all the new building ships, the industry has also to account for the modifications to existing vessels to meet regulatory frameworks. What are the challenges? Regulatory and tax landscape. Some of you who followed recent news, there's a body called the IMO, which is the International Maritime Organization, which regulates shipping under the United Nations. And there was an extraordinary session in October this year for a ruling or for a vote on the net zero framework, which is the framework to apply a global tax to carbon emissions in shipping to promote people to make investments or sort of to give impetus to that, so that because of the regulatory tax, people would be incentivized to invest in decarbonization. Unfortunately, that vote has been delayed, and for a year, there is a pause on the adoption of this regulation. Of course, Belgium has been leading the conversation through Europe, and I think it's common knowledge that the United States had a very strong reservation on adoption of this regulation. The fragmented adoption because of this, so of course there are some carbon tax schemes already in place, especially in Europe where they're leading, the others are lagging, and the fragmented adoption creates compliance bottlenecks, and there are gaps and opportunities which can be captured for further action. What can happen as a result of this is the people who have been mobilizing resources for decarbonization have actually now stood still and taken a pause and are reflecting upon the outcomes of these investments. This is going to delay the decarbonization journey for shipping, and this might create opportunity for some other nations to try and monetize the gap through additional carbon taxes, which may be localized in nature and will burden the consumers as a result of this. Future fuels. I will come to this in a subsequent slide, but there are questions on the pros and cons of each alternate fuel type and which types will come out on the top. And then, of course, you can't run ships without crew. So there is this whole element of crew shortage for trained crew for all these diversified fuel types. And as per an industry report, about 180,000 crew members need to be trained in the next 3 years to manage these ships, which is a huge challenge by itself. Yeah, I think we're here. What are we doing at Anglo-Eastern? Our philosophy of doing the right things the right way has led us to progress the sustainability agenda across the industry and beyond. It's our long-standing approach to growth, expand where it makes sense, and always with the right people and principles in place. The same principle and support from like-minded clients have guided and continued expansion into new fuel technologies and offshore capabilities. Here I would like to mention our Belgian partners, CMB, with whom we have worked since inception, have taken a huge forward-looking step into shipping decarbonization by making huge investments in ammonia and building future ships which will adopt that technology and fuel and help to decarbonize the supply chain. How are we supporting? We have some key sustainability initiatives. Apart from all the new building ships, like I mentioned, there are ships in the water today, 750 of them that we manage, who also need to optimize. And until there is a clear direction on the final solution, these ships were not built with decarbonization in mind. And that's where we're focusing on the sustainability and performance of the ships. It is through digitalization, we are able to make assessments and insights on the performance of these vessels, on the hull as well as the machinery, and drive fuel saving as well as emission saving as a result of this. And I'll come a little bit into that in detail. Future fuel support. This is the part on technology. We have helped design new builds with various fuel adoptions, and I can also expand on that a little bit in a subsequent slide. But we are being fuel agnostic at this stage. Today, we are working with multiple fuel possibilities and trying to build capability across that spectrum so as to support the ambitions of our customers as well as of the wider industry, being a market leader ourselves. Technology and training, the people challenge. This is again a huge area of investment for Anglo-Eastern. We are not only connecting ships through Starlink technology to make problem solving and guidance from ashore easier, but we're also piloting energy saving devices and IoT sensors on board ships to get better information and insights and use AI platforms to optimize that information and to make things actionable from there. This is what our Fleet Performance Center, which is based in Mumbai, looks like. This team has worked with 800 vessels under our management from 2023 to 25, and there are some big numbers there at the bottom, which you can probably see. The effort of that team is a saving of 225,000 metric tons of fuel collectively, which would have resulted in 700,000 tons of carbon emissions. In terms of dollar saving on the fuel itself, this translates to $135 million for our customers. And this is something which we are extremely proud of and investing in to optimize the existing ships on the water. Fuel types. I agreed to come to this in a little bit. Yeah. Traditional fuels are primarily made of hydrocarbons, composed of carbon and hydrogen derived from natural sources. Common examples, like I said before, were gasoline, diesel, kerosene. These are derived from crude oil, natural gas, and propane. Dual fuel refers to systems or engines capable of operating on two different fuels, either simultaneously or with the ability to switch between fuels depending on operational needs. The present focus on LPG and LNG alongside fuel supply and the existing of relevant tech. In the near future, the focus will perhaps shift to ammonia and hydrogen to meet transition requirements. Which of this is most suitable can vary depending upon the pros and cons on the table, which I don't want to really get into details of. But just to let you know, these are the sort of optionality that the industry is focusing on, and hydrogen being a key element and a feedstock for most of the sustainable fuels which are being developed out there. What has the journey for us been so far in the wider landscape? We have today 52 vessels which are able to operate on dual fuel. The ones with LNG and LPG are already active on the alternate fuel. And there are 87 vessels that we are building which have dual fuel capability across fuel types. Our dual fuel journey began in 2021 with LPG carrier for a Mexican company called Nieto. And then we had CLDN simultaneously ask us to build the first LNG dual fuel RoPax vessel for them, which is the Faustine. Followed by Australia, where Fortescue, one of the big mining companies, decided to pilot a vessel with ammonia. I'm sorry, my time is up. I would just sum it up then in the end. I did not realize I'm over time. I'll leave you with some closing reflections. I'm almost to the end anyways. If you allow me 1 minute. Thank you. At the heart of our operations is people, seafarers, our shore teams and partners. We are just one part of a major ecosystem. I would leave you with 3 closing reflections. Sustainability has a cost, but is a necessary investment. Service will become more expensive, but it's the right thing to do, and each of us will end up contributing through higher delivery fees or cost of goods as a knock-on effect. And as you could see, with the various fuel types, there is a race on. Who will champion it? Nobody knows. To drive sustainability, we need harmonized global policies, bold investments in green technology, and a relentless commitment to innovation. Thank you.
Thank you. Thank you very much, Neeraj. We're going to open the floor to questions. I'm going to start because I've got the microphone. I just wanted to ask you, you mentioned that that meeting that you had, which was, I think, I mean, like that the maritime industry had, which was a bit similar to the Paris Agreement, and where they tried to reach an agreement in October, and it failed. And I know we've talked, and from what my understanding is like, Anglo-Eastern was actually supportive of the agreement, but I suppose that if it failed, that means that some people were not supportive of the agreement. So why is it that you at Anglo-Eastern would be supportive while other ship managers would not be?
Thank you very much. I think that's a very relevant question. The IMO is a body of governments, not of industry partners, where each government who's at the table has sort of contribution towards formation of regulation. Usually this is done by tacit acceptance, which means when something is tabled, unless you are against it, you vote for it. And otherwise it goes through. This time they asked for an explicit vote. The countries who did not vote in favor of the net zero framework were, of course, the oil producing countries and United States, which we know from common knowledge has put a reservation on how should I put, renewables at the moment on their coastline. Why were we supporting it, or why would the other industry partners support us? Only for the reason to make a level playing field. Today, without a carbon tax, which is uniform across the world, there are old ships which are going to stay in the cycle much longer, and they're going to pollute much longer. So there's no driver or impetus for people to seek solutions to decarbonize and to make investments towards newer technologies. So to drive that, it's extremely important to have a global rule which would push out the older polluting ships and bring in new technologies as a result of it.
You mentioned $135 million savings. Yeah. How much of that? How much of your clients' expenses did that represent, and on how many ships were the efforts carried out? So how much could it turn into? How far could you extrapolate that saving?
Yeah, that's a very good question, actually. I'm not sure if I'm audible. So I can't speak for how much of my clients' turnover that it saved, because I don't know the profit of all my clients. Yeah. Just to give you context for this, a typical ship burns about 30 tons of fuel every day, right? And this was across 800 ships, and over a period of 3 years, like I said, from 2023 to 25 is what we've measured this cycle. How we looked at it internally, it was basically operating 8 ships emission-free for the whole year. That's what it translates to in numbers, the way we see it from our side. Yes. Yes. It has limitations. I mean, these ships, like I said, are built with a certain fuel consumption, with a certain design, with a certain type of engine. So unless you try and change most of it. Pardon me?
You yourself mentioned that you have to raise the fleet.
I'm not sure if I said we had to replace a large part of. I'm not sure if that's how it came out to be. Yeah, no, that's fine. So just to tell you that ships are built for a life cycle of 20 to 25 years, right? And what I meant was these ships, when they were built, there was no regulation on decarbonization. So there's a lot of old tonnage in the world. And we as ship managers, we don't invest in the assets ourselves. We only manage them. So we do not make those replacement decisions. The regulations do. And that's what we want to support, the regulations, to try and push the industry to make some big movements so that they invest in newer technologies, newer efficient ships to help the supply chain. If you go for a carbon neutral fuel, IMO's ambition is to go net zero by 2050. That is the end goal. And that's what ships today are being built with. So that's why you're looking at hydrogen, ammonia, the kind of fuels which do not have a carbon atom, or you're looking at synthetic or e-fuels, like e-methanol, green methanol, which of course has a different challenge. If we are looking at certain reports, if you look at, I give you a number of 1.4 to 1.9 trillion is what is needed for shipping itself, right? If I add some other industries into the mix, which will use similar type of fuels, the figures are 9 trillion. That's why it needs cross-sector collaboration and also cross-government collaboration. No country, no industry can do this by themselves. It's higher than the GDP.
Thank you so much, Niraj. So in the interest of time, we're going to move. I would like to ask you and all of the speakers to come for another picture. So if we can just have a picture, and then we'll have our next talk. All right.
Oh, then I don't have to.
All right. Right. Thank you very much, Niraj. Now we are going to move to an academic presentation with quite shocking results. When I actually look at the paper, I was very surprised. It's not what I was expecting. So please welcome Pascal Kramer, who is going to talk about food waste. Welcome, Pascal.
Thank you. I wasn't aware it was shocking. I've presented this before, and I've never had gasps in the audience, but now I'm looking forward to the shock and awe. It will wake you up from the post-lunch, if the previous talk didn't do it, this will keep you on your toes. So yes, I am diving into a little bit, kind of more smaller area, but nevertheless very important and actually very, very visible, because when you buy your groceries, what do you see? Absolutely stunning fruits and vegetables, right? When we go out and buy in the supermarkets, they all look so pretty. Makes you want to eat all these vegetables and this greenery. So this is obviously joint work with my co-authors, Yang Fang from Helen Zhao from SMU and Man Man Wang. We got started on this because an alum from our bachelor program was the son of an importer of fruits and vegetables to Singapore. We don't grow our own food and vegetable in Singapore, right? The footprint would be too large. And what he felt is, hey, daddy, you get all these fruits and vegetables, but then you reject all of these because they're not pretty enough, and you don't want to send them to the cold storage chain or to these chains. So can't we do something with that ugly or not quite as perfect looking fruit? So that's kind of what got us interested. We somewhat veered from the initial question because we decided to take a step back and look at the supply chain in its entirety. So if you look at the supply chain for food, obviously it starts at the agricultural production, right? So that's really on the farms, it's the soil. Then after post-harvest, so you harvest, you have to transport it to maybe a processing center. This could be very minimal processing, so just some packaging. This could obviously be more processing in terms of pureeing or cooking. Then distribution and retail, and finally it goes to the consumer. And here below are listed some reasons why we have food waste. And actually there's a difference between food waste and food loss. So the one that we're hear a lot about is the food waste. So that's what happens at home or in the restaurants when we buy too much, order too much, or the servings are too large, and we don't manage to finish before the expiry date and the food gets wasted. So that's something that has been looked at quite extensively in the literature, at least in the operations management literature. But if you go back, there's obviously losses along the entire chain, and when you're further up in the agricultural production stage or the post-harvest stage, we call this food loss, because this is food that did not reach the consumer. And if we then kind of zoom in a little bit, what we see is that high cosmetic standards seems to be a factor that's common in kind of different places, right? It's a problem at the distribution and retail area. So that's when we talked to our former student, right, who said that, well, these weren't quite perfect, so we couldn't put, or Daddy felt he couldn't put them on the shelves. And but it's also an issue at the production stage, so early on. So we decided to kind of zoom in and to look at the relationship between the retail side and the production side. So that's really what we wanted to do. It shows up in those two places. So let's look at how the retailer and the farmers interact with respect to this high cosmetic standards and how this affects food loss. Okay, and how big is that how big of a problem is it? Just to give you an idea, so 1/3 of food produced globally is wasted. That is across the entire chain. Again, this is not specific to one single part. And for example, in the post-harvest and in the transportation, it will really depend on the quality of the transportation network. So if you have excellent fast shipping with reefer containers, you will obviously waste less than if you have delayed transportation and difficulties on the substandard road network. But some studies have shown that 20% of the food waste is due to high cosmetic quality standards. So yes, this is a problem worth investigating. So what do we see in the stores? We see these beautiful apples, and this is repeated for the strawberries or for any kind of produce that you can think of. This is what we see. But what can grow on the tree is something that's maybe a little bit less red or even kind of funnily shaped, right? There are all these sure TikTok videos nowadays, used to be just pictures, but about funny shaped vegetables and fruits. But we don't see those in the stores by and large. If you have your own, which if you live in Hong Kong or Singapore, you don't have your own trees in your backyard. But if you have your own trees in the backyard, you know this very well. Why? So what are those cosmetic qualities concerns? This could be weight, the shape, the size, the color. And as you can really see, it is literally saying, okay, it should be 50% red. The surface should be 50% red for us to say that it's an extra fancy apple, right? Whereas if it is only 33% red, then it's only a fancy apple. And well, below that, I guess it's just a disappointing apple. So there is a range of colors and complexions, but mostly we only see the perfect produce. But that does, sorry, what I also wanted to obviously add, that does not actually change the taste or the texture of that apple. It doesn't change the vitamin content and the juiciness and the nutrients inside that apple. So some of these concerns are really purely cosmetic. They do not change the intrinsic quality, meaning the nutritional quality that you are obtaining from the particular produce. And that's kind of what we want to talk about and distinguish. So why do these retailers set a high standard? Well, clearly there's some regulation, or at least some government grading, right? We see this extra fancy and fancy. This comes from the Ministry of Trade and Department of Agriculture in the US, and Europe has the same, and I'm sure in Asia you have a similar grading. But this is only meant to facilitate trade, so that when the farmer and the retailer or anybody in the supply chain talks to each other, you can say, yeah, these apples are guaranteed extra fancy, these apples are fancy, so that we know, we agree on what we're selling. They're not actually at any point in time meant to be mandatory for sale to end customers. So they're not compulsory for the retailer. So this is not really the reason for the excessively beautiful fruits and vegetables in the supermarket. So could it be for operational efficiencies? And actually there is a point, right? So if you're going to pack your green beans, if you have some that are 20 centimeters long and some that are 5 centimeters long, it's kind of difficult to put them in the same bag. So it's nice if they're all the same size-ish, roughly, they're all straight, so that makes just the whole packaging, transportation process more efficient. So definitely that is also potentially an issue, not so much for the color, obviously, but there for the size and the shape. Regular shape will be easier to stack. But we're not going to focus on that particular part. What we are going to look at is the price premium. So as a customer, we're so used, and obviously we enjoy buying, savoring those very beautiful fruits, right? And we are willing to pay a premium for that. So between the extra fancy and the fancy, there is a $3 premium per carton. right? So as a retailer now, I can sell the extra fancy ones for $3 extra to my customer because the customer is willing to pay this much. So that is empirically shown. So that's what we are going to focus on. So we're not really going to look at operational efficiencies, but we're going to look at the aspect that is purely discretionary in a sense. And we've talked about what will a business do? Well, a business will optimize their profit, right? I mean, so as Professor Savas mentioned this morning, if my customer is willing to pay more and I can give them that more without incurring too much of an extra cost, why would I not do that, right? That's what I'm set up to do as a business. But this does create upstream food loss at the farm, sometimes at the processing. So somewhere along the chain, some of these fruits and vegetables will be filtered out of the system and not sold for human consumption. Well, or maybe they will. So that's what we're going to look at. So you have different fruits and vegetables, and what we see is that what are the cosmetic standards? They vary. How do they do the harvesting? Well, depends. These are sensitive items, so they're still done by hand. Though I know that I just visited a university in China where they have humanoid robots, and they said they're going to train them, and to get them to do the harvesting. So that will obviously change. But at the moment, this is still done by hand. We also try to find out where do they do the grading, right? How early is it filtered out of the system? And so we didn't always have the information, but there are definitely some of those items, such as strawberries and cucumbers, for example, where it's already in the field. So you just don't harvest it. As the picker, the fruit picker or the vegetable picker is walking, actually both fruits, is walking along the field, they only pick those that meet the standards, and they leave the other ones to rot, essentially, and to get plowed under. Some of these, you can do something else with it. So if it's not pretty enough, you can still do something. You can maybe puree it, you can juice it, but as you can see, it kind of depends. Sometimes there is a big market for it, sometimes there isn't. So even if there is a solution, sometimes that solution only captures a small portion of the food loss that happened at the harvesting site. So what is the research questions that we are looking at? So first, why do they adopt the high cosmetic standard? And that's actually not that difficult, so the answer to that will be intuitive. But more interestingly is, does this high cosmetic standard really increase the food loss, yes or no? And when does it do so? So the answer is obviously sometimes yes, sometimes no. And what actions can be taken to reduce the food loss, if any, right? So what are some suggestions, some way forwards? So there is a literature, I didn't want to spend a lot of time on it, and actually I have a whole model supporting this, the outcomes, but I'm not showing it in the interest of time. But as I said before, there's a lot of research on the downstream food loss, so how this is driven by, for example, people buying too much, how this is driven by the convenience of home deliveries. So now that Amazon delivers the fruit and vegetables for you, maybe you order more frequently and so on. There's a paper I like about buy one, get one free. So it looks like, hey, that's helping them get rid of the salad, but what happens, the salad doesn't get wasted at the retailers, but it gets wasted in the person's fridge. So they say this is also not necessarily the best intervention. There was only at that point, so far as we know, still only one paper on upstream food loss that we could find. So we're kind of in an interesting and good space here. So the other paper that looks at food loss looks at gleaning operations. So again, very interesting, volunteers who go to the fields after the picking has been done and basically get the ugly ones that are left over and donate them to food kitchens. So this is organizing actually volunteers to go and pick in farms after the official harvesting has been done. But so what we look at, as I said, is the interaction between the retailers and the farmers, and why is this happening? So how does the interaction first work between the retailer and the farmer? Well, the retailers and the farmers obviously sign contracts, and about a third, or they can buy on the spot market. So two options: they can buy on the spot market or they can sign contracts. Over a third of the agricultural production by value in the US is sold through contract farming. And if you look at more like novelty items, such as, I don't know, heirloom tomatoes, for example, is one of those, the percentage goes up. Or maybe organic and so on. So there it's even more likely to be under contract farming rather than under spot. So buying on the market every day or every week. We're going to look at two different types of contract because both exist in practice. One is the marketing contract, where well before the harvesting season, the farmer and the retailer sign a contract where they specify the wholesale price. So how much are they going to pay per ton of the good, the quality that they expect. So they will say, we want a high quality, extra fancy, or we will buy fancy and above, right? So they set the price, they set the quality they expect, and they set the purchase quantity. So how much are we going to buy of the product? The farmer owns the field. The farmer decides how to allocate resources in terms of fertilizer or other actions to create the final product and obviously sell to the retailer. A production contract is different. The production contract, the retailer essentially owns the entire output of the field and can dictate actions to the farmer. So they tell the farmer, okay, you need to put fertilizer on this kind of schedule. This is the acreage that you need to dedicate to my product, and so on and so on. So they essentially run the show, but the farmer is they're not actually an employee. They're technically not an employee, but they're working kind of to the specifications of the retailer. And that obviously creates very different incentive alignment issues, right? In one case, I can dictate what I want the farmer to do. In the other one, in the marketing contract, I need to incentivize them. I need to make them want to do what I want them to do. So can the farmer do something about cosmetic quality? Well, when I first moved to Singapore, I was very impressed by those Japanese fruits, actually. I had in Europe, it was not a thing when I left Europe. But these melons that are apparently hand massaged to get the nice outside of the melon. And so there's a couple of things that you can do to improve the cosmetic quality of your food. So polishing the surface of the fruits, obviously just more banal and straightforward is temperature control. So you make sure that the fruit doesn't get too cold or too hot. You can apply pesticides. One that I also like is putting the little bags around the fruit so that they don't get damaged. They also grow again, the Japanese are wonderful. They grow square watermelons by putting them inside solid square cubic watermelons, I guess I should say. So there's all kinds of things you can do. Clearly, making a cubic watermelon does not increase the intrinsic quality of your watermelon, but to some, it's easier to stack, I guess, and it's just a symbol of what can be done. But there's still also an element of randomness, right? So you may be doing all of this, but there may be an infestation. The weather might be truly extraordinary or really bad. So there's still some uncertainty around the yield and the cosmetic quality that you will obtain at the end, despite the best efforts of the farmer. So we have to account, and we do account for these. So we have efforts, but we know that the efforts are not kind of deterministic. I do the effort, I get the outcome. No, I might or I might not get the outcome. So what is the retailer thinking? How are they making their choice? As we said, clearly on the positive side, it was very obvious. I get more money if I sell a prettier fruit or vegetable. Those Japanese melons cost a fortune, right? So that's great. But the negative effect is, of course, it's harder to get prettier melons, and I will have less supply of those pretty melons. Actually, diving into how this all works, what they do is normally your melon plant will have several melons growing on a branch. They actually snip off the buds to only leave one or two, to invest all their strength, energy, hopes into the future of the remaining 1 or 2 melons on that vine. So you don't waste the melons because you have so few, right? You could say there's another issue there. I maybe don't create enough melons to feed the world, right? But definitely no food loss, or very minimal food loss. But so yes, you have these two kind of different effects. So One is what we call delta, the price premium, and the other one is the rejection rate. So the more stringent, the more demanding I become on the fruit or vegetable, the more I will reject when the farmer presents them to me. So the more I will say, no, not good enough. I'm not accepting that. I want it extra fancy. This is only fancy, not for me. Okay. So here are the results, right? What do we have on the x-axis? We have the cost of effort. So how difficult is it for the farmer to exert that effort? And on the y-axis, we have the rejection rate. So if I increase the cosmetic standard, does it not matter too much? So on the bottom here, it doesn't matter too much because only 20% of the fruits and vegetables are rejected anyway, right? Versus here, 80% of the fruits and vegetables do not make the cut. They're not pretty enough. So this graph is fairly intuitive. By and large, with some small changes, it's not fully continuously decreasing, but actually that depends on the functional form you use, so that's not too important. But by and large, we see what we expect, which is as the cost of effort goes up, right, it becomes harder and harder to force the farmer to work hard because it's so expensive and so difficult for the farmer to do this extra effort. So I'm more and more likely to go with a lower standard. Okay, so I prefer a lower standard as, so that's the white, right? The lower standard area grows as the cost goes up. Okay, and that's the same whether it's a marketing contract or a production contract. So first question answered, not that difficult, right? So rejection rate is low, retail prefers a high cosmetic standard because they get a lot of money. Effort cost is high, they prefer a low standard because it's just difficult to encourage the farmer to work. But the more interesting question is, does this high cosmetic standard actually increase food loss? And that's where I basically already gave away the game a little bit with the Japanese melons, but not necessarily. Not food loss as defined as food that was ready for human consumption, that existed, and that is not consumed by humans. Okay? Not necessarily, because since I will pay more to the farmer because I earn more from the retailer, the farmer will work harder. If they work really, really, really hard, so if I manage to incentivize them to work really hard, they actually manage to create less food loss than before, than if I didn't set a high standard. So a high standard need not necessarily increase the food loss. But when does that happen? Of course, this doesn't happen if the conditions are not right, right? So it only happens if the conditions are right, which is basically the rejection rate is quite low. So what is the big problem? The big problem is that sometimes, I don't have the, sometimes the preferences, and that's again a question that we had, follow-up question in the morning, the company's preferences and society's preferences may not align. So here, the company prefers to set a high standard in the bottom part, and that's great because that's the standard that also minimizes the food loss. So it's a win-win. We are wasting less food, and the farmer and the retailer are making more money, and the customers are happy to pay for it because they get the beautiful fruit they want. But in the area that's gray but not striped, we do have a problem because from a food loss perspective, we are worse off by setting the high standard. But the retailer nevertheless prefers to set a high standard because they make a higher profit. So there the profit motive and the sustainability motive do not align. How about the different contracts? So does the contract matter? So here I plot the two curves on top of each other, and what we see is that, well, sometimes when I sign a marketing contract, I set a higher cosmetic quality standard. Sometimes I set a lower one. So it's not really, we don't really know. It's not ranked. It could go either way. That's just kind of a side question that we looked at. In terms of food loss, though, a production contract where everything is controlled by the retailer is better because they have no alignment problems. They can tell the farmer what to do, the farmer will have to do it, and the retailer actually doesn't like food loss either per se. They don't mind it, but they'd rather sell than not sell. So they will set higher efforts. So in general, so everything that is not striped, we see that a centralized system where the retailer tells the farmer what to do is better from a food loss perspective. But there are some possibility is relatively minor where actually the opposite is true. So what can we do in order to try and reduce food loss? There's a couple of policies that we could, like obvious ones that we can think of. It's just, why don't we ban the high cosmetic standards? Actually, the EU tried to remove cosmetic standards altogether, but it did not change the behavior of the retailers. They just used the old existing standards, which everybody knew, and still continued to write their contracts using the terminology and the grading that was previously used by the EU. The second policy is we could try and reduce the price premium, right? So we can try and inform the customers, telling them your fruit doesn't have to be perfect. It's still good, nutritious, and healthy to eat. Or we could try and reduce the rejection rate. So that means how can we increase the effectiveness of effort, basically? That my effort is more effective at creating very high quality or high, beautiful produce. And finally, I could also try and reduce the farmer's effort cost. So can I make it less costly for them to try and increase? So the policy 3 and 4 are kind of similar. It's trying to reduce the costs of the high cosmetic standards in terms of rejection. So what we see is that the first one, right, if I look at this particular graph as an example, well, it will only work on the highlighted area. So if I ban cosmetic standards when the standards are already low, the ban will have no effect. If I ban cosmetic standards when actually cosmetic standards were helping reduce the food loss, it's a negative effect. So it only helps when the retailers and society's objectives do not align. When we look at reducing the price premium, if I reduce the price premium, the retailer has less of an incentive to set a high standard. So I am moving from the right of the graph to the left of the graph. What I actually see is that the food loss at first goes up. So what I will only manage to reduce the food loss, if at all, if I manage to convince them to drop their cosmetic standard to a lower level. As long as they continue to prefer, so as long as the price premium is still large enough that they prefer a high cosmetic standard, any reduction will actually just reduce the effort of the farmer. So we have to be careful. We need to make sure that the price premium goes down by a lot, essentially. How much is a lot? Well, that's difficult, right? That's more of an empirical question. Reduce the rejection rate. So reduce the rejection rate. We're moving down. In the white area, the rejection rate doesn't matter because the rejection rate is the rejection rate for the high quality. So as long as you're in the white region, you don't care. Obviously, if you are in the gray region, then it helps. And ideally, if you cross the boundary, that's the best. So if you can really bring it down a lot, again, it helps. And the same will be for the farmer's effort. If you manage to reduce the cost of the farmer's effort by a lot, so that you cross into the striped region, then you're good. Okay? So that's kind of what we have individually. So let's look at it jointly. If we look at the 3 areas that exist, so the area where the farmer was setting a low cosmetic standard to start with, well, we can still actually help, because if we reduce the cost of effort, they will still work harder and create, or not so much work harder, but the same amount of work will create more products that satisfy the low cosmetic standard. By the way, the low cosmetic standard doesn't mean zero cosmetic standard. There's a lot of different standards out there. If we are in the second region, then we could ban the high cosmetic standards. That's one option. If we want to not interfere as much, so let's say we're more of a liberal policy maker, so we don't want to go in there and ban, we can invest in R&D or encourage investment in R&D by providing subsidies, for example, to reduce the rejection rate, so to try and move downwards, or to reduce the cost of effort, both of which will be positive and reduce the food loss. Oh, sorry, and the third one, there's no need to ban. As we said, banning would be counterproductive here, so we are okay with the high cosmetic standard, but obviously we can still shift everything down and make everything better if we can reduce the cost or reduce the rejection rate of the farmer. So that's kind of some ideas to explore and to think about if we want to reduce food loss due to cosmetic quality. So from a conclusion, we look at the contracts in the supply chain between the retailer and the farmer and how these incentives play out by looking at the price differentials that we, the consumers, are willing to pay. And this food loss is a direct consequence of the premium we are willing to pay, right? So we recommend policy interventions that might help. We also highlight that the cosmetic standards are not per se the problem, or not necessarily rather, so that we need to look more closely at each individual product to see whether that's really causing a higher food loss, yes or no. We obviously have checked our model and our predictions for robustness, so we look at kind of different extensions, but that I didn't put in here. I think for me, it leaves me with some questions. Maybe these are questions that you also have, so I just want to kind of highlight some of these questions that are worthy of further thought. Is when we buy a cell phone or a camera, we're going to read reviews, right? And we're going to check, and we know that whether it's a high quality cell phone or not by checking the reviews. Now, for produce, it's kind of harder to do. You're in the shop, it's not like you can get a review of a particular apple from a particular farmer. So how do you judge? You pretty much judge the book by its cover. So you judge the fruit and the vegetable by the way it looks, because that's more or less the only data point that you have available at that point. So that's one thing. So is there another metric of quality? I'm not sure. Is there another component of quality that we can reliably as consumer measure and that we could try and educate the consumer to rely more on this other metric? But what would it be? And then questions are, how much is the cosmetic and the functional quality linked? So if it's in the size of the beans being 10 centimeters to fit in the bag, clearly not. If it is in the redness of the strawberry and a redder strawberry sweeter than a non-red strawberry, then there is some link between the two. So maybe we cannot, here we are kind of keeping them apart from each other. We're separating the two, but that's not necessarily true for all products. And so that I already touched on the Japanese melons. Education of consumers, more and more, we don't do our own shopping. We get the shopping done for us, so they pick for us. So, right, if we get Amazon or whatever is the local online shopping preferred channel, they pick your fresh produce for you. And they will then have incentives. They don't want complaints, so they will have their own incentives to give you fruits and vegetables that they believe you will accept. So that's it for me today. Thank you, and welcome any questions, if you have time.
Thank you. Is there any question in the audience? Bring the microphone. Yes.
I can try without a mic. Thank you. Thanks so much for that. Absolutely fascinating. I will find you afterwards to ask 100 other questions. Maybe two immediate things come to mind. Just the sort of the hippie in me wants to ask you from your perspective, the growth in like alternative supermarkets or the places where you can buy the carrots with the little tumorous growths. Like, is that actually growing at any kind of scale? Is one question. And then the second question I have is, as you look at the retailer here in your research, how much does that behavior differ between, say, the US, Singapore, where you are, Europe? Are these patterns very similar across these regions?
Okay, so first question first about, obviously there are indeed alternative channels where these so-called ugly fruits are actually celebrated and sold as a proof that, you know, these are not artificially grown and that these are like homely vegetables and so on. So I would say from just personal experience in Singapore, not much. Okay, so I think the further the end consumer is, you know, my kids thought that when we moved to the suburbs of Singapore, we were in the countryside. So just to say, nowadays a lot of kids, and I try my best to educate them, but they still thought we were in the countryside. So they really don't know. They don't know better. That's all they know. That's all they've seen. And so they think that, yes, if an apple is not perfect, it's not a good apple. So, and I suspect Hong Kong will hence be similar. So highly dense, not countryside type of areas, there's just a lack of understanding. So it's not that big. the closer you go to rural communities, the better they understand that cosmetic is just that it doesn't really matter. What we find is one big problem is that the mainstream shops do not generally sell the misshapen ones. So you really have to go to those niche, hence more expensive. I mean, they have a lower same price per square meter, but less sales and so on. So they're expensive. On average, they're more expensive than what you see in the regular supermarket. So that's really going to hamper the growth in general across. So now that's across markets, not just Singapore. So they're just small and niche. The other question is a different market. So I guess I partially answered that. I think it depends on if the market has their own countryside, so that people kind of see it and they know it, and they yeah, okay, I know that an apple doesn't need to be perfect. It helps.
All right, a quick question just to understand the scaling of the market. Sorry, you said 30% for waste, and then you said due to cosmetic 20%. So is it 20% of 30%, or is it 20% on top of the 30?
No, not on top, not on top. Yes, so it's 20% of the 30%.
So it's 6%.
Yes, so it's 6%. Yes.
All right, thank you so much, Pascal. In the interest of time, we are going to move to our next session, which is going to be a panel session about greening the supply chain. So for this session, we are going to set up the panel, and so we are going to have Professor Anatole Boot from the Chinese University of Hong Kong, who is going to be our moderator today, and he's a specialist of the energy market and the legal aspects of the energy market. And so he's going to have 3 panelists today. He's going to have Jan Kuit, who came directly from Belgium, from the port of Antwerp-Bruges, to be with us today, and he's going to tell us a bit more about how ports can have an impact on greening the supply chain. And then we are going to have Oliver Haas from Cathay Pacific. So Oliver is the head of sustainability at Cathay Pacific, and he's going to tell us about how the aviation industry deals with greening their supply chain. And finally, we'll have Frank Zhang, who is the Senior Vice President for Greater China of Umicore. So Umicore is a Belgian company that is really active in the mining industry. And in particular, it's really, they mine a lot of raw materials related to batteries, for example. And so they actually are very active in greening and also recycling these battery materials. So I will now let the floor to our panelists, please. Thank you.
It's good afternoon, everyone, and thanks, Maxime, for the introduction. So my name is Anatole Boot. I'm a professor at the Chinese University of Hong Kong, Faculty of Law, specializing in energy and environmental law. And I will be your moderator for this panel. So we've just heard 2 fascinating presentations, one on cosmetic standards and the other one on shipping. So we'll now move to the supply chain dimension. So may I ask, perhaps briefly, in a couple of sentences, so if each panelist could introduce himself, your name, your role, and in one sentence, how your organization is engaging with sustainability in the supply chain. Start.
Yes, good afternoon. My name is Jan Kuit. I'm working in the commercial department of the Port of Antwerp-Bruges. Yeah, that's better. I'm heading up the team of maritime business. Maritime business is a link between the port and the ship operators and the ship owners in our division. But we're also a lot, of course, involved in the energy transition. And I think for a port of Antwerp-Bruges especially, is the challenges for the next years to come, how we can accommodate all the energy transition, not only for the shipping, but a port is also as a wider role than the shipping is also a landlord, also for the industry in its entity also.
Wonderful. Great to meet you, Jan. Great to meet everyone here too. And Maxime, thank you for the invite. My name is Ollie. Oliver is the name that my mother calls me if I'm doing something wrong, so you can call me Ollie. I work for Cathay Pacific. At Cathay, I oversee kind of one pillar of our sustainability team that really looks at how we scale sustainable aviation fuel. And also how we make some very strategic investments in sustainable aviation fuel. So we'll talk about a little bit more about that in the context of supply chain. We're very excited to have opened our route between here and Brussels this summer, and I understand it's doing very well. And so also very, very proud to be part of this forum here today. So we'll share more as we go.
Thanks, Jan. Thanks, Marcel. My name is Frank Zhang, as Maxwell just introduced, a Belgium company and a long history, and you can track all the way back more than 200 years on mining. Original, now we are really focusing on the process industrial technology to support some critical energy sectors, and also include the mobility, which meaning the battery technology. So I'm based in Shanghai, looking after our business operations in Greater China region, mainland, Hong Kong, Taiwan. We have 10 manufacturing sites, and including one newly established R&D center in Shanghai, and a total about 2,000 employees. So I'm very excited to be here and willing to really share from a Umico perspective how we are working very closely with all the stakeholders, government, regulations, customers, and the supply chain, how we continue to involve ourselves to be a strong value provider to support local, regional economy development.
Wonderful. So 3 different sectors, and of course probably common, but also different challenges in the different industries. So perhaps we can go into more detail in the different aspects of this sustainability challenges, supply chain challenges, greening the supply chain in these different industries. So if we can look at greening the backbone or greening the infrastructure and transportation, greening the ports, greening the mining perhaps activities and the aviation infrastructure. So how what would you consider to be the most significant sustainability challenges you face in your sector infrastructure? From an infrastructure perspective, what would be the key sustainability challenges you're facing, also relating to perhaps also the operations of the infrastructure? And how are you balancing decarbonization of the infrastructure with commercial viability? Can we follow the same order, perhaps?
Yeah, no problem. Okay. For us as a port, being the number 2 port in Europe, and maybe most of the people maybe know, but we merged 3 years ago with the port of Zeebrugge, Port of Antwerp, with Port of Zeebrugge. And one of the reasons behind the merger was indeed to accommodate all this energy transition also. We have been a classical port having a lot of vessel calls, but as Antwerp is a very large industrial platform, of course, also. Zeebrugge is a very large logistic platform. But we realized, of course, already very soon, and our shareholders and politicians also realized that when we have to go forward for the energy transition, we will require all these new fuels to be sufficiently important in the port. Nowadays, we have a lot of local production of fuels. Okay, crude is imported via Rotterdam, but we have the refineries in place. Going forward, it will be a mixture. There will be a lot of refineries, of course, also, but simultaneously, I think the new fuels like ammonia, methanol will require a lot more import, will be less local production in Europe, definitely. And that will require other accommodations, other infrastructure. And I think this is one of the main drivers behind the merger already. So that's point number 1. Number 2 is, of course, also the regulation will change. All these new feedstock and new fuels, they have another risk profile. It's a much more awareness. Ports are still quite nearby to the population, especially in dense populated countries like Belgium and Holland also. So we need also to translate that and have it accepted by the population also. There is a large role in that also, and I think that are the main. We do not do it ourselves because the industry has to play their role, of course. We are a facilitator in that also.
Actually, some of that mirrors really well into aviation. I think maybe if I take the higher level view of the question, one thing that does encourage me about sort of living in the time that I live is that we technically know what we need to do across most sectors, right? The ones also kind of represented here. And aviation is a hard to abate sector. Following on from Niraj, like aviation is responsible for about 2.5% to 3% of human generated emissions as well. The issue is, I do not want to describe that is a small issue. The issue is that aviation is hard to abate. So the further we go along, other sectors will decarbonize faster than aviation. Aviation is also super visible, right? We all have a connection. Like you go to an airport, you smell the fuel. Just like we said with shipping, you don't really see ships as much. So we have this like very kind of direct relationship between the customer and the problem in aviation. But encouragingly, we have technology solutions, right? We know sort of what we need to do. We have alternative fuels. And from the perspective of infrastructure, one of the greatest things, at least in concept, about a sustainable fuel is that it's a drop-in fuel. So I can use largely the same infrastructure, even some of the refining capacity at Rotterdam, for that example, to refine and distribute and handle all the logistics of the fuel. The number one issue is cost. Right? Fundamentally, it's cost. So in aviation, sustainable aviation fuels are about 2 to 4 times the cost of conventional jet fuel. Conventional jet fuel generally makes up 30-40% of the cost of an airline, operating cost of an airline, right? So it's a huge cost, and hence this sounds like a really cheap answer to the solution, no pun intended, but or to the question. But it's literally just about the cost of the transition, right? That's what we face. It's not really any more kind of fundamental technical questions. Of course, there's a lot of technical development that still happens. Yeah.
Yeah, for Umicore, it's really for us to, if you think about traditional industrial technology company from supply chain perspective, it's really a linear supply chain. You take, you make, and in the end, you dispose. So for us, it took us a few decades to really change not our philosophy. It's really from a cost perspective, from a sustainability perspective, is we change this linear supply chain into a circular model. It's really not only the vision change, it's our business model change to really support our customer to be more sustainable. So we really, for us, because we're a number one consumer for the precious metal, for example. And in the past, we own mines. But the operating cost is very high. So we developed the recycling technology, which consumes substantially low energy, and also really help us to overcome the geopolitical challenges and build a much more resilient supply chain base. But that's also required a substantial technology change. So we invest heavily for the technology, for the recycling technology. For Umicore, for precious metal, we have a huge R&D capability, and we have a huge operation in Belgium. People from Belgium, Umicore is well known on the PGM recycling. We have our own. Ireland, we have it's a world-class facility on the precious metal recycling. But also we have on the energy side, Umicore also invests heavily on the battery material. And we design, this is a relatively new business for us, and to really support mobility development globally, particularly in China and Asia Pacific, we design our material to meet the recycling from the beginning. So battery is the product, must be recycled. So it's not only a vision, but that's a must by all the regulations. So for us, technology is the key. We continue to invest technology and to really meet the recycling business model for Umicore. But now it's good to be here at the right time. It's a good time to be here in China, because China over last decade or two is really become the center of excellence from technology development, especially on the battery side. And with a battery, not only for the mobility application, but for me, it's fascinating to really for the battery storage system. Now, this technology can be applied together with solar and wind, renewable technology, and also develop a much very high vision for Chinese government and also the public sectors and the government company and also private sectors. So it's fascinating. China today already achieved the largest scale of the renewables energy sector and also the lowest cost, even lower than the traditional, for example, oil and gas turbine technology. So China, moving forward, will have enough the renewable energy, and probably today is already 60% plus of the global capacity on the renewable energy, and at the lowest cost. And with that infrastructure will support the strong development on the AI technology, data center, all those kind of things. This is a fundamental infrastructure investment. I think, so I want to just highlight from Yumiko, I think it's good time and it's important to be in China, to be part of the technology ecosystem, to really be part of the development, to continue develop the technology, apply for our China business, but also for the global business.
Okay, thank you very much. So perhaps some good news. The technology is there, I think, in the different sectors, and it's clearly it seems to be, at least from what you said, something quite central to your recent fundamental kind of decisions and merger, for instance, and also investments. But the cost issue, at least in your sector, aviation, remains a problem. But in other sectors, clearly we see a major shift in terms of cost, where clearly, thanks to economies of scale in China, renewables is now cost competitive, at least from an electricity production perspective. So this is encouraging. Let's continue where you stopped on the issue of green energy. You said many important things in relation to renewable energy and the cost of renewable energy. So you also mentioned the issue of supply security in terms of minerals, but clearly also renewables contribute to supply security of electricity. We've seen it in Europe in 2022. But do we also see a bottleneck? Is there enough green energy, for instance, for corporations? Do we face a limitation in terms of the availability of green energy? And is this constraining your sustainability strategies? Are you seeing competition for green fuels or renewable electricity in your operations? What role can partnerships or policy play in expanding access to green energy?
I think as a port, and the aspect of the cost is the same for us anyways. And I think till 3 years ago there was a lot of optimism in Europe, and we will go fast, and we go fast, and we were preparing, and the energy transition for the port. We were all aiming for hydrogen, and then came the remark, but we should maybe do more for electricity, and is the power grid enough? And we got the same view because we were making land available for them, and then the investment was stopped, and that's a difficult position for a port. And in the meantime, it almost comes at a standstill, I must say. There is still a lot of projects ongoing, but the final investment decision is not there anymore. And I think that's for the years. Okay, it's normal, of course, you go on a wave also, and someone optimistic becomes now a bit depressed. I think the curve will go up again. But in the meantime, we must have the necessary funds also to continue this investment and to make the right choices. And that's a more difficult one. Land is a scarce thing, especially in Benelux, I think. It's very difficult to decide on where and what should we make the reservations for. Is there a shortage of green energy? I think for the time being not, I would say. And that's why because there is formally nothing moving, so I think the guys who want to start, apart from the cost issue, yes, they can get the product. It's a chicken and the egg, of course. So that's we have in the port the energy transition we have a second project that's a multi-fuel port, we call it. That's for the fuel for the vessels, where we do not make a choice. We say, okay, all alternative fuel is fine for us, and we must be ready for all these fuels. We've been doing last year 2 methanol bunkerings, 3 methanol bunkerings for Maersk. Since then, it stopped. But I think there is room and sufficient product for the time being, because it's at a small scale. And we try to facilitate and to bring it up to a higher volume, and that's extremely difficult. We also talked to that a lot, European Commission, for example. They first said it was a capex issue. For me, no, it's an opex issue. It's really an OPEX issue, and I think Europe should decide and understand also that there is more to be done around that operational issue for all the players in the field. But at the time being, I would say no, there is, with the actual demand, there is no shortage.
So from my perspective, actually, I probably have a lot to learn from you on this, Anatole, but if I think about this as like as a optimistic engineer, if I think about this from first principles, for decarbonizing our industry across any sector, yes, we need more renewable energy. Drop everything we do and just build as much renewables as you can, because everything from the road sector, heating and cooling, cement production, green hydrogen production, this is the underlying assumption is that you're going to have abundant and cheap renewable energy to fuel those transitions. No pun intended. In aviation, this is true as well. So in aviation, if you look at sustainable aviation fuel, today, then does anyone know what the #1 feedstock for sustainable aviation fuel is? I usually bring 2 jars, but I forgot them today, so I've just shown you what the jar is. Does anyone have a guess? Who said that? Can you say it louder? That's correct. It's used cooking oil. So McDonald's fryer oil, KFC fryer oil, big dining facilities. This is the #1 feedstock at the moment for sustainable aviation fuel. The kind of chemical pathways to produce that fuel are very mature, and so essentially that's kind of what SAF is made of mostly today. But that's not a scalable pathway by any means. The feedstock's going to run out. It's very expensive. The next kind of wave is going to be agricultural waste and so-called alcohol-to-jet processes. This is sort of other chemical pathways that are now maturing to commercial scale, and we'll start to see a lot more supply coming from agricultural waste. But that's also not enough. The #1 sort of most scalable pathway is so-called electrofuels, which is where you combine green hydrogen with carbon and you kind of make the fuel synthetically. But the underlying assumption there is that you have massive amounts of renewable energy abundant and cheaply to make these fuels. And I think one question that comes from a policy perspective, if I sort of remove the idealist hat to say just, yep, make as much renewable energy as you can, it's also about how we distribute that renewable energy as a society, right? Because which sectors should get it first? Should it be the easiest to electrify sectors, or should it be the hardest? And that sort of becomes a really interesting principles question as well.
Yeah, for me, I'm a strong believer for renewable energy. As I mentioned, this is the right place and right time, because from a China perspective, China is compared with Europe or US, China is lack of natural resource. So there's no way China can follow the traditional oil and gas path like Europe or US did to really meet China's ambitions to become a developed country by 2035. Renewable energy, why China is so keen to, with all the ambitions led by government and with all the stakeholders, so really we can produce the energy. And from solar, from wind, hydrogen could be another area. And also with the latest battery technology, storage system development to really combine. China already showed us very, very fast shifting to the renewable energy, but still can meet the scale, can meet the cost expectation compared with the traditional one. I think for China, 10 years ago, if you look, for me, it's the 2 biggest sectors from a green energy perspective development. One is the energy, the electricity production. The other is mobility. If you look 10 years ago, so renewable energy probably 2 times or 3 times high. But today it's about equal. I would say my personal belief, 10 years from now, renewable energy will be 5 times bigger than today, and probably 50% cost less. So China will really bid bet on the renewable energy and become the energy electricity surplus, rich countries. So it's built a fundamental infrastructure factor to support agriculture, but China is also import a lot of soybeans or all those kind of things, you can name it, because the province by province is so unbalanced. But with cheaper electricity, China can distribute all the natural resource, water, for example, to wherever the province lack of for water, and agriculture production will be also grow substantially over the next 10 years. So we can already follow China's ambitions on the 15th five-year plan. If anyone of you follow that one, the agriculture self-sufficient will be the must within the next 5 or 10 years. So that's the direction. It's happening. A personal strong belief, and the mobility is already proved. And 60% of today, China produced 20 million cars, and 60% electrical. And 5 years ago, it's probably less than 20. But I would say 5 years later, probably 80, 90% will be EV. And reduce the oil consumptions, cut oil consumption for the mobility at least by 60%. But the key, all this happens really depends on technology development. And foreign company like Umico, I think for us is we have no choice. We really need to be local in China, be part of the ecosystem, build a strong partnership with government stakeholders, be part of, it will be good, part of the regulation development influencer, and really work very closely with our customers, with other stakeholders, other supply chain to really co-develop this technology and be part of the journey.
Can I just add, Frank? I couldn't agree more. Right, I'm massively optimistic also about what's happening in China from the perspective of renewables and development. And even today, China has significant periods of excess renewable production, right? Just by the way of intermittency, which are perfect conditions to start creating, alternative fuels and green hydrogen, etc. So there's a lot of sort of I think power today in what's happening, as well as the direction of travel. Yeah.
But it's also important to notice that the fossil fuel will still be there for another 25, 30 years at least. And I think in Europe, definitely, we're also aiming a lot at the carbon capturing industry also. And I think that will go along. So that's why I said I'm not so afraid that there will be a shortage of energy. I think my biggest concern is that demand should be growing indeed, and to make sure that the investments can be done. And I think that's the largest hiccup at this moment.
Thanks. So yes, huge investment needs and cost challenges to be overcome with technologies that are available depending on the sectors. And if I may, I'd like to come back to perhaps one aspect of the questions that perhaps discuss in slightly more detail. It's the policy aspect. What do you think? What is the role of the government here? Of course, in China, the government has played an important role also through state-owned enterprises to kind of accelerate the transition through various support mechanisms, but also through the market, and now increasingly through the market in China. And price signals. China is moving towards the creation of it actually has a carbon pricing mechanisms. What do you think? What is the role of policy? There was a mention in the previous presentation on carbon taxes in the shipping industry. Do you see the need for carbon pricing mechanism? At what level? And is it possible to do it at the national level, or in your industry, do you need a global carbon taxation initiative, or is it possible to work based on regional partnerships? And then how to avoid the major problem of carbon leakage? Do you think if a carbon tax is introduced by some players who move faster, is there a need then for some carbon border adjustment mechanism like the EU is initiating? So on the policy side, what is your views?
I believe we need a policy. Without a policy, there will be less quick progress made, definitely. That's why we regret that what Anglo-Eastern also was saying about the IMO regulation. I think that was for us as a board not a nice message we got there. we as a port, we work already together with Rotterdam. We work also under the umbrella of the International Association of Ports and Harbors to, as much as possible, get the same systems in place for all these new fuels. But for example, Europe and ETS regulation for shipping is in place, but we start slowly seeing an invasion. And I can understand it from ship owners' perspective, of course. Large containers, companies who first call in North Africa, West Africa, or in countries like Turkey or the UK, in order to reduce their payment on ETS. This is a logical decision from their point. But it will bring less funds for Europe to Europe, and these funds are required to invest, to make the necessary investments. And that again is something that we as a port, we also try to convince Europe about that. Look, there is more. Don't be too naive. But a global approach would be the best one, of course. Definitely, I think that. But yeah, okay, we can dream, and there will be always exceptions. So that's. So then I think at least Europe should talk as one voice also.
I won't bore you with all the intricacies of aviation environmental policy, but maybe the way to think about it is aviation is an interesting case because it is one of the sort of first industries that did come up with an international framework. So it's called CORSIA. But I'd say for sustainable fuels in particular, the more effective tools we're seeing are some form of mandate policy. And what's quite interesting is there's few regions around the world now, EU, UK, the US, Singapore, we're advocating very strongly for policy in Hong Kong. We're seeing a few examples of what's working and what's not working so well. And basically there's kind of two buckets. There's carrots and sticks. So the US actually, ironically, has a carrot policy at the moment. So there's incentives for producing sustainable aviation fuel. That means today it is effectively, in most cases, cheapest to buy sustainable fuel from the US. But a lot of that feedstock comes from outside the US still. And then Europe has a stick policy where there's a mandate now in place as of this year in the EU and the UK, 2% of all fuel uplifted from the jurisdiction must be sustainable aviation fuel. But that creates a lot of very weird market dynamics because those costs are actually passed on to airlines from the fuel suppliers, and it gets, it's not a fair system, I'll say. Singapore has an interesting system where they basically introduced what they call a levy, and it's effectively just it's similar to a departure tax. Everyone just gets charged the same amount, every departing passenger out of Singapore, regardless of what airline you're flying, whether it's low cost, whether it's a full fare carrier, whether it's a long haul, short haul, there's different pricing for that. But fundamentally, it's an equal playing field. And then the government collects that money and they buy as much sustainable fuel as they can. And actually, we think that's a really fair model because it creates a demand signal and also creates an even playing field. So point being, there's a lot of policies that are in development and some are working better than others. But we're seeing them certainly spur on the development of sustainable aviation fuel.
Yeah, I think the government policy clearly is very critical to really for safeguard and also give the right direction for the industry. But I think everybody has a role to play, even a company like us, and we actively, in Europe, we actively working with EU to develop in the past the so-called automotive catalyst standard, EU5, you probably heard EU4, EU5, EU6. But also we work to really translate, because we are one of the key members for that committee, to really develop this EU emission catalyst standard. But also in China, we also very, very actively work with the regulators from China, because they know we are one of the key members, and we have a special know-how, and we are very open to share the testing recipe methodologies and working very closely with China regulators to really come out equivalent version China 5 or 6 to really improve the regulations to improve the car emission performance. Similar, we are doing right now is battery recycling government standard, and we are also UMICO as one of the leading members for the the program called the Battery Passport, in Europe called Battery Passport programs, to really you can track from day when you produce material all the way to the battery packaging. And when the battery become end of life, you can track to really get the battery returned to the original manufacturer or to the recyclers. But in China, we do the same. We also share this special knowledge. Now we are part of the committee as a key members for the China equivalent, the China program called Battery ID. So China, we don't call it Battery Passport. We come out with a new name, Battery ID program. I think this is just give you an example. It's not just sit and wait for the government to come out with something, then you respond. So I would say always everybody has a role to play to actively contribute to your know-how to become the ecosystem, to be part of that development, the right and also suitable government regulation to support this transition.
Okay. We can now shift our discussion to the technological aspects, if that's okay with you. Technology as a key enabler of greener supply chains. And I'd like to ask specifically in the aviation and perhaps also in the shipping sector, do you see sustainable fuels, electrification or retrofitting to be viable at scale? And how long do you think it will take to decarbonize your industry and to move to net zero? From a materials perspective, you mentioned the importance of recycling. Perhaps you can tell us more as to how innovation in terms of recycling is going to change the industry, green the supply chain, but also contribute to supply security.
I believe is it viable to go to the alternative fuels? I would say yes. What we've been doing in Port van Perbush with this multi-fuel project, we started with LNG, which is still a fossil fuel, but of course there is also bio-LNG available, and there we see indeed a larger demand. We are preparing the port now for methanol and make it available for ammonia also. Ammonia still needs a stricter regulative framework than the other ones. But we believe that we shall be ready in 2027. Then again, it's a matter of demand and offer. But I think when the demand is there, we see more and more vessels with a dual fuel, like Mr. Natja told already also, the more and more dual fuel demand. For us, it's difficult to know what will be the mix. And we see an hesitation for the time being for the last mile delivery. I think that's one of the issues there, of course, because it's uncertain on what will be the dominating fuel. But yes, I'm optimistic. I'm optimistic on that it's viable. The cost is, again, it's a cost issue again on all this. That's the most difficult thing.
And I think this is one of the biggest differences between shipping and aviation is fundamentally, even though it's not that easy, there's more options in shipping. In shipping, you got a big ship, and so there's more options of what you can put in there as an alternative fuel. In aviation, if I take our Hong Kong Brussels flight as an example, that's flown on a beautiful A350-900, carries about 280 passengers, it's about 285 tons, flies 12 hours at 900 kilometers an hour. There is simply not, there are not many alternatives in terms of fuels that have the energy density that allow you to do that and allow you to do that at scale. I used to work on building electric aircraft or developing electric aircraft, super fun space, a lot of super cool things happening, particularly because of development of battery technology in China, but you just can't crack the math on an electric aircraft flying any reasonable distance or any kind of large number of passengers. There'll always be a regional kind of context. And so really to decarbonize the bulk of aviation emissions, sustainable aviation fuels that can are liquid fuels that you can use in aircraft that sort of look similar to today are the key. And am I optimistic? Yes, from a technology perspective, there's fundamentally still, we're still in an emerging technology phase, right? So there's not enough investment, right? There's not enough investment at every stage of the chain, from R&D to actually building new plants to figuring out the financing at scale. So we, to give you a sense, last year, sustainable aviation fuel made up 0.3% of total jet fuel production. So we have a long way to go. But to me, that's just about that's about pointing humanity in the right direction. Like we know what we need to do. It's just about figuring out the right frameworks and incentives to develop and scale the industry. And I can talk a bit more about that, but.
Sorry, can I just ask for a question? Well, specifically, what is Cathay Pacific? I mean, what are the investments that if you could tell us more about the investments that Cathay Pacific is doing in this space?
Absolutely. So we have kind of a sort of today and tomorrow answer to that question.
Go ahead, please go ahead. We are running a bit out of time, but
sure.
Go ahead.
There's a today and tomorrow answer to that question. What we're doing today is, of course, ongoing fleet renewal. Cathay has always maintained a fairly young fleet, and so that's the best way to avoid emissions is to have a more efficient aircraft. We also work on scaling sustainable aviation fuel today, also in work with our corporate customers and partners and our shipping partners, and increasingly now also individual travelers. We have options where individual travelers can choose sustainable aviation fuel, and they do get rewarded and recognized for that. In terms of tomorrow, we are also making some strategic investments. We've invested alongside Breakthrough Energy Ventures, which is Bill Gates' climate tech fund, and a group of other airlines to invest in the next generation of sustainable aviation fuel technology. And we also have a co-investment partnership with Airbus that we announced, where the two of us will be working together to invest in new production, both in Asia and globally towards our 2030 targets and beyond.
Okay, I'm really sorry. Last time I checked the clock.
Yeah, me too.
It said 15 minutes. I don't know what happened. I think someone interfered there. So then we should move to the question.
Yeah, exactly. So if someone has any question, please go ahead for our panel. Yeah.
Thank you so much for the insightful discussion. Maybe I had a question that is more targeted toward Oli. We have heard about difficulty maybe from a technology point of view, and I know that your company, among other companies in Hong Kong, have the use of internal carbon pricing to try to decarbonize. So I was wondering to what extent this kind of more, let's say, finance or governance tool helps, given that at the same time you are facing technological difficulties to decarbonize. Thank you.
Thank you for the question and for remembering Oli. So that's a great question, and sort of two ways I can think about this is the investments that I mentioned are, that is quite new for Cathay to think about investing in the value chain this way. We have invested in sustainable aviation fuel before, but this is really concerted sort of strategic effort for us to help secure future supply and also do so in a commercially attractive and efficient manner. So that's kind of one. It's not directly a financing tool, but it's a new way for us to think about trying to crack the problem. To your point about internal carbon pricing, so we do have an internal carbon price of $100 a ton. And actually where that really helps is we have a lot of fuel efficiency measures. Fuel efficiency is this interesting case where if I find opportunities with my existing aircraft to operate them even at a fraction of a percent more efficiently, generally speaking, I save fuel, I save money, right? And I said fuel is 30 to 40% of any airline's operating cost. The internal carbon price still helps there on helping to close out some of the business cases, right? So often with those types of business cases, I have to make some kind of capital investment into the aircraft, some efficiency investment in the aircraft to get the return. And we use the internal carbon pricing a lot for those types of projects to look at how we can sort of better close the business case.
Thanks, Maxime, Professor. And hey, good afternoon, Oliver. And also question to you is because I understand that the Swear Archive and the Air China, they really care about the reputation for the safety. And you mentioned a couple of times fuel efficiency. How do you balance the fuel efficiency and safety from the air aviation point of view? Thank you.
Thank you for that question. And yeah, someone said it just here, safety first, always safety first. So there's no, but I do mean that seriously, like in one case, in some respect, that actually tempers some of the development in aviation. If I look at the more extreme cases, electric aviation, hydrogen aircraft, the developments of those technologies are, for some spectators would say they're slow. And they're slow because before you put a passenger in any form of new technology, you want a significant testing and certification program behind that. Generally, those technologies will mature through cargo first before they reach passenger. But so that is the absolute sort of underlying foundation stone. When we look at fuel efficiency measures, we have to look at those incrementally and carefully as well. And sustainable aviation fuel is regulated not only by global standards, so the ASTM and other equivalent European and global standards, and that's tested at multiple points along the value chain to ensure that it's equivalent to jet fuel. Yeah.
So one last question.
Yes, sorry. One more question is, we always listen to these questions in relation to, we take the past and we continue linearly. Nobody ever talks about changing the model towards, hey, if it's more expensive, then it should be priced to reflect this, even though it translates into less demand. Why is that? I mean, isn't that part of the answer as well? I mean, is it sustainable to have airline that sells you tickets for £16? I mean, does that make any sense at all? When we know it's not even the cost of fuel?
Do you want to answer? I can answer the aviation, but I can answer all the questions. Sure. Luckily, we don't sell tickets for £16. But no, but your point absolutely holds. Demand management needs to be part of the larger tool that we think about to decarbonize the industry for sure. And here COVID did teach us something, right? It taught us that we may not need to go to Bangkok for that 1 hour meeting and return on the same day. So I think we have seen some structural changes. Of course, demand is still very high, both in leisure and business travel, right? And I think that also speaks to the benefits that aviation drives. Does this need to be priced into tickets? In some way, if you look at, for example, European regulation, the answer is it already is to some respect. Mandates, costs from the EU ETS, those will flow through in some way into pricing. But I think what we're looking at very carefully in the industry is still allowing some form of growth while also maturing technologies. If I give one last view to this, is my personal view. So I'm half Austrian, half Ugandan. The African continent today represents 2% of global air traffic, even though it is a continent of 1.3 billion people. As soon as aviation markets liberalize in Africa, that'll be the next continent you see AirAsia, Ryanair, EasyJet, Southwest explode, and to some degree, and to a very high degree, I want to see that happen. I want to see that continent benefit from aviation as well. So to me, the reason I work in sustainable aviation is trying to square off the growth that the industry can drive with also trying to figure out a way to do it in a more sustainable way.
All right.
Go ahead, please.
But I think it's similar in the shipping. Ultimately, the consumer will have to pay the additional cost. And I think regulation can help, and then the cost will be higher. And ultimately, then the products are not willing or not able to pay, they will no longer be shipped or will be no longer there. I think that's a consequence of it. But that's maybe not wrong and all this. But of course, growth, yeah, we still see more and more demand, more and more growth, and more. That's reality. In the container market, on an annual basis, it's still 4% growth of containers that are moved from one part to the other. So that's reality still, of course.
Thank you so much for this great panel. We are not going to have a small 20 minutes break, so let's have a coffee break. Thank you.
Sorry, I'm so sorry we couldn't go. Yeah, that's all. Yeah, thanks. Cut the time too. Yeah, something happened. I was a little sure, so 50 minutes. Yeah, it's free. Let me make sense of short. Yeah. Hey, how's it going, man? Thanks for shouting out. Hi. Theoretically, like, that'll scale the development. We are not Well, yeah, you have the shipping corridors here, but no one is actually. Yeah, that's right. What was worked on it. Okay, the reason for 100% is to make progress. Incremental progress. I think we as our view has always been let's be and if it's 5-10%, and don't think that's like the best way possible, like no, start here in the head. But might come from whatever it is. It's maybe not the most important thing. Yeah. Yeah. But we have an own full electric vehicle. So we just need to be better, right? Yeah, we have one on methanol, we have one on hydrogen, we have one on full electric. There are some container lines. Yeah, but then they go But on a container, we tried on the containers, and in the beginning we were hopeful that they would do, but like no one is willing to pay. No. They made an own business model out of the container lines, and they will not be offsetting, and they will never. They will offset it. The partners will work, but they will not premium, and they will fix it. Actually, so that's one of the roads. That's why I think it's going to be on cars. There's one in Shanghai road. Shanghai where we are Europe. Thank you.
Testing.
We're gonna go. Start. Yeah. I'm sorry. I'm gonna ask you to please go back to your seats. We are going to start for our last session of the day, where we are going to talk a little more about governments and NGOs. So I think that we have our session chair here, Nicolas Nijssen from the University of Liège, who is going to help us chairing this session. And the first speaker should be, if I'm not wrong, one of my colleagues, Xipeng. Yeah, take your time. Xipeng Yan, who is a professor of strategy in our university at HKU, and so he's going to tell us about his paper. Xipeng, the floor is yours. Do you want this one?
Yeah. Hello, can everyone hear me? All right, is my slides up? Great. So thank you all for being here. I'm really delighted to have this honor and privilege to present this paper to all of you here. I know it's getting late in the afternoon. Hopefully you are still awake. So this is a paper about climate litigation and trying to see it from a carbon emission perspective. It's a joint work with Li Zhen, who's also a postdoc fellow at the Institute, and then Zhang Zhou, who's a doctoral student of mine. So without further ado, let me just dive into it. I don't know if you've heard about the phenomenon climate litigation, just in case anyone heard about this phenomenon before, climate litigation. You might have heard about environmental litigations, firms might pollute, and then you might file, litigation against them. But specific about climate litigation, this is a fairly new phenomenon. The activists find out that there's an actual way, if we use legal means, to make companies accountable for their potential misbehavior in terms of emitting carbons that could cause community damages. As you can see, especially after Paris Agreement, the number of such litigation has increased a lot. As you can see, so there's a kind of difference between the US and non-US. And these are the picture for the corporate defendants, right? You can also file climate litigation against governments. That's also possible. And obviously, this kind of activists will primarily target those oil and refinery industries as a primary targets. But as you can see, they have over time been targeting a wide range of different companies across different industries as well, right? So the kind of risk, if you see that as a form of risk, is actually spread across different kind of firms. So basically, I just want to show you and convince you, at least, this is an emerging phenomenon. This might imply some significance for a lot of corporate decision makers, as some of the reports have been suggesting. There's a climate risk liability. We currently see the risk iceberg, but there might be a real hazard of which only a minor part is currently visible to all of us. And there's a Paul Pullman, the former CEO for Unilever, suggesting that by ignoring those legal risks, boards are playing with fire, right? So how do we make sense of this phenomenon, since it's such a novel and unprecedented phenomenon? If we look at the literature, you will see a very mixed picture, which might be surprising because all of us trying to understand. There's a very inconsistent evidence on the actual impact of climate litigation on firm responses. Some be suggesting overall there's actually no effect whatsoever. Like these activists are maybe simply wasting their time. The corporates simply ignore your demands. But if we look closer into some of the anecdotes, you also see very interesting pattern, because for some of the cases, you seem to achieve some objectives. There are facilities have been shutting down because of litigation cases, even though those cases have yet to be concluded. But there are also cases that's even more puzzling. Some of the firms, after being litigated, they become even outrageously increasing their emissions. So we are really looking at such diversity of phenomena across different cases, across different firms, and trying to make sense. What's really going on? Is the activist doing something wrong here, or is the companies reacting in a way that we didn't know? I think especially in this literature, maybe one of the reasons we didn't get a clear picture is that we tend to only look at the litigators and defendants, the pair that has been directly involved in this relationship. Well, for those kind of activism, the impact is never limited to the direct targets only. It often has some very strong spillover effects, especially in the prior literature on social movements, right? Because social movements, you don't think they are really have a direct impact on the, let's say, sales. It's not going to cut down your revenues directly, but they often have very indirect impact on other stakeholders who then exert pressures on the firm decision making. So, and also there's a bit of technical jargon here for those of you who are less in the academic world. Essentially, the activists don't target the firms randomly, right? They don't roll dice and see, I'm gonna file litigation this company. Maybe I'll file litigation against the company because it looks weak. Maybe it's more likely to concede to my demands. Maybe there are a lot of characteristics, but I might be predicting the relationship, the matching between me as an activist and the company being chosen, right? So it'll be really hard from an econometric point of view or a causal point of view to understand a clean effect of the impact of climate litigations. So in case you are still awake, I'm giving you a one-slide summary of what our paper is about. So our research question is that how do firms actually adjust their emission levels when their peer corporations in the same jurisdiction, which means that this kind of litigation risk can spread because they share the same underlying legal structure here. Once their peer firms are being targeted in climate litigation, especially for the first time, because we want to capture this highest level of uncertainty. So our answer is, as a lot of the answer, it always depends, but then it depends on one thing, is how you make those litigation claims. So in any kind of litigation, including climate litigation, there's an important element is what kind of needs and demands you're making. Do you want them to pay you some compensations? Or this is what we call compensation-based litigation relief. Or what we call technically injunctive reliefs, meaning that please stop killing, please stop emitting, please shut down your facilities. These are very divergent categories of the relief requests. So quickly, we use an organization theory, which is institutional logic perspective, and you can see that through two lenses. One is that if the litigations exclusively seek injunctive reliefs, meaning that stop emitting, shut down the facilities, they will see that as more of a serious effort. These are not easy activists to deal with. We will actually think about reducing our emission. Whereas if somehow, still totally legitimate, you are polluting the environment, you guys need to pay. You need to pay for my litigation costs, and you need to pay for my lawyers' fees, all sorts of that. We will see it as from a financial logic lens, seeing, oh, these guys, they might be partially for climate justice, but maybe also importantly, they are looking for some sort of financial rewards or financial compensation. Whereas if you actually present a mixed case, where you're not only asking for actions, but also asking for financial compensation, they become inactive. They don't know how to react, because these are two competing thoughts at the same time. So they hesitate and want to take a moment of hesitation, don't want to act upon that. So we have this three-layer tier predictions. We also test the mechanism. We're trying to see how they achieve those emission changes. It is primarily through shifting the energy use. To preview the findings, basically they don't adjust the production level. Because one way to increase or decrease the carbon emissions just to adjust the production, they don't. We also check if they have been shifting the production to somewhere else, right? That's also very smart, convenient, but a sneaky way of reducing carbon emissions. We didn't find evidence in support of that. You might also wonder, maybe it is because the threat of the litigation, because some of the litigation may be more successful, more threatening than the others. At least we'll check the final outcomes. Actually, for the one that reduce carbon emissions, there's more failures than the one that on the financial ones, right? The actually financial ones, one of the cases actually won the favor of the judge. All right, just to give it a quick sense of how these things might look like, right? Because that's typical in all sorts of litigations. You can sort of only have these two. Either you're asking for money or asking for some actions. So this is one example where there's pure monetary relief. You can see we're highlighting the terms like costs. Please pay me back for all of these things. Whereas this is a pure injunctive relief. Please ceasing all discharges. Please eliminate the endangerment to health. Implement this, implement that, right? So these are injunctive reliefs. And if you look at the key terms, they will also spell out in very different fashions. And then the way we're trying to understand is that firms, especially when they face unprecedented first time happening climate litigations, they usually don't have a lot of precedent to draw from. So they have to rely on what they already know, right, in face of uncertainty. In this sector, there are usually two broad ways you can think about this issue. One is that there are two. One is you can see it in very extreme sense, is that everything is sort of financial, can be monetized. So making friends is, social capital, receiving education is human capital. You can apply similar logic, which is a very valid perspective. But in this context, maybe that primarily not for climate justice, but to get a sort of compensation for monetary purposes. The other one will be more closer to the core activist idea, which is that it should be about achieving the climate justice regardless of the cost, right? Both are very extreme, but these are kind of pure forms, the lenses you can help you think about these issues. So, and then because I don't know which exact logic you are taking in order to litigate me, so I'll be thinking, all right, I'm gonna look at the linguistic cues from the litigation relief request you sent to me, and then make a judgment, right? So I'll be looking at those words, which then shows the importance of language here. And based on that, I'll make a judgment, okay, you guys are actually coming from this perspective, and let me react accordingly, right? So this is the basic idea of that. So I have laid out these two logics, and I think the key point here. So the perceived litigated purpose, on the one hand, it will be climate justice. On the other hand, maybe more financial. Then the appropriate response in order to pacify or address these two kinds of activists will be very different. One is possible, actually, I can buy you out. As long as I pay you sort of enough, I can get away with the problem. The other is that, well, maybe these people are very serious, and they probably have very prolonged engagement in a very confrontational way with me. And I might have to think about more substantial ways to deal with them, right? So then, you might wonder, really? Is that kind of, especially on the financial logic, you might wonder, like, this is a buy to pollute kind of idea? Is that really possible? So we also consult different perception in this field, like some of the lawsuits seek to monetize climate change, but not really providing solutions. And there's even some form of third-party litigation finance, because some of the NGOs really couldn't be providing enough funding, and actually by litigating the corporations, you might get a compensation and it provides an alternative source of funding. So from looking at this, trying to put you in different boxes, right? Even though they don't have a lot of sophisticated understanding of what these NGOs are really looking for. There's also three important assumptions I want to tell you, because these are important, let's say, for causal identification. First is that a lot of these climate litigation came for the first time. So many lawyers, attorneys, when they formulate those things, they're not being very strategic. Because if they are being very, very strategic, then I might be capturing some other issue as well, right? So this is more for those of you who want sanity in the methodology. I think that might be an important point. Second is that the litigation risk is not trivial. I hope I convince you to some extent. Finally, the spillover is possible, especially within the same jurisdiction. Because for the attorneys, knowing that litigating one company in this region is possible makes me very happy, because I can use the same tactic to attack another company, because I can simply reuse the same argument, similar documents for the next target. So you probably have heard, I've explained the main logic here. If there's only injunctive seeking litigation, I see you as more of a serious activist. I activate this climate logic, and then I have this incentive to actually adjust my operations and cut my emissions so that to preempt future risks. Whereas if you are compensation seeking only, right? So I see you through this financial logic. And if you don't mind, I need to fly a little bit. So the argument is there is I no need to prepare, like I need to financially prepare for potential compensations. And one convenient way of doing that is actually reducing my energy costs. Later in the mechanism test, we found out they switched to more cheaper but dirtier energy, such as coal, to achieve that goal. So financially, they are better off. And then I get this kind of reserve to deal with those litigators. And I actually can bargain with them because they might ask for 1 million at the beginning. How about half, right? I'm still paying for you. Very quickly, just in the interest of time, this one, I hope it is also more straightforward than the two previous one, which is that if you present two queues at the same time, there's a bit of mix, and then company don't know exactly how to respond. So apologies, I have to quickly fly here. Basically, all the data we use are publicly available. Not only litigations, but also the claims and languages they use. And also we look at US facilities where we have information for carbon emissions. Let me make sure I show you this one because I think this is important. So this is the different types. As you can see, actually the compensation-only litigation have declined over time. Probably the activists sort of figure out, it doesn't seem to work the way we want it. This is how we do it. For example, there's one litigation case, we look within the jurisdiction and want to find the proper control group. We know the treatment because there'll be other facilities in the same jurisdiction. We want the proper control group, so we look at the border of the jurisdiction that is bordering with our treatment groups. So it will look something like this, that share the border but not in the same jurisdiction. Let me fly here if you don't mind. This is some of the key cases we selected. I just want to point out the case outcomes. There's nothing in favor, like one particular case is more threatening than the others. A lot of them have been dismissed. And the one that has more carbon emission, actually the activists won the case. These are panel level, these are event studies you can see, which are consistent with our predictions. And let me go through some of the major baseline points. And I do want to show you perhaps especially, some of the alternative explanation, right? So it's really hard to get a very clean estimate, for example, like where there's a pollution outsourcing. But we've been adopting some of the published ways of doing that because some industries are by nature mobile, some are immobile, which means very hard for them to outsource the pollutions to other different locations. That's one thing being looking at, and we got some confirmatory results. I know it's a bit fast. Please ask me afterwards. The other thing is the production volume, which is very important. We look at this chemical called VOC. This one is highly consistent with the production volumes. So if you are trying to reduce and increase carbon emission through adjusting production level, then it should also spell here, which we don't find evidence on, which again supports our claim that it's actually more changing the energy sources. Let me try to go to this energy one, which is energy. This is a full sample. By the way, the full sample is actually consistent with the prior literature. They found a no effect. We also find a no effect if we combine everything together. We want to show that this known effect might be misleading because it depends on the kind of litigation claims you make. And actually that has masked the real effects behind it too. And the message for the activist, you have to think carefully about the claims you make to the companies. Maybe saw the message to the company as well, right? Maybe want to think beyond those pure and simplistic logic and think about what the activists are truly looking for. And policy, maybe more for the activists on the regulation side, maybe additional legal tools that they can use to make it a more of a stronger collaborative community. Thank you.
Thank you so much, Xipeng. Is there any question? Yeah, please go ahead.
Thank you for your presentation. Very interesting. I had a question on the spillover effects. Yeah. I'm not sure that I understand exactly why you're limiting this to the same jurisdictions. Just for an example, if we take in 2017 the Dieselgate with Volkswagen, we have seen that actually it rapidly went viral and global. So why not considering when you are attacking large corporates, large firms, very well known, that possibly you could actually also have an effect outside of the jurisdiction?
I think this is a totally valid question. Thank you for that. So some other previous scholars have been primarily looking at industry spillover, right? So if you're targeting Volkswagen or Royal Dutch Shell, that's a very high profile one. Actually, the activists won as well. We actually did that from the industry point of view. We didn't find a fact. I think here, strictly speaking, I think this is primarily because we want to look at the legal risk spillover. In this case, it could involve other things such as reputation or other kind of operational business level considerations. So this is a cleaner, but I totally agree with you, and this might deserve a separate design or study. Yeah.
Thank you.
Any other question? Oh yeah, go ahead. Actually, that's easier.
Yeah, so in your earlier example, if I remember correctly, the effect that you find for the company react to its own climate litigation could be positive or negative.
So the average effect other people find is 0.
So my question is, if they do not react to their own litigation, why do you find that they react to the peers' litigation? It seems more remote to me. And also, they pay attention not only to the litigation, but also to the details of the litigation. So how would you convince me that they pay that much attention?
So first, all these litigation documents are public. So that's one thing. Of course, I don't have, let's say, attentional data to tell you that those people are, putting their eyes on I don't have that level of evidence. But spillover, at least in the social movement literature sense, that has been pretty well documented. Firms do observe what the peer firms are doing, especially similar locations, similar industries. So I'm trying to say I indeed building on this assumption. Do you have any suggestion we can further strengthen this assumption a little bit?
Actually, just like the first question, I also think if they pay attention, maybe they do not just pay attention to the litigation that happens in the same area. It might be some very big event that all people pay attention, but for others, maybe nobody pay attention.
But it's true, a lot of other studies, they are not like we look at whether you're being litigated in first place. A lot of studies look at the final court rulings. That one, it's also clear evidence that they be looking at each other very, very closely.
Yeah, and maybe look at the outcome, like if the litigation actually happens and there be a big fine, maybe the peer will pay more attention.
We can do that if there's a degree differences.
Right.
Yeah, thank you.
Thank you.
All right, thank you so much. Thank you, Xipeng. That was a great presentation. Now we are going to have Professor Jim Goldman from McGill University, who is going to tell us about
government contracts and corporate social responsibility.
All right. Hi, everyone. Thank you very much for the opportunity to talk about this here. I'm very happy to be here. So I'm going to talk about the role of social value in contracting, and this is joint work with Nick Ganchev from the University of Virginia and Shu Zhang at the University of Exeter. Okay, so the starting point of this paper from academic research perspective is the observation that we have substantial research documenting how investors monitor, engage, and potentially discipline firms for poor environmental, social, so negative environmental, social performance. But we know somewhat little about how environmental and social consideration may influence wholesale contracts between wholesale entities. And so what we have in mind, so this is the type of things that we would like to explore here. And the type of questions that we have in mind and that we would like to progress on is how do these ENS factors affect contract terms? Do they affect contract terms? And if they do, how? And can contracts drive or tilt sustainability practices in businesses without explicitly embedding sustainability clauses in these contracts? Now, from an academic research perspective, these are challenging research to get at for several reasons, but one important reason is that typically contracts between firms, these wholesale contracts between private entities are not public, they are not observable. And so what we do here is that we resort to a slightly different setting where we are going to focus on government procurement contracts, where we are going to be able to have a lot of information on contracts for goods and services. So I'm going to talk a little bit more later on about what kind of contracts we are looking at, where a firm where the government is going to contract with the firm. Now, in doing that, not only we will be able to hopefully say something about, whether or not these sustainability, whether or not these ENS incidents, these ENS considerations are embedded in these, affect these contract terms, but also by looking at these government contracts, we look at a setting that is also very relevant for public policy, and maybe we can better gauge whether government can also influence business practices on a sustainability basis, not only directly through regulations, as we know, but also through more market-based mechanisms and using the huge purchasing power that governments have when they basically contract with firms and purchase goods and services. So this is the idea. And so to do this, we gathered 4 million procurement contract in the United States for the period between 2008 and 2020, which represent over $300 billion in value. So all this data is publicly available. It's quite rich in terms of the type of terms that we observe for these contracts. We know what kind of product and services the contract is about. We know the value of the contract. We know the degree with which the contract was competed. We know how many bids were put for each particular contract. We also have some information about the incentive features and the performance features that the contract has, and so on. And so all these things are going to be helpful for us when we try to compare different, when we try to compare contracts that are attributed to different firms.
So not only we observe the terms of the contracts at initiation, but we are also able to track renegotiations during the life of the contracts. And so we see whether or not contracts are modified during their life and in which direction, in the sense that we see whether the contracts amounts are extended or reduced, whether the duration of the contracts are extended or reduced, etc., as well as the reasons for the modification. And so this is going to allow us to look at what happens to these modifications when there are some environmental and social concerns that suddenly happen during the life of the contract. So let me tell you very briefly what we do. So what we do is relatively simple in this paper. We will study how government contractors' environmental and social performance, and we will focus on their negative performance, the occurrence of incidents around these contract awards, and we will study how these, what I will call incident, affects contracting outcomes between the firm and the government. And we will do that studying contracts that do not have explicit sustainability clauses in them, right? So what we are studying is what I would call very regular contracts, and I will give you some examples, but you should not think of those as contracts that are special in any ways or that are contracts that are explicitly used by a government to promote sustainability practices. This is not the case. These are very regular type of contracts. Okay, so what we will do is that we will compare these contract outcomes we'll try to compare contracts that are very similar on many characteristics. We have the same empirical challenge that the previous paper. The incidents that we are going to study do not necessarily happen for random reasons. So what's going to be very important in our study is to have tight comparisons. We will want to compare contracts that are very, very similar, but different in the sense that one was awarded to a firm that had some ENS issues in the past, and the other one was not. So we will do very tight comparison, and we will exploit the richness of the data that I just described to try to do these comparisons as tightly as possible. And I will not go into the details here, but we use alternative econometric methods to do this. Okay, so in terms of the results, we'll document that past negative incidents will affect the terms of new contracts. So for firms that get new contracts but have experienced incidents in the past, in the year before, we will show that these new contracts are 11 to 13% smaller, in the sense that the amounts are reduced, and these contracts have also shorter durations. We will then explore how this effect varies, and guided by theory, we will pay particular attention to the type of products, right? So we will look at contracts that are for products that are generally more competitive, in the sense that products for which more firms generally bid, as well as contracts for products that are more or less differentiated. So these two things are, of course, tightly related. Products that are more standardized tend to be more competed on. And so what we will find is that we'll find stronger effects in the sense of greater reduction in amounts and duration for contracts that are awarded in less competitive markets and for differentiated products. And the idea here is that for this type of contracts, for this type of products, it's harder for the government to switch contractors. And so these are contracts for which it's going to be more important to exert monitoring and discipline on the contract term. This is what we call the monitoring channel, if you like. In addition, we will document stronger effects for contracts by government agencies that have better procurement resources. So if the channel works through some sort of monitoring channel, you would expect agencies that pay attention more or that have better capacities to track what's happening to the contracts. And this is what we find. We also look at, as I will explain, these contracts do not have explicit sustainability clauses embedded in them, but the way contracts are awarded allows agencies to consider, that's something important, to consider factors that are non-price based, right? So there is a scope within the way agencies are allocating these contracts to consider non-price factors. And we will look also at our effects around a legal ruling that strengthened the ability of agencies to consider these non-price factors in the allocation of contracts, and will again find stronger effect for better resourced agencies after this ruling. So everything I said so far was for the allocation of new contracts, but what we will also do is to look at the renegotiations of existing contracts. And so what we do here is that we look at contracts that have been awarded and then something happened to the contractor during the life of the contract. And then what we will do here is that we will examine what does this do, what does the occurrence of the incident do to the probability that the contracts get modified, and what does it do to how the contracts are modified. We will see that when an incident happens during the life of the contracts, that contract becomes less likely to be modified further down the line. And when it gets modified, the modification results in lower amounts and lower duration. And then finally, we will not only document that these procurement practices might tilt the contract terms, but we also try to document some broader economic implications of these procurement practices. And so we'll look at some agency level spillovers. I'll show you, hopefully I will have time, that for agencies that have awarded contracts to a greater fraction of contractors that have experienced incidents, these agencies become, if you like, more careful. The new contracts that they will allocate will be more likely to be awarded to contractors with which they are familiar, so they are taking less risk, if you like. And again, they will tend to be more careful and reduce the amounts and the durations of these contracts. We'll also look at the implications for the government contractors themselves. And so this is interesting because at that point, we will compare government contractors with other type of firms, so firms that are only active in the private markets. So the comparisons that we'll do here are slightly different because we will compare firms that both experience these incidents, but I will show you that government contractors, if you like, suffer more from these incidents than other firms. So that, that point to the direction of the government playing some sort of special role in the product markets. And then finally, but most likely I will not have time to show you this, we'll look at, for the government contractors that are publicly listed on the stock market, we'll look at the stock price reactions, again comparing government contractors and other private. Okay, I don't have a lot to say about the data source for public procurement, other than it's publicly available. You can download it from the website. It's fairly comprehensive. There are many government agencies, 74 government agencies, close to 200 sub-agencies. And as I said, something that's important is the fact that these contracts are
do not have sustainability clauses embedded in them, and also that they are available across a wide variety of goods and services. So it is not the case that we are only looking at defense contracts for fighter jets or this kind of contracts that you may have in mind, but it turns out that the government buys a wide range of products and services. So to shift your prior a little bit, we'll be looking at contracts for medical devices, telecommunications. There are a lot of professional services contracts, IT consulting, some R&D services, some manufacturing goods, et cetera, et cetera. There are many different types of contracts. The government will buy shoes for the military. So there are many goods and services that, that the government purchases, but that you would also find in purely private transactions. Okay, so that's for the contract part. On the incident part, so the idea of the paper is going to study this contracting outcome after the realization of what we call ENS incidents. So these are, if you like, some negative news about the environmental or social policies or practices of firms. So this data comes from RepRisk, a data set that was used in another paper that was presented this morning. So that's a fairly standard data set. What I would like to point out here is that when you think about these incidents, do not think about major oil spill like the deep water, like the what was the name? The oil spill in out of Louisiana. Most of those incidents are much more minor than this, right? So these are news events that may affect the company with which the government has to which the government has granted a contract. So here I have some example in the environmental space about one bank financing mountaintop removal for mining. There's another one here about deforestation. There are also many incidents related to labor practices or child labor. This is the type of news that are mostly contained in this data set. Okay, so in terms of the actual results, so this is the first baseline result that we document. That after a firm has experienced this type of incident in the previous year, the contracts that it gets in the next year, so that's at the contract level, this is conditional on the firm getting a new contract, are somewhat smaller, between 11 and 13% smaller in terms of amount, and the contracts tend also to be shorter. I don't know why I put this in a little, but what you see on the bottom right of the slide here are the dynamic effect of these estimates. And so what you tend to see is that you don't observe much on the period before the incidents, which is represented by 0 here. It's relatively flat. And then you see this drop in contracts amount in the following years. These are the split by the competition of the market and the intensity of competition for contracts related to that product. And you see, we split here the contracts in 3 bins according to the tercile of our measure of competition. And you see that this effect is monotonically decreasing as competition is increasing. So you see that more strongly for the amounts. The results for duration goes in the same direction, but the estimates are not as precise. So the idea here is that the effects that I was talking about are again stronger in environment where competition is reduced, and as I was saying, for products that are more differentiated. What else? So this is the role of procurement resources. As I told you, these effects that what you see highlighted in red here are stronger for agencies that have better resources when measured by the number of procurement officers that are employed on a full-time basis at the agency. So the interpretation of these results is that to impose this sort of discipline, the agency needs to pay attention. To pay attention, it needs to have the resources. And so agencies controlling for size, so on a relative basis, have more procurement officers, tend to have a stronger effect. Let me skip over the legal ruling. These are the results on modification. As I was telling you, when an incident takes place during the life of the contract, that contract sees a lower probability of being modified. So about 30% of contracts are modified, and this probability goes down when an incident happens during the life of this contract. So I don't have a lot of time to tell you about the economic implications, but in the paper we document these things as well, and this is, I think, an interesting aspect of the paper. As I told you during the preview of the results, these incidents have also, so when a given firm experiences the incident, this also has consequences for other firms that are going to contract with the same agencies. This is because agencies that experience a greater fraction of these incidents in terms of the past contracts that they have awarded will, there will be changes in the contract term that are associated with this fraction of incidents. They will be more likely to go with contractors with whom they are familiar, and they will generally allocate smaller and shorter contracts. The government may play a special role in the sense that government contractors suffer more than other firms from these incidents. So this was, I guess, the end was quite fast, but this was from a preview of the results that we have. Firms with recent incidents faced adverse outcome in newly obtained and existing contracts. They see smaller amounts, shorter contracts. They have a lower probability of modification. And so, overall, when you reflect on these results, you may think that procurement contracting, at least with the government, can shape or at least tilt business practices, even without having these clauses explicitly mentioned in the contract. So this provides some sort of middle ground between regulation and market mechanism.
Thank you. Thank you so much, Jim. Thank you. So in the interest of time, we are going to move to the next presentation right away. And please leave your question for the beer tasting that we'll have afterwards. All right. Oh, yes, and please let me introduce Cara van Steenkiezen, who is a professor at the University of Sydney and is going to tell us about the strategic side of charity and its role in M&As and in the M&A market. Please welcome Cara.
All right, thank you. Okay, so this is a paper about charity. Right. Now, the best way to illustrate what it is exactly that I'm doing in this paper is to show you an example. So some of you might be familiar with the merger deal between DuPont and Dow Chemical in 2015. It was a massive deal. Two major chemical companies announced that they would merge on December 11 of 2015. The deal was worth more than $130 billion. Now, one of these two companies, Dow Chemical, they operate a corporate foundation. And now a couple of interesting patterns emerge when you look at the donations made by the Dow Foundation in the years prior to this takeover or merger. For example, they donated $750,000 to Change the Equation, which was a charity focused on encouraging STEM education in primary schools. They donated $100,000 to Tufts University, $500,000 to various charities in Wilmington, in Delaware, where Dow does not operate, and more than $1.5 million to various charities in Harris County and Middlesex County, both areas where Dow did not operate at that point in time. Now, what all of these recipients have in common is that they have some link to DuPont. So, for example, the CEO at the time of DuPont, she was a board member and a trustee at both Change the Equation and at Tufts University. It also happens to be the case that DuPont was headquartered in Wilmington. So a lot of its board members and important shareholders reside in that area and are active in local charities in that area. DuPont also operates major facilities in Pasadena, which was in Harris County, and in Sayreville in Middlesex County. And after 2017, when the deal was officially completed, the Dow Foundation made no more donations to any charities in or near Wilmington, where DuPont was headquartered. So all of this indicates that these donations made by the Dow Foundation had probably some relation to its decision to merge with DuPont. So that is the sort of relation that I want to investigate in this paper. Now, first of all, why do I look at charity in the first place? Now, charity by corporations is a rapidly growing business. In the US alone, it amounted to more than $40 billion last year. And it's one of the fastest growing forms of philanthropy. And so in this paper, I will consider charitable giving by corporations as a sort of non-market strategy to manage their relations with stakeholders. Now, how could charity affect stakeholder relations? There's two main mechanisms that I will investigate. On the one hand, there's an exchange of benefits mechanism, where donations to charities affiliated with stakeholders create a quid pro quo to elicit some reciprocal behavior. And there's also a reputational benefit story, right? So by donating, I demonstrate some corporate citizenship, and it establishes a sense of purpose and commitment with stakeholders such as your employees. And I will argue that these incentives will be particularly relevant around corporate decisions and investments that rely on support from stakeholders for performance. And so I'll investigate all of this in the context of M&As. So I use M&As as a setting to investigate the use of charity as a stakeholder relations management strategy. Now, why do I look at M&As? M&As, they have a very large impact on both the financial and professional interests of target managers, target shareholders, and target employees, all of whom can affect a deal's negotiation and integration process. So I'll investigate two main questions. I investigate whether a firm's donations are related to their takeover activity in the first place, and then I look at whether these can improve the deal's outcomes. All right, how do I investigate this? I look at a sample of about 6,000 takeover deals made by foundation-owning US acquiring firms. Combined, these made over 500,000 donations over a 15-year time period. And I will investigate this at the county level. So I will look at counties in which the target operates or has affiliated charities. And so these deals, they affected more than 200,000 target establishments spread across 3,000 counties in the US. So my analysis is done at the deal county year level. So I'll investigate whether a firm donates to a given county at a given point in time. And I will compare whether these donations differ based on whether the target operates in that county or whether it has affiliated charities in that county. So those are the treated counties. And I will compare that to a set of control counties. Now, in my main analysis, the control counties will be those in which pseudo-target firms operate or have affiliated charities. And so pseudo-target firms are firms that were not targeted in a takeover, but that operate in the same industry, are headquartered in the same state, and are relatively similar in terms of size compared to the actual target. I have some additional tests using different control samples. I can look at all of the other counties in the same state as where the target operates, but in which the target has no establishments. And I can look at all counties in which the acquiring firm operates prior to the takeover, but in which the target does not operate. But in the main analysis, I'll mainly focus on those pseudo-target firms. So this is the main specification that I'm using. The outcome variable is the natural logarithm of the total amount that a firm donates to a county at a given point in time. And I regress that on indicators for the time periods before and after a takeover deal, comparing donations to treated target counties versus control counties. And so my main identification in this sort of specification comes from highly granular fixed effects that will absorb a lot of potential underlying mechanisms of variables that could drive these relations, but that are not related to the takeover deal. So for example, I can account for all variables at the firm year level. So these are firm characteristics like financial constraints that could drive a firm's resources and decisions to donate. I can control for county by year fixed effects, which absorb all changes at the county level that could affect the firm's decision to donate, like changes in GDP or local policies. And I can control for firm by county fixed effects. And so these absorb the importance of a specific county to the acquiring firm. So I will include all of that, and then I will look at how the acquiring firm's donations change prior to a takeover and after a takeover. No. Where do I point this? Oh, no. Where is the laptop actually? Oh, there. Ah, there we go. All right, so these are the main results. If you remember nothing else from this presentation, remember this. So what I'm plotting here is the acquiring firm's donations to target counties versus control counties relative to the deal's announcement. And so what you can see is that there is a significant increase in the acquiring firm's donations in the years prior to the deal. So in the 2 years prior to the deal, the acquirer's donations pick up, and then they revert back to baseline, indicating that there may be some relation between what's going on here. And so this is the outcome of that specification I showed you earlier. I look at both the likelihood that a firm donates to a given county in the first column and the amount that it donates to a county. And so at baseline, I find that firms are 0.8% more likely to donate and donate 6% more prior to a deal announcement, and that's in the 2 years preceding a deal announcement, to treated counties versus control counties. Now, of course, you could argue 0.8%. What is that really? Or 6% in terms of donated amount. So that represents about a 20% increase relative to the unconditional likelihood of donating, because at baseline, firms are very unlikely to donate to any given county at any given point in time. And in monetary terms, it reflects about $20,000. Now, again, you could argue, what's $20,000 to a multi-million-dollar corporation, right? Now, one thing to keep in mind here is the recipients of these donations, they are your local neighborhood charities. They are your local primary schools, your sports clubs, youth work, for whom $20,000 is a not insignificant amount of money. And also, this is an average effect. I'll come back to this in a couple of minutes, but I'll see that these effects amplify depending on which type of target county you're going to look at. So these results indicated that these donations are likely related to the takeover. I do want to look at this in a little bit more detail. So what I'm doing here is I'm looking at deals that were announced, but that were not completed. So in which the acquiring firm withdrew the takeover offer. And I'm going to look at what happens to the acquirer firm's donations prior to the takeover, after the takeover announcement, but before the withdrawal, and after the withdrawal. And so what I'm seeing is that donations remain elevated in the year, or in the 2 years prior to the announcement. They increase even more after the deal was announced, but before it was withdrawn. And then after it was withdrawn, it reverts back to baseline, very much indicating that these donations were likely intended to get this deal across the line. So these donations do seem quite related to this takeover decision. Now, do these patterns reflect an increase in donations to target counties or a decrease in donations to control counties? That is what I'm going to look at here. So I'm looking at a sample of control counties. The target does not operate in these counties. And so what I'm seeing is that the acquiring firm indeed pulls funds out of these counties in the years prior to a takeover announcement. This is concentrated in counties in which the acquirer does not operate, because acquiring firms have incentives to donate to their own facilities. That's something they do. So excluding those counties, it indeed pulls funds out of counties where neither the acquirer nor the target operate. And this effect increases even more if I look at the more distant counties. So counties further removed from the acquirer's headquarters, where there's no target operations, no acquiring firm operations, funds get pulled out of those counties. Now what happens to those funds? They get transferred to the target counties. So here I'm looking at a sample of target counties. And so here there's an increase to target counties prior to the takeover. These donations almost double if I'm zooming in only on the target's headquarters. So headquarters is a strategically important county. Donations double to those counties. They increase by about 20% if I'm looking at counties in which the target's insiders, so executives, directors, are active in local charities. They also increase in counties in which the target operates multiple establishments. There's no increase if the target only operates a single establishment in a county that's of less operational importance. So these donations flow to the target counties that are more operationally important to that firm. Now, how can donations affect takeovers? So I'm going to look at these two main mechanisms that I talked about earlier. So first, I'm going to look at donations as an exchange of benefits mechanism. So I'm going to look at donations specifically to those charities in which the target's executives, directors, or shareholders are active. And so I indeed see that in these specific charities, donations increase by 10 up to 16% prior to the takeover. So this is to executive affiliated, director affiliated, blockholder affiliated charities, and also counties where voting employees reside. Donations to areas where shareholders are active, so the blockholders and the employees, or voting employees, they revert back to baseline after the takeover, because once the deal has been approved by shareholders, acquiring firms have no more incentives to keep seeking some sort of exchange of benefits. They remain elevated for the executives and the directors. So that's a sort of exchange of benefits mechanism. They can also help establish some commitment with the target's employees, because if the takeover is successful, the target's employees will become the acquirer's employees. So the firm has incentives to establish some sort of commitment with those stakeholders as well. So here I also find that donations increase most to those counties where the target has more employees. It also increases in counties with fewer employees, but less so. And these donations are especially pronounced in counties in which the target's employees engaged in strikes in prior years. So consistent with this idea that the acquirer wants to establish goodwill with those employees that are most likely to resist this sort of takeover process. I also have some results that show that these effects are higher in counties with higher unionization rates, that are concentrated in your local neighborhood charities and not so much in charities based on international conflict, for example, and in charities aligned with the employees' private values. All right, now in the last couple of minutes then, I want to look at whether these donations are associated with better outcomes. And so I find that at baseline, if you only look at donations to target affiliated charities, so charities affiliated with executives or directors, this is actually associated with worse outcomes. Acquire returns decrease if the firm donates only to insiders, well, executives and directors, especially pronounced in the CEO affiliated charities. And so this indicates that these donations might actually reflect agency issues in the acquiring firm, like empire building, reflects a value-destroying deal. That's not the case for all insider-affiliated charities, though. If I zoom in on the blockholder-affiliated donations, so shareholders, the ones that have to approve the deal, then I do see returns for the acquiring firm. So announcement returns and the deal announcement, they increase. And this reflects a 1.7% lower deal premium. So shareholders seem to be willing to accept a slightly lower price if the firm made some donations to blockholder affiliated charities prior to the takeover. I also see that returns are higher if the firm donates to charities not affiliated with the target's insiders, but the charities in the target's establishment counties, so targeting employees. They are also associated with better acquire returns, reflected in lower goodwill impairments, which is an empirical proxy for integration costs. So the integration process between both firms seems to be easier if the acquiring firm donated to the target's employees prior to the takeover announcement. So consistent with this employee commitments and reputation building mechanism. So let me wrap up. So I investigate the use of charity by corporations as a sort of non-market strategy to manage stakeholder relations. In the context of M&A, I find that firms donate prior to a takeover announcement to target counties. These donations go back to baseline if the takeover offer does not go through, if it's withdrawn. And it reflects a redistribution of funds from counties not associated with the deal to counties related to the target. And so these donations are concentrated in donations to target insider-affiliated charities and employee-oriented charities through this exchange of benefits and commitment-building mechanism. Now, donations are not always associated with better deal outcomes, though sometimes they are, especially if they're made to shareholders who can approve a deal and achieve better deal terms, and if they're made to the target's employees. So overall, these results show that charity can align to an extent financial and pro-social incentives, but it also highlights a need to address governance and transparency gaps in nonprofits so that we know which kinds of mechanisms are going on in terms of the firm's business interests for making these sorts of donations.
Thank you. So is there any question from the audience? Yeah, please go ahead.
I mean, I thought this was great. Now, so several points. So first, do they donate before or after they've approached them? And you can find that out, right? So have they already talked to them and then they start donating, or do they start donating even sooner? And you can find out in the, they have to disclose, right? When they first talked. So,
Yeah.
So,
so I haven't investigated this like empirically, but I find in some cases that they start donating up to 5 years prior to a takeover offer, indicating that they're probably doing this even before they reach out.
But then you should, why don't you use this data to predict takeovers? I mean, if this is what they're doing, you should actually, this is a great prediction of whether somebody will become a target long before apparently anything else happens. I mean, I don't know how many false positives you're going to have.
Yeah, no, that's an excellent comment. Long story short is my referees wanted me to throw out those tests. I did have them, but I was requested to take them out.
And then just a final question. I mean, it seems very cheap to buy a good deal. So why don't I do a lot more of it?
Yes, no, that's an excellent question. So one of the aspects here is that the monetary amount, so the $20,000, that only captures the direct monetary costs of making that donation. What's also playing a role here is that to make those donations and to identify the charities, firms need to operate a foundation quite often. And foundations are actually quite costly. Like running a foundation can run into the millions of dollars once you take into account like employee costs and these sorts of things. So that's one aspect. Second aspect is that I do think there's a lot of uncertainty. So like on average, donating is associated with negative announcement returns. Markets don't like it. So I think because of that, it's a bit of a fine line. And I think that uncertainty might deter perhaps some firms from doing this in the first place. That's my interpretation.
All right. Thanks a lot, Kara. So we are now going to turn to our last presentation with Professor Marieke Uyzentraut from HEC Paris, who is going to tell us about hybrid organizations and beneficiary engagement, the role of language. Welcome, Marieke.
Thank you. Thanks for still being here. I should applaud you guys after a full day of. Can you hear me? Does it work? Yeah. Okay. Cool. Yeah, I figured the microphone it's going to be hard because I like to move my arms, and so you won't hear me. So, so my name is Marieke. I'm a professor, like Xipeng, I'm a professor in strategy. I think we're the only two here, and so actually, thanks for organizing an event like this because it actually doesn't happen that much that we get to learn from different disciplines and have practitioners in the audience as well to kind of engage with our work. So thanks for the opportunity, Maxime, and also the Consulate of Belgium here in Hong Kong. So what I've prepared is basically to start off something a little bit more depressing than some of the positive vibes that we were on earlier. So what you see here is an annual assessment of the Global Sustainability Development Goals. And you see this is the most recent assessment. So there's a lot of red, orange, and there's basically no green. So what this is telling us that on all of these goals, we are sort of stagnating or even, yeah, things don't really go good at all. We are really off track. And so actually, these kinds of statistics have led many scholars in management and strategy to sort of take pause and say, like, what are we doing? How can we be more effective, or potentially through our work, through our research, at helping sort of inform strategy that impacts these different domains. What you all know, I imagine, is that there's 17th development goal. So number 17 calls for action, calls for more partnerships for development. So basically, this is the goal that is speaking out to businesses and other private sector actors to step up and sort of see what they can do, what kinds of initiatives can they bring to help make progress towards these goals. Okay, so I should say, I don't know how it is in your disciplines, but in strategy, there we are a little bit in a depression. Actually, there's a lot of work, like recent pieces in management science, organization science, Financial Times, professors that are speaking up and asking themselves, what can we do? Should we be more active? Should we be closer to business? Should we be more engaging with what private sector needs are and help them sort of connect them with these kinds of goals? So there's a quite vibrant discussion now about research with impact, research that resonates, and sort of trying to maybe leave our offices more often and be more in touch with what's on the mind of businesses. So what I've prepared now is basically just a very quick snapshot of 3 studies that I'm working on, but more to share some ideas. So a lot of my work regards hybrid organizations. So these are organizations that have dual goals. So you talked earlier about logic. So these are organizations often that are trying to combine a business logic with a social charity logic. They are combining a sort of economic goals with, or financial goals with sort of more social impact goals. There's a very big literature. A lot of scholars are interested in these organizations, and they look at all the tensions that maybe people who work in these organizations face when trying to sort of try to pursue those two or multiple goals. By the way, there is a big literature now talking about the fact that every organization pursues multiple goals. It's not just hybrid organizations that pursue multiple goals. But I'm going to limit myself here to hybrid organizations, specifically that are trying to affect welfare or well-being of marginalized communities. So that's my, if there's one common theme in my work, it's about vulnerable groups, marginalized communities, and trying to see what can we do to affect their well-being. So, and so more and more, and I've come to understand that language is an important lever that we can actually activate to be more efficient at reaching these hard-to-find communities. And I'll tell you how I come to that conclusion through the following three studies. So, and actually they correspond, to working together with three types of hybrid organizations. One is the typical like CSR type of initiative where basically it was Danone through Blidina that was trying to affect the sort of child nutrition outcomes of low-income families in France. So I'll talk a little bit about that, and then I'll talk about some social housing agencies and a public institution. And so heads up, so my work is very experimental, so it's really like I spend for each of these projects at least 1 year preparing for a field experiment and then trying to collect new data to evaluate. So it nicely complements some of the other methods that were presented today, which use kind of really interesting bigger data sets. So my work is by definition micro behavioral, and so I look at specific contexts to make some progress on understanding how these types of initiatives can be more effective at affecting these kinds of outcomes that we might care about. Okay, so I'm interested in the kind of client, the organization client interface, and I'll tell you a little bit more about how I do this. Okay, so first study in, this is published work with Rudy Durand, who's my colleague at HEC, and so we worked on a field experiment with Danone, trying to see how can this initiative, which is not just Danone, as you can see, it's a kind of a collaboration between French Red Cross, the French Pediatrician Association, how can they be more effective at reaching low-income households? And so we did a large experiment affecting over 5,500 households, and we essentially tried out different communication frames, different ways of communicating about this project to see which one would be most effective at attracting people to, encouraging them to enroll into the project and using, basically this is a project that provides vouchers to families that they can use in the supermarkets to buy baby food products at a much reduced price. So it's vouchers and also like tips and tricks, like child nutrition tricks of how to produce healthy meals at home. Okay, so typically what a lot of these initiatives do, these corporate social initiatives, is they kind of don't want to talk too much about the fact that there's a corporation involved, and so they really press hard on, we are a charitable initiative, we are, and so in the communication, and that was basically our status quo, would be that we talk a lot about, we are a social initiative, we are created by these social initiatives, to kind of emphasize the social goals, the social legitimacy of the initiative. So we kind of replicated that messaging, and then we tried other communication frames. Basically, we used the status quo, which is, emphasizing the social goals of the initiative, and then we compared with other types of message framing, where we either emphasize the goal of the fact that there's an alignment between the program and the goals of the households, or we emphasize empathy. We show that we kind of care about, we understand that living in poverty is a lot about juggling and struggling, trade-offs, or we simplify the message, or we kind of combine some different communication frames. So the trick here is that we have a large sample, so we can actually compare different treatment arms and see which one of those actually works best. You want to guess? Which one do you think worked best at getting people to enroll? Please. Yeah, and one other. There were two that worked best. What do you think? You can rule out this one, right? So that one I didn't really sell, the charity one. But empathy, actually empathy and simplicity were the ones that worked best. And it's very interesting because we tend to, when we present these sorts of initiatives, we tend to talk about ourselves. And actually that's not what helps people attract the attention and engagement of beneficiaries. It's really turning things around and showing that you actually understand what it's like. So the empathy, and then really just sort of simplifying what the program offers. So interestingly enough, okay, so we have a kind of a big take-up, and also here we can see the different messages that we used. And so it's actually interesting, not just the take-up changed, but even 3 months afterwards, we found that the simplicity and the empathy message also increased the utilization rate of the coupons, which was kind of beyond our expectation. I thought it would be like a campaign, immediate impact, but actually it also changed the way the beneficiaries engage with the program afterwards. Now why? So this is cool, okay, great. And so now basically the program is scaling for the whole of France. So every month there is hundreds of thousands of women, often women or parents who get messages using the empathy frame. So basically, cool. There's a kind of, and that was the President Macron identified this as part of the child sort of strategy to fight child poverty. So very cool. But actually, what happened was that we actually, we didn't really affect the changes of people who don't master, who are actually not French, of French origin. So basically, all of the effect is coming off people who are of French origin. And the other thing is, actually, there was a huge spillover effect. So over 700 other people who never received the message signed up for the program. So basically, there is a big diffusion that is going on within this community, which we just didn't anticipate, and so we were not really able to study. But is it important in terms of like any future work that is trying to reach these communities? Basically, what happens is that there's some people are like really strong reference, and they forward the messages to other families that could benefit. So there's a lot of solidarity, and I think in general, we really underutilize the spillovers in the kind of positive diffusion effects that these programs could achieve. So, but this is like a little bit disconcerting. Basically, all this kind of messaging, verbal words, we were not effective at reaching people who were of foreign origin. So that kind of was a bit frustrating. So now I'm going to introduce you a second study that tries to advance. So here we're in still a little bit of the same communes, the poorest departments in France. They're working with social housing agencies who also have this similar challenge of, okay, they have to make the business run, so people need to pay their rent. So that's, at the same time, they also have a social hat. They care about allowing, giving affordable housing to everybody. So basically, there's this kind of, again, dual objective of social housing agencies. And again, after working, looking at how they organize for over a year, actually, we understood that when somebody has a problem of rent arrears, okay, the frontline professionals, they will phone up and try to get them to pay. And there's two ways of doing this. Either like the shocking way, like if you don't pay, you might end up on the streets, like the really like harsh or business way, or something much more soft, which is about what's going on, why are you not able to pay your rent, and so this is work with Thomas Oblage. So we were interested. Okay, maybe we can try to assess which of these ways of communicating is most effective at recovering rent arrears and clearly trying to avoid evictions. So, and now coming back to what we did was basically we started working with a graphic designer with like visuals, because of the problem earlier I told you about the other study where we never reached the people who don't really speak French. So we tried to revamp the way they actually remind their tenants to pay their rent, but now changing the wording and adding visuals. So I guess you can guess this one is really more it's more formal, it's more transactional. It's like we have you have your responsibilities to pay. So emphasizing that the relationship is like more of a contractual business type relationship. This one is, as you can see, like it's more soft. It's about like treating the tenant more from a social welfare perspective, like what is trying to put them in a more kind of beneficiary-centric mindset. And then lastly, we had a neutral, which didn't work. So good, like we can exclude that one. So what we are interested in again is like, here we are manipulating how the tenant thinks about the relationship. Am I in a very contractual business-like relationship, or am I more in a beneficiary kind of social informal relationship, or basically not manipulating that at all? What do you think? Which of these messages worked best at, let's say, at reducing debt? Subsequently, which of these messages do you think helped to reduce the debt? Any guesses? This or that? This one, yeah. But it's interesting. So actually, so we have basically, yes. So, and we, by the way, we did this in, this is like a study with 2 field experiments. So we replicated the results with another in a completely different setting. And so we find, yeah, so we find that, like the middle one, so the beneficiary-centric message, actually, so the likelihood of being indebted the following month was lowest for the beneficiary relative to the client-centric messaging, and we actually the neutral was even worse. So we kind of only tested the neutral message 1 month and then dropped it because it was actually the poorest performing. And so we also see that the size of the debt. The size of the debt the following month is also lower. So basically, you could say, cool. So we could say we could recommend to the social housing agencies to use more of a kind of softer tone to remind their tenants to pay their debt. But that's not the full story. Actually, and this is also quite coherent, we see that there's a greater take-up of a repayment scheme when you're in a kind of contractual, formal, business-centric kind of relationship. So the take-up rate of a repayment scheme that the social housing agency provides is higher following this kind of more contractual messaging. And then what we also find is that once people repay their debt, the likelihood of falling back into debt is also smaller when it's a client-centric message. So basically, it's not, the recommendation is a bit more mixed. It all depends on what you care about as a social housing agency. Do you want to reduce like the size of the debt in the short term, or do you care more about long-term situations of debt, and in which case you might privilege the client-centric message over the beneficiary-centric message. I should say, I forgot to tell you, like, we went into this project suspecting that, you know, rent arrears affects maybe a minority, like, I don't know, maybe 10, 20% of the people living in social housing estates in France. It turns out that in these two, and these are like big, they have like each has over 40,000 units. These are big social housing agencies. Actually, it affects the majority of the tenants. It's not a minority phenomenon. It's actually if you look at, you know, it's 75% of all the tenants incurred at some point in their tenure a problem of rent arrears. So it's kind of interesting because then you also realize, like, the problem is much more systematic, and maybe we're beating something which is trivial. If you really wanted to make a difference on the problem of rent arrears, probably we need to rethink the contract altogether and not just chase people for. But for organizations like or partner organizations, this really matters. They have a dashboard. They really keep track on how many people have a rent arrear, how much money is at stake. For them, these are the key you know, indicators they care about. But in some sense, the whole assumption that people are able to pay their rent is probably flawed in this setting. So yeah, I'd be quite interested, I guess, in a city like Hong Kong with a housing problem. You might, some of these results may be interesting to see whether they can be translated to a setting like Hong Kong. Okay, so then let me turn to a very last study, which is very different. So actually, this one is not an experiment, and this one actually relates a little bit to your work on logics because we exploit language as well. So what we are here interested in is basically we're still in a setting of, you know, people who rely on welfare benefits. So in France, that will be like housing allowance, child benefit, unemployment benefits, disability benefits. These are the sort of bucket of benefits that people can access. And so there's a public agency called CAF, 93, so that stands for the Seine-Saint-Denis department, which is the poorest one in France. And now what we were interested in is like how, so basically when you're, so how shall I explain this? So basically the, in a place like Seine-Saint-Denis, 60% of people rely on benefits coming. So this is like, it's the this is the department with 27% live in poverty. This is like a department where there's a lot of people actually rely on CAF. So we're looking at a pretty representative, let's say, sample of low-income households in Seine-Saint-Denis. And we were interested in understanding the language people use when they email the CAF. So when they have a difficulty, they can go to the guichet, so they can go to the place, the offices, and to the till, and ask, and they often do actually. They can also telephone, or they can write emails explaining that there's a problem. So what we are interested in is when a beneficiary writes an email, so you should know, like when they write an email, it's typically about, oh, why did my housing allowance go down? Why am I no longer getting my housing allowance? Or it can be very like practical things. Oh, I forgot to send you this document, and so there's many different reasons why they would send an email. So what we were particularly interested in, I should say, this is Paul Gouvard, who's a kind of more of a linguist, expert in language and analysis of language. We were interested in understanding whether, when the language is very different, when people speak very different languages, is that consequential? Like, we're looking at the semantic alignment between the messages sent by beneficiaries and those used by the public officials, so the frontline workers. So basically, we would expect that, when there's a good alignment, when the alignment is strong, there's higher liking, it's easier to coordinate, communicate, etc. So we would expect semantic alignment to be positive in terms of whether it predicts subsequent access to aid. But what we actually, and I won't ask you, but I'll just tell you, what we actually find is the opposite. Okay, so what we find is that when the semantic misalignment is actually predictive of greater subsequent, accessing greater subsequent, in the subsequent months, welfare aid, so increased benefits, and also, so there's different kind of specifications. So basically, misalignment predicts more aid. Misalignment also predicts greater likelihood of getting an answer to begin with, and misalignment also predicts the timeliness, so less delay, faster response. So that was kind of like a puzzling. We didn't expect this result, so we spent a lot of time talking to the frontline officials to help us understand what is going on. So why do we see misalignment to play a role here? And basically what they say is that because these frontline workers, their job is not automatized yet, so they actually have quite a bit of discretion yet when they filter through emails, which ones to attend to and which ones to not to attend to. And they privilege these messages because the fact that they're so misaligned, they infer from that these people are really lost in translation, and we should kind of prioritize their needs. So it's actually, in some sense, a little bit comforting, because we are talking here about a public office whose mission is to actually make sure that people who are entitled actually receive their welfare benefits. So what we find in this setting is that actually misalignment is something that predicts access to benefits. At the same time, it is kind of interesting that, because we control for many other potential factors that may affect access to aid, it is kind of interesting how language in and of itself can play such an important role. I mean, these decisions are highly consequential for beneficiaries, so that actually, it's kind of also a little bit, you could say, surprising that it plays such a big role. In terms of theory here, how do we theorize about this? Basically, what we are saying is that this is a setting where the beneficiaries do not have many resources to actually learn to master the language of the official. So typically, in the previous, any kind of work in this space would expect either kind of exchange to break down. If we don't speak the same language, basically at some point that will just collapse. Or we would expect one or two of the parties to actually invest in mastering the language, so that actually coordination and communication becomes easier. So in this setting, this is a kind of extreme case where actually the people involved don't have a lot of resources available to invest in mastering the language. And so we think it's kind of an interesting theoretical contribution then to actually show that when this is true, there is still opportunity for exchange. In fact, even the misalignment could be something that positively affects a transaction in this particular setting. So again, as I said, like the officials interpret this as a sort of misalignment, as a sign of need, of urgency of the beneficiary's situation. Let's see. So let me conclude, and then if you have any comments or questions, I'll be very interested to listen to you. So basically, these are just 3 studies that I wanted to share with you, which have to do with social impact and language, and where we try to explore, using different methods, the role of language in these at the interface organization beneficiary. So in particular, communities that are disenfranchised, marginalized communities. Where the first study kind of shows that actually the words that you use, what you say, actually matters in terms of your ability to engage with your target audience. So the presentation, I don't know if this is true at your school, but I should say we have, for instance, a training program that targets disadvantaged women. And so we could kind of learn from this work of what words do you actually use to attract people's interest and to actually get them to, for instance, sign up in a training program, or what words do you use? We work together with big banks who actually have social offers. How do you present those kind of social offers to your communities? Again, language may play a bigger role than we sometimes assume. The second idea, and this is something that people have not shown, is that basically the way we think about the nature of the relationship that we're in. Do I perceive this relationship to be like a transactional, formal, business-like relationship, or instead do I see this as a sort of social, informal relationship? Actually, this may really matter to how I actually behave. Okay, and so this is something that we can influence. In fact, so we show this with the social housing agencies. Just by the words they use when they communicate, or the visuals they use, actually they prime the communities to think differently about the relationship that they're in. And this, again, I showed you is consequential to their behavior subsequently. And then the last point is about, okay, when we have different communities, what happens when actually they do not speak the same language? How might this affect the ability to access, in this case, the ability to access aid? And so this is kind of interesting, and actually now there's quite a lot of organizations that are like now coming to Paul and I to work with us, because it's actually a big challenge of how do you, so many social organizations work with frontline workers, and so how do you actually, on the one hand, standardize their work without, and still allowing for some discretion, given that this discussion is actually might be favorable to the overall goals of the organization. So I hope I gave you a little bit of a flavor of the kind of work we do. So it's more micro, it's more experimental, but it's very collaborative. So a lot of what we do at HSC is with a structure that we created thanks to Schneider Electric, which is called the Impact Company Lab. And we really try to connect researchers with actors in the field who want to test and experiment, evaluate scientifically approaches to affect sustainability outcomes. So thanks for your attention. And yeah, I'll be happy to take questions if we have time.
Thank you so much, Marika. Any question? Yeah, please.
Have you considered expanding the conclusions of your study to different societies which are more or less socialistic than France? France is quite rather socialistic on one hand, and where maybe the rule of law applies better than in France, does not apply very well in France at this point in time, it seems.
I like your question. Yeah, well, yeah, I mean, yes, I'm actively trying to find other testing grounds. Like I was 2 weeks ago, I was in Morocco. Yeah, I try to, yes, I agree with you. I think we need to like try to test the validity of this work in different settings. I think it's quite culture specific. And so, yeah, I agree with you. I think we should try to explore. And I actually was thinking, coming here, I don't know how much, you know, in French, there's many different dialects, there's many different, I mean, you should, at least in the way well, I should say dialects, different ways of expressing oneself, formal, informal, and all of that I see in the messaging. So I guess my question would be like, I don't know, here in Hong Kong, whether there are different ways of communicating about the same, you know, using different flavors of, for us, it's very clear that actually there's a like variation in terms of the semantic space we are in, even within the same community, in the same country. So I wonder whether that exists in a place like Hong Kong as well. I don't know.
Any other? All right. Well, then this concludes today's conference. We now are gonna have a small Belgian beer taste. So thank you very much for joining us today. It was great to have you, and thank you very much for all the participation. I thought it was very active. We got lots of questions. So thank you very much, and please enjoy Belgian beer. Thank you.